Welcome to Navkar Digital Institute. I welcome you all to this rapid revision session of costing paper. That's your paper number 3. Now we're going to be revising entire costing in a very quickly manner, and this video is going to help a lot for preparing your examination. So without wasting a minute, let's begin. Now if I talk about your costing syllabus, it comprises of 15 chapters. Right? There are total 15 chapters right from chapter number 1, which talks exclusively about theories. Moving on to the next one, material, labor, overheads, cost sheet, job costing, batch costing, contract costing. Then we got process, joint product, byproduct, marginal costing, standard costing, and budgets and budgetary control. Right. So there are total 15 chapters that you got to cover in your costing syllabus. And what I'm going to do is I'm going to start in a reverse order. I'll be starting from chapter number 15. That's your budget and budgetary control. We'll take a look at what are the points that you need to keep in mind. And once we are done with that, we'll be moving on to the chapter number 14, 13 and so on. We'll come to chapter 1 and then we'll be ending this rapid revision session, right? So with this said, let's begin with chapter number 15, and that's about budgets and budgetary control. So if you talk about budgets and budgetary control, first thing, what is the definition of budget? So there are two things that you need to keep in mind for something to be called as budget. Like for example, for something to be called as budget, there are two main characteristics. One, it should be quantitative expression. And second, there should be for definite period of time. Right. It should be for a definite period, and it should be for a quantitative expression. Like I give you example. If I tell my manager that next year means I'm defining the period. Next year you have to do maximum sales. It is not a budget because there is a definite period next year, but maximum is not quantified. On the other side, if I say like, gentlemen, sell 10,000 units, again it's not a budget because he may come to me after 4 years selling 10,000 units, and he may tell me that, okay sir, I have sold 10,000 units. Again, that is not a budget because the name of chapter is budget and budgetary control. If you do not tell a specific period within which he has to sell those 10,000 units, you will not be achieving the control purpose. And also if you do not put the number 10,000, you will not be achieving the control purpose. So for achieving the purpose for which you are preparing budget, that is control, you got to be satisfying these two conditions, that it must be a quantitative expression and it must be for a definite period of time, right? Now, when we look at the types of budget, right, there are two main types of budget that we prepare. So when we look at types of budget, just a second. Yeah. There are two main types of budget that we need to basically look at. One is going to be functional budget. Right. First is going to be my functional budget. And second is going to be behavioral budgets. These are the two main types of budget that we prepare. Starting from first, functional budget is the budget prepared for each function of organization. Now, what are the functions of organization? So under this, I might be preparing, first of all, sales budget. I may be preparing second function of your organization, production. So you might be preparing a production budget. Third function, you got to be purchasing the material, so or you need to be preparing a material consumption budget. Based on consumption, you have to purchase. So fourth budget you might need to prepare is a material purchase budget. Fifth one is going to be your wages budget. Sixth one, though we are not specifically asked sum on this, but you got to keep in mind that there are overage budget being prepared. And last, your master budget. Right, that's how functional budget needs to be prepared. These are main functional budgets. There can be other, like even we can have bifurcation between FOH, admin, S&D and so on. Now, and as far as behavioral budgets are concerned, first budget that we prepare is a fixed budget, and second is a flexible budget. Right? These are the main types of budget that we prepare. Now we'll visit each and every budget very quickly. We'll see how it can be prepared and what is going to be the format in which you can prepare the budget. So if I have to explain you the budgeting process very quickly, first of all, through budgeting process, understand this thing, I am only interested in knowing one thing, and that is, as a business and as an entrepreneur, I'm only interested in knowing one thing, that what is going to be my profit for the next year. The ultimate question that I want you guys to answer is what is going to be my profit for the next year. That's the main question that I want to answer. So if you want to know how much is going to be my profit for the next year, we need to have few questions answered. First, if I want to know what is going to be my profit, I must know what is going to be my sales, how much will be my production cost, how much is going to be my overheads cost, how much is going to be my material cost, wages cost, and then you summarize all this and you get your profit figure. So if you want answer to this question, that what is going to be your profit, the first and foremost question, profit will happen when? Profit can happen only you make sales. So how much sales will happen in the next year? For that we prepare sales budget. There are variety of sales budget that can be asked, but generally what is asked is what I'm going to show you right now. So first budget, always in budgetary control procedure that I prepared, is a sales budget. So how do I prepare sales budget? Generally usually what format is asked in intermediate is something I'm going to discuss right now. Like, you know that during the last year, for the years just ended, you have been able to sell, say for example, X and X units. Or let me put some number that you have been able to sell 10,000 units during the last year, for the year just has ended. And now you estimate that next year we'll be able to increase 20% of the sales, because we'll be working hard, market share is going to increase, market size is going to increase, and for whatever reason we'll be able to sell 20% more. So my next year sales units are going to be 12,000 units, and multiplied by selling price per unit. What is the estimated selling price that you expect? Say for example, if I expect 100, then my sales rupees is going to be 12 lakhs. So 12,000 into 100 is going to be 12 lakhs. 12 lakhs rupees is going to be the estimated sales for the next year. That's how I get my sales budget, right? So any budgeting process, more often than not, every sum of budgeting starts from sales budget. Yeah, in some sum, I'm telling you right now, if the selling price is not given, I'm giving you right away selling price. If the selling price is not given ready-made, then more often than not, the sum in your examination will begin from the heading of calculation of selling price per unit. That's the first thing that you'll be calculating if selling price is not given. So you'll be saying calculation of selling price per unit. Now how to get selling price per unit? Simply follow the format of cost sheet and you will get everything, right? So if you have to calculate selling price per unit in your examination, first of all, start from direct materials. Calculate your material cost. Add direct labor to that. Simply follow direct cost sheet format, right? I'm telling you. So direct material, direct labor gives you prime cost. After getting prime cost, add factory overheads to that cost, to that prime cost. So we'll say add factory overheads. Now generally, here we get gross factory cost, works cost, and then we add, opening WIP and closing WIPs. But that question of adding and subtracting WIP stock will not arise over here, my friends. Why? Because essentially you understand we are only calculating everything for per unit basis. See, when you're calculating for when you return direct material cost for 10,000 units and then 2,000 are remaining WIP, then you got to adjust WIP. But the very fact that you are only calculating, you are only making this working note for per unit, it is telling you clearly that no stock adjustment required over here. Do remember this. So do not get confused in examination when you're calculating selling price per unit about what is to be done about stock. Nothing, right? So we have got factory cost. To that, we add admin overheads. To that, you add S&D overheads. Again, nothing to worry about finished goods stock. Same logic, because we are working on a per unit basis. So this will give you total cost. And to that, add whatever profit margin the question is telling you to add. Add the profit margin and you will get your selling price per unit. Right? Some sums, I'm just trying to tell you all the varieties that is given. First and foremost, without getting sales unit in any question, do not move forward unless it's the question of flexible budget, which I'm talking about. But for doing any sum of budgetary control, you must be having sales unit with you. Unless you have sales unit with you, do not move further in that sum, right? Like if you have to calculate sales unit like this, like last year given, and then divide by 20%, it's okay, go by that way. Now sometimes what questions are asked is, they give you sales rupees ready, they give you estimated selling price, estimated sales revenue in terms of rupees ready. Then they give you cost data. So what you need to do is, if you are given estimated sales revenue ready and you are given cost data, then again calculate the selling price per unit with the help of format that I just gave you above. Direct material, direct labor, prime cost, add factory overheads, admin, S&D, total cost, profit and selling price. Again, don't worry about stocks because we are calculating per unit basis only, right? So once you get the selling price with estimated sales revenue, divide by selling price per unit, so you will get your sales unit, right? You'll be getting your sales unit, and once you get your sales unit, move forward in the budget. Now what is the next thing that we need to do? So after getting sales budget, the next budget that we think to prepare or we have to prepare is going to be production budget. Now how can we prepare production budget? So by preparing production budget, our intention is to know how many units needs to be produced next year. The main question that we want to answer by preparing production budget is how many units needs to be produced during the next year. So when you're answering this question, how many units are to be produced during next year, the first thing that you must know is sales unit, because the simplest answer is number of units that you got to sell are the number of units that you got to produce, because unless you produce you cannot sell. It's very simple. So production budget, how much production is to be done, the first and fundamental answer that you will get is from sales unit, my friends. And that's why I said, unless and until you know sales unit in any sum of budgetary control, please do not move forward. So we've got the sales unit. Okay, say for example, in my example, I've got 12,000 units to sell. So definitely I got to produce 12,000 units. Then one of my manager came and asked me, so we are selling 12,000. I said, right, okay, then what's the problem? And so we are producing 12,000 as well. Yeah. So he says, so what if demand exceeds our expectation? What if there's more demand? we'll be running out of stock, we'll not be able to sell, we'll not be able to make profit out of the demand. I said, yeah, you're making sense. So what is to be done? He said, sir, let's produce more. If it doesn't get sold, we'll keep it as a stock. What's the issue with that? I said, okay, man, go, permission. So we want to produce more so that we can keep stock. So I'll say add closing stock. Whatever number of units you want to keep it as a stock. Like if you're thinking that I want to keep 2000 units always as a stock. So okay, produce 2000 more. And that gives me a gross requirement. Right, so we have got gross requirement, say for example 14,000 in our example. So I want to produce 14,000 units. Why I want to produce 14,000? Because 12,000 is what I want to sell and 2,000 is what I want to keep it as a stock. And then that very same manager told me, sir, please wait. I said, what happened? You only suggested me, and that's why I'm allowing you to produce 14,000. He said, sir, okay, agreed. Thank you so much for listening to me and allowing me. But I just noticed that there are 1,500 units already lying in the godown, already lying in the stores, finished goods. Oh gosh, is it? Yeah, 1,500 units are already lying in the stock. Then you don't need to produce those 15,000 units because your requirement is 14,000. If you already have 1,500, do not produce it. Produce rest of the things, and that is why from gross requirement we will say less opening stock. So whatever units are there with you as opening stock, do not produce it, and my friends, you will get your production. That is the format of production budget in which you need to work. So always production budget is going to work like this. Okay. Now after production budget, the next budget that we want to prepare is going to be material purchase budget. Consumption and purchase I will show you together. Okay. Now see, all these questions are very much interrelated. First question that we answered is how many units you want to sell. Okay, I've got the answer, 12,000 units for the next year. When will I be able to make sales? Answer this question. When will I be able to make sales? Only when I've got production. Right. So next budget we prepare is production budget. So we prepare production budget like sales unit, add closing stock, gross requirement, less opening stock. Oh my gosh, we are ready. Next thing is material purchase budget. Why material purchase budget next? Because when can we produce? See, if I want to answer, when can I get profit? When there are sales. When can I have sales? When I have production. When can I have production? The first requirement is if I have material, I can start production. So next thing that I want to answer is what quantity of material do I need to purchase during the next year? So tell me very frankly, if I tell you that my 1 unit requires 5 kgs of material, if my 1 unit requires 5 kgs of material, what is that number? What number of kgs I need to purchase? Depends on what? Depends on production. Because whatever number you want to produce, that will need material, and hence they have to be purchased. Very simple. So your purchase budget will start from production. Right, we have got production units multiplied by kgs per unit is going to be this. So that gives me my consumption quantity, that this many units are going to be used. Like if you are asked consumption budget separately, do this much. But if you are asked purchase budget straight away, you need to continue forward. I'll tell you what if separate consumption and purchase asked once I complete this. So and please remember, this is the sequence that you got to remember. Understand? Material depends on what? Material depends on production. As you can see, material budget is starting from production. So material depends on production. Production depends on sales. So that's what I tell you. First and foremost, you got to have sales units with you. Right? Once you have sales unit, you can have production unit. And sometimes the question can be like this as well. Prepare sales budget. Second, part 2, prepare material purchase budget. You got to be very clear in your mind that after preparing sales budget, I cannot jump to preparing material purchase budget. I got to have production budget, because unless production, I cannot start material budget, as you can see over here. Because your material consumption will depend on production quantity and not on sales quantity. Okay, so we got consumption. Then again same story gets repeated, that so okay, we are producing 12,500 units into 5. So this is going to be the number of kgs that will be consumed, 62,500. So I ordered my staff to purchase 6,200 kgs. But then my manager told me, sir, what if we have to produce more? The demand is superb. We have to produce more. Then what will we do? I said, oh my gosh, in that condition, we'll be stuck. But no, sir, let's not get stuck. Let's keep some more. Let's purchase more. We'll keep it as a stock. I said, okay, agree. Go permission. So for that, I allow him to purchase more. And that is why I add closing stock, that okay, whatever number of units you want to keep it in closing stock, go and buy more, my permission. So consumption are the units that we're going to need. Add closing stock, we'll be getting gross requirements. So I got my gross requirement. I told my manager, purchase manager, gentlemen, go and purchase this quantity, we'll need it according to your EOQ or whatever system that you follow. But then he answered me, then he questioned me, so is it really we need? Yeah, I need. Look at the calculation. What nonsense are you talking about? But sir, no. We need this much, but there are already few kgs lying in the godown, already there. So should I purchase this? Oh no, idiot, please don't do that. If this is my requirement, if you got some opening stock, just look at it and subtract whatever quantity you have there. Don't need to purchase it. And hence, from gross requirement, we say less opening stock and you get purchase quantity. This is the quantity that we need to purchase, and this purchase quantity we multiplied with price per kg, and you get purchase budget in terms of rupees. Okay, so that's how we prepare our purchase budget. Now if you are asked consumption budget and purchase budget separately, like part 2 is prepare material consumption budget, part 3 is prepare material purchase budget, then what you're going to do? Prepare consumption budget, end it over here, and then again give a new heading, part 3 material purchase budget, start from consumption, add closing stock, less opening stock. So broad format is going to remain this. If you are asked consumption and purchase separately, just split it and get your answer done. So the first requirement of production is material, we prepared it. Next requirement, what is the next requirement? The next requirement is going to be wages. You got to have workforce. So next budget we prepare is wages budget. Yeah, purchase budget, I'll just tell you as far as your sums are concerned. In many sums there are more than one material required to produce one product. Then you can have columnar presentation. Like if my product requires 3 materials, A, B and C, so I'll be preparing budget like this: A, B, C, start from production and multiplied by kg. So that's how you can do it up. Okay, and even if there are more than one products that is being manufactured by your company, manufactured and sold, then your sales budget as well as production budget will be in a columnar form. Okay, so adjust accordingly. Now let's prepare wages budget. Again, how many number of workers we need to recruit, how many hours we'll be paying for. You need to have a HR budget ready. So how many hours you'll be paying for, it depends on wages, labor force depend on, yeah, exactly, production. So again, wages budget is going to start from production. Whatever number of units you're going to produce, that will require your workforce. Okay, production multiplied by, we will say, hours per unit. So that gives me total hours. And fortunately, please do not try to add closing stock and less opening stock over here, my friend. There is no stock of workers that we keep at factory, right? It's for material and products, no for labor. Okay, so directly we're going to get total hours multiplied by rate per hour, and you get your total wages. So in this sequence and in this format, you have to prepare your functional budget. whatever is asked in your examination, more often than not, the sequence is going to remain there. This, first and foremost, unless you have sales budget, you cannot have production budget. You cannot, if you cannot have production, you cannot have material purchase and wages, right? I hope I'm making that absolutely clear. Then, in practical life, there are overheads budget also prepared. So prepare overheads budget. We are not having any specific sum on just preparing overheads budget in our study material, but yeah, we can prepare it based on hours. You can multiply, you can have a fixed budget, and it's okay. And now, still, after doing so many things, still my main question is not yet answered. My main question was how much profit I earn, and for that I prepare master budget. Practically, master budget comprises of three things. First, estimated P&L account. Second, estimated balance sheet. And third is going to be estimated cash flow statement, right? Like how to get estimated P&L account. We have got all the data to prepare P&L account. If you want sales, you can pick up from sales budget. If you want purchase cost, pick up from purchase budget. Material stocks, prepare from pick up from material opening and closing stock. Finished goods stock, pick up from the production budget. So every data that you need to prepare master budget has already been done by preparing for former budget that we just discussed. And it is also told that master budget, as the name says, master, right? Master budget is, so we say that master budget is a summary of all functional budget. That's what we understand about master budget. Right, that's how you prepare master budget. Now, going to the next part, that is behavioral budgets. So behavioral budget is typically, if I explain you very, very simply why behavioral budgets are needed. In behavioral budget, first budget we have is a fixed budget. Now in case of a fixed budget, so first budget is a fixed budget. Now many students has got this misconception, right? Like fixed budget is a budget for fixed cost. No, my friends, it is not that way. Fixed budget is a budget which is prepared at the commencement of a period and which remains static, which remains fixed over a period of time. What I'm talking about is, if I give you a very simple example, I have told my sales manager that during next year, so when I say during next year, I'm ensuring one thing, that there is a definite period of time, which is the first characteristic of a budget. During the next year, you have to sell 10,000 units. That's the target given. So I've given a target that during next year you have to sell 10,000 units. And when this target is fixed, it is for the year. Now, during January, February, March, April, May, June, I do not change this budget unless, of course, the circumstances have changed like anything. I keep the target fixed that, okay, I'll check with you in December what has been the actual sales, right? So this is called a fixed budget, which remained fixed for a period of 12 months, which is not changed. Now, the purpose of budgetary control, as I said, it is budgetary control. Why are we preparing budget? So that our activities, our managers can be controlled. Now, how can they be controlled? We need to check at the end of year that are they achieving the targets or not. Has he been able to sell 10,000 units? If no, why not? If yes, okay, cool. What is the actual sales? When we realize that he has sold 14,000 units, then we need to check our budgeting process. Oh my gosh, is it anything wrong with my budgeting? That I told 10,000 but he has been able to sell 40,000, might be we might have prepared wrong budget as well. So The budgets are not of any use unless it is compared with actual during the last at the end, and this is what our standard costing is all about, right? So we need a control, but one thing for sure, to control the things we need to be making them comparable. Like, say for example, this is what we spoke about, sales budget. Now let's talk about production budget. So if my fixed budget was like this, fixed budget which was prepared at the beginning of year and which remained fixed over a period of time. Okay gentlemen, you have to prepare 10,000 units, and direct material, direct labor, variable overheads, fixed overheads, so on and so forth. Your cost should be, if you're producing 10,000 units, your cost should be 10 lakh rupees. Yep. Now that's what I've told my managers, and they're also given assurance that if you save anything from me, if you do the production in less than 10 lakh rupees, you all are gonna get some bonus. Oh my gosh, that is awesome, right? So now my manager is focused on saving costs, saving costs, saving costs. He did a wonderful job, and at the end of the year, he came to me, sir, I deserve bonus. I said, what happened, gentleman? Tell me, what is your cost? Tell me, I'll give you bonus. So he said, sir, my cost is only 8 lakh. Oh my God, that's awesome. Just 8 lakh. Well, yeah. Can I check? So I said, check, whatever you want to check. Cost is 8 lakh. I'm definite 100% sure. Okay, I said, cool, you deserve bonus. So when I was about to pay the bonus to him, I was just signing the check of bonus, and my sales manager came rushing in my cabin. Sir. I said, what happened, gentlemen? Sir, this production guy, he is not giving me production only. I want to sell. There's demand. Customers are standing. They are, on my head. But this gentleman is not giving me production only. He is not giving me the units. I said, no, it's not possible. He's a brilliant man. He should have produced 10 lakh units. He should have produced at the cost of 10 lakhs. He has already saved 2 lakh for me. Look, I'm giving him bonus, gentlemen. I'm giving him bonus. So please stop. He doesn't deserve bonus. I said, man, he saved my cost. Sir, listen. He has only produced 2,000 units. Oh. That's a huge blunder. I was about to give bonus, keeping in mind the cost of 10,000 units, and he's actually produced only 2,000 units. So, but naturally, cost of 2,000 units is going to be lesser than 10,000 unless all costs are fixed costs. Yes or yes. And that is where, if you compare like this, if you try to control like this, you're defeating the whole purpose. The purpose, the objective is not being achieved, let me tell you. What is to be done? Actual cost of 2,000 units should be purchased with, it should be compared with budgeted cost of 2,000, and then you will get the actual idea. If I produce just 1,000, of course I'm going to get bonus. So that is not the way. So my friend, when you prepare a budget for 2,000 units, we call it flexible budget. So that's how we prepare flexible budget at various level of activity. Like, okay, if production is this is going to be your cost. If this, then this is going. Now, while preparing flexible budget, only 3 things need to be kept in mind. Only 3 things need to be kept in mind. Your job is done. What are those 3 things? First, variable cost always remains same per unit, and if any increase or decrease is given, apply it on per unit basis. You know that's a very simple concept of costing, right? What I'm talking about is, over here your direct material was 10 lakhs and per unit it was 100 rupees. Now for 2000 it will remain same per unit and my cost is going to be 2 lakhs. That's what simply I'm talking. And it's obvious, you know that, right? Variable cost always remains same per unit and you have to be adjusted on a per unit basis only. Second point that you need to keep in mind is fixed cost always remains same in total, and if any increase or decrease is given, it is to be applied on total, right? Like if there's a rent or a fixed overhead 2 lakh. Now whether you produce 10,000 unit or 2,000 unit, rent will remain same. That's what I'm saying. It remains same per unit in total. And if you are asked that, if you're given that fixed cost will increase by 10%, then you have to adjust it on a total basis and make 2,20,000. For fixed cost per unit is not relevant. And the last thing that you got to keep in mind is semi-variable cost should be divided between variable and fixed and follow step 1 and 2. Simple. If there is semi-variable cost, split that up. Now how do we split? So we say that for variable cost per unit, the formula is going to be change in cost divided by change in units. That's how you will get variable part out of the semi-variable part, right? So these are the main crux of budgetary control chapter. This many things you got to keep in mind. Practice a lot of sums. We cannot discuss sums over here. It's a rapid revision. If you get the format right, you'll be able to solve all the sum more often than not, right? So we're completing this chapter over here and we go to chapter number 14. Chapter number 14 in your study material is marginal costing. So let's discuss marginal costing now. So first of all, what is marginal costing? So in one word, in one sentence, if I have to explain, marginal costing is a technique for treatment of fixed overheads. Okay, let me give you a very simple example. Now, when we talk about treatment for fixed overheads, there are two basically treatments that we follow. One treatment says convert fixed cost into per unit cost. Which technique tells you this? The technique which converts fixed cost into per units are absorption costing, or it can be your ABC. Basic is absorption costing, but the advanced version of absorption costing is ABC, so they're not separate thing. Absorption simply means absorb fixed cost into product, right? So we've got two methods over there: traditional costing, which is your chapter number 4, and then ABC, which is chapter number 5. Okay, and then one technique says treat fixed costs as a fixed cost, and that is nothing but marginal costing. Really simple, right? Now what is to be done and why? Let me give you an example. A businessman is selling one product. Say for example, he is selling only one product, and his selling price per unit calculation goes like this. Direct material cost, of course, per unit is 3 rupees. Direct labor, say for example 2 rupees. Variable overheads, if I have to talk about, it is 3, and then fixed overheads. Now fixed always remains same. I mean, fixed is fixed irrespective of whatever number of units you produce, but the fundamental of absorption costing is to charge it to product, because I agree fixed cost is a fixed, but the fact is I have to charge it to product in order to get it recovered. Unless I charge it to product, I'll not be able to recover. So if my fixed cost is 10 lakhs and I'm estimating that I'll be producing 1 lakh unit, I get rupees 10 per unit as absorption rate, which is, by the formula, if you can remember this, 10 lakhs is budgeted overheads divided by budgeted number of units. That's how I get our absorption rate. So I've got my absorption rate 10. Your total cost is 18. To that add profit, say for example 7 rupees, and selling price per unit becomes 25, right? So that's how cost structure for businessman is working out. He's selling his product at rupees 25. Now say for example on day a customer came and asked for the price. This gentleman told it is 25 fixed price, please do not negotiate, we are a fixed price shop. If you want to buy, else it's okay for me, I am not going to negotiate. Customer said, man, please give me some discount, I am from a poor background, this, that and all, and please. So the shopkeeper said, okay, I do not give discount, I never give discounts, but for you I'm going to make it 23. Just take it in 23 if you want, else forget. Sorry, don't waste my time now. I know you are a businessman, a small businessman, you need help, that's why I'm giving in 23. Now please don't ask anything more than this from me. He said, no, please. And negotiation. That small gentleman, the small businessman, finally told this businessman who is selling this product that he wants to give 10 rupees per unit. If he is only ready to give 10 rupees per unit, whereas our selling price is 25, our cost is 18, as you can see, the bigger question that I want to ask you is, should you be selling your product to this gentleman at 10 per unit or no? Tell me. Think for 1 second and tell me very quickly. Should you be selling your product to this gentleman? Answer is obviously yes. If you're thinking no, it's obviously yes. Why? Because my friend, this is irrelevant. Why are you thinking that your cost is 18? My friend, your cost is only 8. It's not 18. Your cost is only 8, not 18. Because whether you sell these units to this gentleman or not, your fixed cost is going to remain fixed at 10 lakh. Why are you confusing yourself? In fact, if you would have sold these units, you would have made, what we call it as contribution, positive contribution of 2 rupees per unit, which probably would have helped you to pay this 10 lakh, you pay your fixed cost, isn't it? It would have helped you, but you missed this opportunity. Why? Because you converted fixed cost into per unit cost, and that is why marginal costing says always keep fixed cost as a fix, and then only you'll be arriving at a right conclusion. Now we are getting stuck in conflict. Absorption costing says, hey, please convert fixed cost into per unit cost. Marginal says, oh, please do not do that, you'll mess up. What is the right then? So to understand that, first of all, I want to teach you the difference between absorption and marginal costing in this rapid revision section first. So at one side we have got absorption costing. I'll not be getting into much detail. I'll be telling you very speedily, but I hope you'll be understanding this, and you must understand this. This itself can be asked as a question or theory question. So what is the funda of absorption costing? Converts fixed cost as product cost. So if you divide fixed cost with per unit, it is basically converting fixed cost into product. So absorption costing converts fixed cost into product cost, and marginal costing treats fixed cost as period cost. So when we say that converts fixed cost as a period cost, means do not convert into per unit, do not charge it to per unit, keep fixed cost fixed. Like how do you speak fixed cost then? Rent is stand like per annum. So that is what we are saying, that it is treating fixed cost as a period cost. Now again the question is, which technique is right one? So both the techniques are right. We can say that absorption costing is an accounting technique, and it is definitely right, because as said, we need to charge our fixed cost to product, and for that we need to get selling price for it, and for getting selling price for it, absorption costing is must, where you convert fixed cost into per unit cost. But for marginal costing we say that it is a decision making technique. Then okay, few points in the form of cost sheet that I would like to elaborate, because you are also asked the sums on prepare cost sheet as per absorption costing and prepare absorption costing, prepare cost sheet as per marginal costing. So now I'll be showing you the format of cost sheet as per absorption and marginal costing. Format of cost sheet. Though we'll not be getting much detail, but you need to understand it. So format of cost sheet is going to be like this. I'll have two columns. One column is for absorption costing, and one column is going to be for marginal costing. Again, understand, both these techniques differ for overheads. So up till prime cost there is no change. So direct materials, no change in both of them, it will be remaining same. To that we add direct labor as it is, direct expense as it is, as it is. So we get prime cost now. Right, we get prime cost. Now prime cost should be followed by factory overheads. Factory overheads are divided in two parts. One is going to be variable overheads, next is going to be fixed overheads. Variable overheads, again both of them will keep it same. Now the difference will come. As we said that in absorption costing, fixed overheads are treated as a product cost. If fixed overheads are treated as a product cost, then what will happen? It will be charged to product, and if you want to charge it to product, you got to write it before cost of production. And absorption cost, marginal costing doesn't write fixed overheads over here, right? Because if you write it over here, it will be again charged to product. Amount is okay, right? Okay. And here, which amount you need to write? You need to write absorbed amount. you know what is absorb, you would have learned a lot, so I'm not getting much into absorb, and we'll be having revision of that absorb at a later stage when we're doing overhead, right? We are going in a reverse order. Okay, so we got absorb, and here you get your factory cost, works cost, assuming that there are no WIP stock, so it will be getting COP over here. If WIP is there, adjust, I don't mind. So we have got factory cost, works cost, COP over here. Then add opening stock of finished goods over here and less closing stock of finished goods over here. Now stocks will be valued at cost of production, of course, and if you understand this, then I can tell you the next point about the difference between absorption and marginal costing right away. The next difference is stocks are valued at total cost, and in marginal costing, next point we can say that stocks are valued at variable cost. Absolutely clear, right? You guys would have understood with this format. And why am I teaching you this format? Because you are asked sums in 10 marks that prepare cost sheet as per absorption costing and prepare cost sheet as per marginal costing. So there, these techniques will help, right? So we got COGS, cost of goods sold, and cost of goods sold will be followed by, first of all, add fixed production overheads, not to be written over here because it has already been written over here above. Only you need to write in marginal costing and which amount should be written. So we say that you have to write actual overheads. Whatever is under over absorption, forget. In marginal costing, always write actual overheads. To that, let's just finish this sum. Just add administrative overheads in both the cases. Add selling and distribution overheads. You get cost of sales. And to cost of sales, add profit, and you will get sales. That's going to be profit, right? So if you are asked sums on prepare cost sheet as per absorption marginal costing, this technique will help you. If you are asked difference between absorption and marginal costing, we are learning, right? So we say that stocks are valued at total cost. You have already understood with the format of cost sheet, and stocks are valued at variable cost. Then next point is fixed overheads are not completely written off in the year in which it is incurred. And over here we see that fixed overheads are completely written off in the year in which it is incurred. Now I'll explain this point with two angles. First, over here I write absorbed amount. So if there is any under absorption, like actual overheads is 10 lakhs, so I would have recorded 10 lakhs in case of marginal costing over here. But if absorbed is only 9 lakh, I would have recorded 9 lakhs only over here. That is first reason why we say that fixed overheads are not completely written off in the year in which it is incurred. Second, even if there is no under over absorption, like if actually it's 10 lakh and entire 10 lakhs has been absorbed, still the entire fixed cost will not be written off in the current year, because this 10 lakhs will be included as a part of closing stock, and closing stock will go to next year, right? So in that way, the fixed cost will not be written off completely in the same year. So that's the difference between absorption, marginal costing now we had. Then main thing, the major thing that on which sums are frequently asked is called CVP analysis, cost volume profit analysis. I'll be revising you the formula very fast. In case of cost volume profit analysis, now say for example, I'll put it this way. Now if your sales 10,000 units at the rate 10, your sales is 1 lakh minus variable cost 10,000 units at the rate 5. So it will be 50,000 rupees. Sales minus variable cost, we get over here contribution. It is called contribution. Is going to be 50,000 and minus the fixed cost 20,000. So we will get profit of 30,000. Now if say for example I sell 12,000 units now, what will happen? My sales is going to be 1,20,000. My variable cost is going to be 60,000, right? 60,000 is going to be my contribution minus 20,000, and we get 40,000 as our profit. Now if someone calculates profit ratio, it is 30,000 divided by 1 lakh, 30% over here, 40,000 divided by 120, so it's around 33.33, and someone is getting confused. Okay, what is my profitability ratio? Now this profitability ratio is getting confused. At one point we are saying 30, at another point we are saying 33. It is because of one thing, that is fixed cost. Because with the change in volume, fixed cost has not changed, fixed cost has remained same. So if you want to understand the relationship between cost, volume and profit, ignore fixed cost, because fixed cost has got no relation with volume. And now if you want to calculate your profit ratio ignoring fixed cost, right, with volume, what is going to be a change in profit ratio? So you should be considering contribution. Fixed cost we have already ignored, and hence we get our first ratio in this marginal costing. First formula that we get is profit volume ratio, which is contribution divided by sales into 100. Or sometimes it is written C by S as well. So whatever you are asked in exam, it is same, C upon S, contribution by sales, right? Now, ignoring fixed cost, we've ignored fixed cost while calculating profit volume ratio, but we cannot totally ignore it. We cannot totally ignore it. We got to be considering it because it's a fixed cost. So how we consider it? We first of all find that, okay, first of all tell me how many units I need to sell so that I pay my fixed cost. I do not make losses. So typically what we are talking about is, I am talking about break-even point in terms of units. How to get break-even point unit? Break-even point means no profit, no loss. So how do we get no profit, no loss? If you earn 20,000 contribution, which is sufficient to pay your fixed cost, you will be not suffering any profit, any loss. So if you want to arrive at that condition, no profit, no loss, first of all you got to earn your fixed cost, which is 20,000, and each unit is giving you 5 rupees of contribution. That is this 10 minus 5. So it's very simple. BEP in terms of units is going to be fixed cost upon contribution per unit. That's the formula for BEP in terms of units. If someone asks you what is the BEP in terms of rupees, so you're simply going to be saying, okay, I'll calculate this over here. 20,000 divided by 5, and that's going to be 4,000 units. First 4,000 that I sold didn't give me any profit. It was just paying my fixed cost. so that I arrive at a no profit no loss condition. Now what is BEP in terms of rupees? You can say this way, BEP in terms of units multiplied by selling price per unit. So BEP in terms of units is fixed cost divided by contribution per unit and then multiplied by selling price per unit. Now let's make some changes. I'll say this way, fixed cost divided by contribution per unit divided by selling price per unit, and accordingly fixed cost divided by contribution per unit divided by selling price per unit is nothing but profit volume ratio. And if someone asks you BEP in terms of value, in terms of rupees, you got to be giving them this formula, right? So out of 10,000 units of your total sales, 4,000 units have been used to pay the fixed cost to arrive at BEP. So we can say that balance 6,000 units have given you profit. Okay, what is the contribution per unit? So it is at the rate 5. So your profit should have been ideally 30,000. Let's go back above and check. Yep, here it is, 30,000 profit. So 6,000 units have given you profit and 4,000 units have given you, 4,000 units have given you BEP, no profit no loss, and above that 6,000 units have given you profit. So these units that give me profit, that give me safety, are called margin of safety. How to get margin of safety? So if you want margin of safety in terms of units, it is going to be profit divided by contribution per unit. Very simple, right? Fixed cost was paid by BEP and profit has been earned by margin of safety. So if you want margin of safety in terms of units, it is profit divided by contribution per unit. Like over here, like what we are saying is 6,000 into 5 is profit 30,000. Now if I want this is margin of safety in terms of units. What I need to do, 30,000 divided by 5, and that's what I'm doing. 30,000 is profit divided by contribution per unit. And when you want margin of safety in terms of rupees, by same logic, contribution per unit divided by selling price unit, C by S. I'm not getting again into it. So you need to do profit divided by PV ratio. Okay, so these are the main things about marginal costing. And one last thing that we can discuss about marginal costing is, now this all thing you can do when there's a single product. Now when there's a multi-product company, when there is a multi-product company, in that case BEP in terms of units is going to be fixed cost. Now fixed cost is fixed for the company. We do not have fixed cost for the product wise, and that's the concept of marginal costing, that keep fixed cost fixed, do not divide it into production or something. So we will say fixed cost upon contribution per unit, but which contribution? So it is going to be weighted average contribution per unit, right? You got to be taking weighted average contribution per unit. Like there are two products, A and B. Contribution per unit of A and B is 2 and 5 respectively, and we are given that whenever 3 units of product A gets sold, only 1 unit of B sold. So that's the weight, 3:1. So total is going to be 3 into 2, 6, 5, total 11, over here 4. 11 divided by 4 is going to be a weighted average contribution, and that's what you need to divide with, right? And one last thing that you need to do is, sometimes you are asked the desired sales, that if you want to earn this much profit, what is the number of unit I got to sell? So please understand this, if you want to earn profit, it will only come after break-even point, right? So if you do this, profit divided by contribution per unit, this will give you margin of safety. But margin of safety will come only after BEP. BEP is must. You have to earn BEP, and then only you'll be able to earn profit. So for BEP, we say fixed cost divided by contribution per unit. So if you want the formula for desired sales, we can say over here desired profit plus fixed cost divided by contribution per unit. And same way, if you want desired sales in terms of rupees value, you can say it is going to be desired profit plus fixed cost divided by PV ratio, right? Same logic. So that sums up our very quick rapid revision of marginal costing chapter. We'll move to next chapter, chapter number 13, which is standard costing, right? Chapter number 13 is standard costing. Now, few things that we need to know about standard costing is, now as we know about standard costing is something that completes the budgeting control, right? Now, if we talk about control, the word control, or cost control. So what is the definition of cost control? We'll be revising this thing, cost control and cost reduction, again when we're coming to chapter 1 in the theory section. But as of now, cost control means to ensure actual cost adhere to standard cost, simple meaning. And right, when we say that to ensure actual cost adhere to standard cost, you need to do two things. First, you need to have an established standard cost. And that process of establishing standard cost is done by budgetary control chapter. We have established standards in budgetary control. Then you compare it with actual cost and take corrective action if you have budgets, but if you do not compare it with actual at the end of year, it will not be serving any purpose to you, right? So standard cost must be compared to actual cost, and that process of comparing standard cost and actual cost is what we call it as standard costing, is what we call it as a standard costing, right? That's the standard costing. Compare standard cost with actual cost, and if the results are not favorable, if they are adverse, take the corrective action. If they are favorable, reward the employees, and also check into the budgetary control system, right? So that process of comparing standard cost and actual cost is what we call it as a standard costing. Now, the explanation part of budget and standard costing is very, very simple. In budgetary control, I say that in this very same session, around 1 hour and 8 minutes back, if I'm not wrong, 1 hour and 8 minutes back, when I started with the budgetary control chapter, that in budgetary control chapter, I want to get answer of mainly one thing, that what is going to be my profit. And then the rest of the things follows this question. What is going to be my profit? Then sales and everything we discuss. Let's not get into it again. Now, similarly, standard costing is also based on this only. That if my profit should have been 10,000, that is what I had budgeted, but it actually happened to be only 8,000. So there is 2,000 adverse variance. 2,000 adverse. Why? Why my profit is 2,000 less? We got to know the reason of it, and then the whole standard costing follows. Like we say that, okay, so there are two reasons. Either your cost would have gone up. If profits have reduced, either your cost would have gone up, or your revenue could have gone down. Okay, if cost would have gone up, why? So there are further breakups of cost that we do. First of all, we say that, okay, either material cost would have gone up, then we say, or labor cost would have gone up, or variable cost would have gone up, or fixed overheads cost would have gone up. So these are the probable reasons because of which my profit differ from standard profit. What I had thought of is different than what I actually get. Now, and then standard costing starts about calculating each and every variance in depth. When I've taken standard costing in video sessions, if you've learned with me, I've clearly mentioned that standard costing is an investigation, it is not an inquiry. We have to investigate. If it would have been inquiry, we would have said, okay, 2000 adverse, be careful next time, God bless you all, bye-bye. No, that's not an inquiry, my friend. We want to investigate why 2000 adverse. Has cost gone up? Which cost has gone up? Material cost has gone up? Why material cost has gone up? So when we start calculating material cost variances, total material cost variance is the first one we calculate. In calculating the total material cost variance, we take a difference between what should have been the standard cost, standard material cost, and what actual material cost did we incur. Now this material cost variance further gets divided into two parts. That, okay, if it is adverse, if it is more, why? That could be two reasons. Either you would have paid more price, it should have been purchased at 10, but you actually purchased at 12. You paid more and hence your cost increase. So one reason can be material price variance. Now how to calculate material price variance? If you want the formula is going to be standard price minus actual price into actual quantity. That's how I get the price variance. Or if price is at par, not more not less, then there are bright chances that you would have used more quantity of material, and because of that my material cost went up. So second variance that I calculate, my friend, is material usage variance. Okay, how do I get material usage variance? I get material usage variance by following formula. For material usage variance, I say how much I should have used, that is standard quantity minus actual quantity and into standard price. Now I'm not getting much into the logic of why standard price. I've talked about this at great depth in the regular session. If I talk everything, then this rapid revision will get too long, but I think formula is enough for you. Standard quantity minus actual quantity into standard price. And if this variance is adverse, that can further be two reasons. If either you could have changed the mix, that is why we calculate material mix variance, that costlier material have been used more, cheaper material has been used less, you would have changed the material mix and hence your price would have gone up. So when we are checking the mix, please do not look at standard column. We are just looking at actual quantity and have you changed the mix or not, right? So first thing that I calculate in material mix variance is standard mix for actual consumption. Whatever is the actual consumption, what is the standard mix for that? And then when I have to calculate variance, this is step 1 and then step 2. The formula is going to be standard mix for actual consumption minus actual mix for actual consumption and into standard price. So if you goofed up in this mix, you used costlier material more, or to protect yourself used more of a cheaper material, you will be getting caught over here. And then the final variance that we calculate is material yield variance. So when we calculate material yield variance, we say that it is standard quantity, of course in standard mix. It is always in standard mix, but just for clarity I am writing it, minus actual quantity in standard mix. If you study standard costing with me, I have explained you that why we need to take actual quantity in standard mix. Two reasons. First, because after calculating material mix variance, you need to give effect of it, and hence we say actual quantity in standard mix. And second, if you take actual quantity in actual mix, it will be same as material usage variance. And what is the limitation of usage variance? The limitation of usage variance is if your manager has changed the mix, usage variance cannot cut that. Say for example, my manager should have used 10,000 kg, he used 12,000 kg. Now the moment you realize that he is using more than what is allowed, what he will start to do, he will start increasing cheaper quantity more, and costlier material he will reduce, and effectively he can get his variance favorable, forget about adverse. Now material usage cannot catch that, because material says okay 10,000, and what is the cost, what is standard quantity, what is actual quantity, multiplied by standard price. It doesn't change the mix. So here we calculate the mix variance, which actually considers standard mix. So any such blunder has been given effect in material mix, and now you get the actual efficiency of your manager in utilizing the material, right? And into standard price per unit, obviously. Now one thing that you need to keep in mind is standard quantity should be calculated for actual production, right? Like if your original budget was to produce 10,000 units, and you had thought of like this, for 10,000 unit 20,000 kg should have gone at the rate 2, so my amount should be 40,000. Now in actual, due to corona, due to lockdown, only 4,000 units have been produced by using 10,000 kgs and 3 at the rate 30. Now if you compare this 40,000 minus 30, oh my gosh, it's positive, my manager is awesome. No, my friend, this is the cost of 10,000 units. So you've got to prepare a revised standard for 4,000 units. Okay, so we say if 10,000 requires 20,000, 4,000 should require 8,000 at the rate 2, 16,000, and now you get, oh my god, 16,000 should have been the cost, but actually it happened to be 30,000. My manager is adverse, and let's get into price and usage and right? So these are the things that you need to keep in mind while preparing material variance. We go to next now, labor variance. So after doing material variances, next turn is of labor variances. So next variances that we want to look at is labor variances. Now what are the variances that we calculate as far as labor variance is concerned? So we calculate mainly 6 variances as far as labor is concerned. First variance is total labor cost variance. Now in case of a total labor cost variance, our fundamental formula, what we want to know is what should have been the standard labor cost, right? So we say that standard labor cost, what should have been, minus what it actually happened to be. So we say minus actual labor cost. Now if this is adverse, say for example it is adverse, then we want to investigate the reason. I told you yesterday, it's standard costing is all about investigation. So we want to investigate why our cost is on higher side. So there can be 2 reasons mainly. First, either I would have hired my employees at a higher rate, like I should have recruited them at 2 per hour, but I recruited them at 3 per hour. So because if I'm paying more, of course my cost is going to go up. Or second, I could have taken more hours. I was hiring at the right rate, 2 hours, but my workers were taking more hours. This could be 2 probable reasons. So let's get into that. First variance that we calculate is labor rate variance. Now, how do we calculate labor rate? Logically, understand that. What should I mean the rate? So we say that standard rate minus actual rate, the difference. And you have to pay this. You would have paid more or less for actual number of hours worked. So this loss of profit will occur to you for actual hours, right? So that's how we get our labor rate variance. Then the next is labor time variance, whether worker have taken more hours or not. But before we blame worker for telling them that you have taken more hours, it is not allowable. We came to know that, oh my gosh, there was 50 hours when machine got breakdown. There was power failure when workers could not work. So because of that, they have taken more time. Let's not blame them for that, right? So first, if you come to know that okay, there was power failure, there was machine breakdown, let's give effect of that, and hence next variance that we calculate is labor idle time variance. Labor idle time variance formula is really simple. It is going to be idle hours multiplied by standard rate. Why standard rate? I have already talked of in my regular sessions, and we have discussed a great, we have discussed a great concept about why we take standard rate after every, for every variance after labor rate variance. We have discussed that in class a lot. Give effect and all that. You are very much aware about it. And now, having given effect to that, having subtracted that. So if primarily I was knowing that my worker should have taken 10,000 hours, but they have taken 11,000 hours. Oh gosh, it's negative. But now I come to know that no. 500 hours is something where there was power failure, there was a machine breakdown. Let's not blame them for it, right? So next variance we will be calculating is labor efficiency variance. And the formula is going to be standard hours minus actual hours. But here you have to be careful. Here we say actual hours worked. Now how do we get actual hours worked? Actual hours minus the idle hours, that is the second variance, right? Because you already given effect of that. So that is something that you got to keep in mind. And here we get multiplied by standard rate, so you get your labor efficiency variance. Now labor efficiency variance further gets divided into two parts. Now there was one very strange thing that we noticed. Primarily we know that, okay, let's continue with that example. My worker should have taken 10,000 hours standard, but they actually took 11,000 hours. But while analyzing this, I noticed that no, out of that 1100 hours, 500 hours were something where there was machine breakdown, there's power cut and all that. So let's not blame workers from that. So we say standard rate minus actual hours work. Now, if 500 hours were, due to power cut and machine failure, still my workers are inefficient because the work that should have been done in 10,000 hours, they have been able to do in 10,500 hours, even if I subtract those 500 hours of idle time. But surprisingly, my labor efficiency variance, when I calculated it, was favorable. Despite hours taken more, my variance was favorable. I couldn't understand that. What is being cooked up over here? It has taken more hours, they are inefficient, the variance should be adverse, but here the variance is favorable. I checked my calculations twice, thrice, and then I realized, oh my gosh, he had mixed up, my manager has mixed up with the mix. Where skilled workers were required, he deployed unskilled workers. Why? So that he can reduce the cost and he can bring the labor efficiency variance favorable. So to check this, labor efficiency variance further get bifurcated into two variances. First is labor mix variance. How do we calculate labor mix variance? For calculating labor mix variance, first of all, first thing first you need to do is you need to calculate standard mix for actual hours. And which actual hours? my friends, actual hours worked. See, after idle time, just forget those idle time hours. You've given effect of that, you're debited to PNL, understand that way. You know, if you're not getting comfortable with given effect, you got to watch my videos on standard costing and everything will be so crystal clear. We have done standard costing in a manner that you cannot go wrong even if you wish, right? So after idle time, everything is going to be on a standard mix for actual hours work, and then what we see, the variance if I have to calculate, it's going to be standard hours. And of course, when I say standard, no, sorry, we will say actual hours in standard mix. That mix should have been this of unscaled scale minus actual hours in actual mix and multiplied by standard rate. See, important thing to note over here is here both the places we are taking actual hours. One is in standard mix and one is going to be in actual mix and multiplied by standard rate, so that you will exactly come to know that how much a production manager has messed up because of changing the mix. Where skill was required, you deployed unskilled. That would have affected the quality, and that is definitely something that we don't want. So one variance we calculate is labor mix variance, and second one we calculate is labor yield variance, or few people call it labor sub-efficiency variance. Efficiency was calculated third variance after idle time. So here it is going to be sub-efficiency variance. What is going to be the formula? Formula is going to be very simple. Standard hours minus actual hours into standard rate. But my friend, see if you do this much, right? You're basically asking this question only. How many hours should have been taken? Okay, 10,000. How many hours have been actually taken? Okay, 10,500. But my friend, that is, you did over here as well now. You did here also, same thing, right? If I write worked over here, you're doing the same thing. But if you do this, labor efficiency variance and yield variance will become same. And what is the limitation of a labor efficiency variance? The limitation of labor efficiency variance is, my friend, if the mix has been changed, it cannot consider that. Now, after giving effect of mix, we actually want to know whether my worker is efficient or not. If they change the mix, it is not allowed. So now what I'm going to do, I'll say standard hours minus actual hours worked in, very important, standard mix. Whatever mix has been changed, we have given effect to that. So now I got to be taking standard hours minus actual hours worked in standard mix and then multiplied by standard rate. So that's how we'll be taking care of our labor variances. Now going forward, next variance that we need to understand, my friend, is variable overheads cost variance. Let us take a third part of this, and that is going to be variable overheads cost variance. Now, okay, before I move to labor variable overheads cost variance, one note, very similar to what we did uh, in case of material, that while calculating labor cost variance, while I'm writing the note over here, while calculating labor variances, all the labor variances, standard hours should be for actual number of hours, actual number of units produced. We know that we wrote the same note yesterday also for material, and now we are doing the same thing for material for labor as well, right? That if you are given hours of 10,000 hours and you realize that my workers have taken only 3,000 hours, you feel like crazy. Okay, they should have taken 10,000 hours. Okay, after learning material variances, now it's time to go to next variance, and that is labor variances. So let's take up labor variances. Now, in case of labor variance, my main concern that is what is the change in my labor cost. So how do we calculate? What are the number of variances we calculate? In total, we'll calculate 6 variances for labor. First variance that I would like to calculate is going to be total labor cost variance. So we say over here total labor cost variance. Okay, how do we calculate it? We simply ask what should be the standard labor cost, right? So we say standard labor cost minus actual labor cost, and we get this difference. Now if this is adverse, say for example if this is adverse, we try to investigate. And previously also I told that standard costing is not about inquiries, it's about investigation. So if this variance has come adverse, we would like to investigate why this variance has been adverse. There can be 2 possible reasons because of which this variance can be adverse. First reason can be I have paid more rate, that is I would have paid at higher rate. My recruitment rate should have been 2, but I hired the workers at the rate 3, so because of that my labor cost can go higher. Or second reason can be my workers have taken more hours. I was hiring at right rate, I should have paid 2 and I am actually hiring at 2, but my workers are taking more hours than it should be. So that's why I get my adverse variance. So let's get this divided into 2 parts. First variance that we calculate is labor rate variance. So how do we calculate labor rate variance? In case of a labor rate variance, we say that at what rate you should have hired. So we say standard rate. At what rate did you actually hire? So we say standard rate minus actual rate and multiplied by actual hours. So either my workers could have taken, I would have recruited workers at a higher rate, or my workers would have taken higher time. So next variance I want to calculate is labor efficiency variance. That if my workers have taken more hours, and while I was just looking at the data, I say for example I came to know that for the production that I am actually looking at, my workers should have taken 10,000 hours, but they've actually taken 11,000 hours, and I was crazy with them. And then they told me, they stopped me. Before I calculate this efficiency variance, my workers stopped me. So please wait. I said, what happened? They said that, sir, it's okay. You can see that instead of 10,000 hours, we have taken 11,000 hours, and you are feeling us that we are inefficient. But there was a power cut, there was machine breakdown. I said, okay, you want me blamed for that? So before we calculate labor efficiency variance, we have to calculate one more variance, and that is going to be labor idle time variance. Labor idle time variance. How do we get labor idle time variance? It is very simple. It is idle hours multiplied by standard rate. Now, why do we take standard rate? We have discussed this at great depth in our regular video lectures. If you're not seen that, just go ahead and watch it, right? Enroll into Navkar Digital Institute and you will come to know that. So, the logic of taking standard rate has been greatly explained over there, so I'm not getting into it again. Now, after having subtracted the idle hours, okay, what was the first basic conclusion? That 10,000 hours should have been taken, but 11,000 hours have been actually taken. My workers have taken 1,000 hours more, they are inefficient. But now we realize that no. Out of that, 500 hours was due to machine breakdown, power failure, where they cannot be blamed. But still, they have taken 500 hours more, so without doubt. They should have taken 10,000 hours, but they have actually taken 10,500 hours. So, without doubt, they are inefficient. And hence, we calculate labor efficiency variance like this. we say how many hours should have been taken, so we say standard hours minus actual hours. Okay, which actual hours? So very carefully understand over here, we got to be taking actual hours worked. Worked means whatever the actual number of hours paid for subtracted by idle time. Like 11,000 hours are paid, but if you calculated the idle time variance 500 hours, now over here I got to be putting out 10,500. Okay, and if there are more than one type of worker, then you have to subtract both. That's the simple thing. So standard hours minus actual hours worked and multiplied by standard rate. Now when I calculated this variance, to my surprise, to my biggest surprise, this variance was favorable. This variance was favorable. Now how can this be favorable when I have taken more number of hours? I should have taken 10,000 hours, but I actually took 10,500 hours and still my variance was favorable. When I investigated this, I realized that my manager, my production manager was very sharp and shrewd. The moment he realized that he is taking more number of hours, his variance is going to be adverse, what he did was, he started deploying more of unskilled worker even where skilled workers were required. I repeat, he started deploying more of unskilled workers even where the skilled workers were required. So what will happen? Unskilled worker, the rate will be lower than skilled worker, and that's how he has brought this variance favorable. But this is not what we want, right? So we break this up into next two variances now. Now labor efficiency variance gets divided into two variances. First is labor mix variance. Now in case of labor mix variance, we want to check that what has he done with mix. See, hours should have taken more or less, that is not the concern over here. You took more hours, you took less hours, just not worry about it. Let's just try to figure out what he has done in mix. So we do not take difference in hours, and hence we take over here standard mix. First thing that we calculate is standard mix for actual hours. We are considering actual hours only, but in standard mix. And once we get there, next we will move to calculate the variances. We will see that actual hours. See, again we are not taking any difference of hours. We are taking actual hours in standard mix. So we are asking what should have been the mix and what you actually made. So we will say actual hours in standard mix minus actual hours in actual mix and multiplied by standard rate one more time. And let's get the final variance, and it is called labor yield variance, few people call it. Few people call it labor sub-efficiency variance. Now, see, when we were calculating mix, we were not just thinking about how many hours should have been taken and how many have been actually taken. We are just, what you have done with mix. But now, when we are calculating efficiency, yes, we want that. So now what I'm going to do is, to calculate variance, I'll say this way. First of all, drawing a line so that you don't mix up these two formulas. Okay, here I say that how many hours should have been taken? So we say standard hours minus actual hours, of course, worked, and multiplied by standard rate. But my friend, if you take this formula, standard hours minus actual hours worked and standard rate, you're taking the same formula over here. You're taking the same formula. So, what is the limitation of labor efficiency variance? This third variance that we have taken. What is the limitation of that? My friend, the limitation of labor efficiency variance is that if my production manager is sharp, if he is smart enough, and even if he has taken more number of hours, by changing mix, by deploying more of all skilled worker where skilled workers are required, he can bring his variance favorable. But we do not want that. We want to know the actual reason, and hence when we calculate labor yield variance, we say that standard hours minus actual hours worked in standard mix, and also whatever changes happen in mix, we already considered in mix variance, we have given effect, we have penalized him, we have punished him. So now we'll be taking actual hours in standard mix so that we can actually come to know that what is the efficiency or inefficiency of my worker, right? That's how your labor variances gets taken care of. The next thing that we want to take up, okay, before I take up next thing, one thing I would like to put a note, same as we did in case of material. The note I want to give my friends is, while calculating labor variances, while calculating labor variances, while calculating labor variances, standard hours should be considered for actual production quantity. What I'm saying is, you must be knowing, we prepare revised standard. Like say for example, if I'm telling that my worker should have taken 10,000 hours, when I checked actual, my workers have taken only 3,000 hours, and I was like, oh my gosh, my workers are awesome. 10,000 work, 10,000 hours they should have taken, they actually took only 3,000 hours. But when I checked the units, they should have produced 10,000 hours, but they've only produced 1,000 hours. So I cannot compare like this. I got to be preparing a revised standard that, okay, if they've actually prepared 1,000 hours, 1,000 units, let me check how many hours should have been taken for producing 1,000 units, and then you calculate variance, right? So your actual quantity should be considered while calculating standard hours for labor cost variance. Then, having done labor cost variances, the next variance that we look at is variable overheads cost variance. Now there are three variances that are being basically calculated under this variable overheads cost variance. First and foremost is total labor cost variance. Total variable overheads cost variance. When we calculate this total variable overheads cost variance, we usually ask this: what should have been the standard variable overheads? What should have been the cost, and how minus how much have been actually incurred? So we have actual variable overheads, right? Standard variable overheads minus actual variable overheads. Now, if this is adverse, there can be two reasons for it. Either the cost would have gone up. Now, examples of variable overheads can be power and fuel. So either power and fuel has gone costlier, which is something within not within your control, or the rate was same, but you consumed more quantity, you've taken for more number of hours. So accordingly, we break up into two parts. First breakup of variable overheads cost variance we can check out is variable overheads expenditure variance. Now when we are calculating variable overheads expenditure variance, we say that what should have been the standard rate, what has been actual rate, and my friends multiplied by actual hours, and After having given effect of this, if any rate change, we have given effect of it. Now, next thing that we calculate is variable overhead. So I write VOH, volume variance, or you can call it VOH efficiency variance. VOH volume, or we can say VOH efficiency. Now, how do we calculate this? So we say that it is standard hours minus actual hours and multiplied by standard rate. Okay, now, one thing I want to explain for variable overheads is generally you are not given the hours specifically for variable overheads, right? Then this note will help you. That this is important. While calculating variable overheads cost variances, hours or actual hours should be considered same as labor. You have to take same number of hours as you would have taken in labor, because variable overheads will ultimately depend on labor only. If labor have taken more hours, variable overheads will be consumed for more number of hours. If labor have taken less hour, variable overheads will also be required for lesser number of hours. And if we say that, there is one more confusion that I would like to clear, that for variable overheads cost variance, the actual hours should be taken from the labor. Now, as far as the actual hours are concerned in labor, we have just calculated labor variances. So even for actual hours, there are two possibilities. One is actual hours paid for, and another is actual hours worked for. Paid for and worked for. Like in the example that we are taking, 11,000 hours were paid for, but 10,500 hours have been worked for. Now, which one to be taken in case of variable overheads? And I can guarantee you, my friends, in 99% of the cases, you will not be given hours for variable overheads. You have to take it same from labor. But now there are two: actual hours paid for and actual hours worked for. So which one you will be taking? So my friend, I will be taking actual hours worked for, because the simple logic, if there are idle time, there was power failure or there was machine breakdown, then power and fuel will not be required. The simple logic is power and fuel will not be required, and accordingly you have to take this actual hours worked for, right? This was the important note for you guys. Now with this we are able to complete variable overheads cost variance. We move to the next one. The very important one is fixed overheads cost variance. Now, a few points that I want to talk about right at the beginning. First is for material, labor, and VOH variances. Unit should be same. Even the note which we wrote earlier, you have to prepare revised standard to match actual number of units. Why? Because material, labor, and VOH are, my friends, variable cost, and variable cost of product cost, hence production should be same. But my dear, for fixed overheads cost variance, for fixed overheads cost variance, time period should be same number of units. Because ultimately, my friend, fixed overheads is a period cost and not a product cost. So here what we do is we try to keep the period same and not the product same, right? That's the first thing that you want to give. So in case when you're calculating fixed overheads cost variance, if you see that in budgeted there were 5,000 units, in actual there are only 4,500 units. Do not worry. Period must be same. If ours are units are different, that's okay, right? Now, the first variance that we calculate over here is, okay, before I talk about first variance, we were just discussing few minutes back in this video itself, that there are two treatments for fixed overheads cost. One treatment is absorption costing. And one is a marginal cost. In absorption costing, we know that fixed overheads are converted into per unit cost. And in marginal costing, fixed overheads are treated as a period cost and hence kept fixed. So if there are two techniques of treating the fixed overheads, of course there are two ways in which fixed overheads cost variance can be calculated. Now let me first talk about absorption costing. Absorption costing is all about converting fixed cost into per unit cost, right? So first thing that we need to do while calculating absorption rates, while calculating fixed overheads cost variance as per absorption costing technique, is to calculate absorption rates. That's the first thing I need to do. Now, how do I calculate absorption rates? Typically, I'll prefer 5 absorption rates. There is a small trick. Which 5 rates you want to calculate? First, in my lecture I've given you, I'll just give you a quick recap over here. You say this way: 1 day, 1 day, 1 unit, 1 unit, 1 hour. How do you remember this? Day, unit, hour. Day, unit, hour. Right? And then rupees, hours, rupees, hours, and rupees. That's simple. Day, unit, hours, rupees are rupees. Now what will you do? Overheads in rupees divided by number of days. Hours divided by days. Rupees divided by unit. Hours divided by whatever is on the right side you have to take as a numerator, and whatever is on the left side of equal to take as a denominator. Simple, right? And of course, my friends, you know that you have to calculate absorption rate always from which data? Yes, from budgeted data. That is something that you know from overheads chapter, that absorption rates are always calculated with the help of budgeted data. Now let's calculate the first variance. The first one I calculate is total fixed overheads cost variance. Okay, how do I calculate this? Here there's a bit of change. So first of all, we calculate total fixed overheads cost variance. It is like this. Now here, see, understand this. It cannot be like this, that what should have been the standard fixed cost and minus actual fixed cost. No, that cannot be the variance. Like, say for example, and I'll tell you the reason as well. Now, my budgeted overheads was, say for example, 10 lakhs. Actual overheads happen to be only 9 lakhs. So if I calculate my variance like this, okay, it should have been 10 lakhs, it happened to be 9 lakh, 1 lakh favorable, I saved. No, actually I have not saved, because if I tell you that I have paid actual 9 lakhs, but minus absorbed is nil. I could not recover a single rupee of overheads because of lockdown. Now, it is not 1 lakh favorable for me, my dear, it is 9 lakhs adverse for me. Please understand that. As far as fixed overheads are concerned, incurred and recovered are different, and which is not the case in variable costs like material, labor, and variable overheads. In case of material, labor, and variable overheads, my friend, incurred and recovered are same. If you produce 10,000 units, you would have incurred for 10,000, you would have recovered for 10,000. But if you, okay, in case of material, if you produce 0 units, then incurred would have been 0 and recovered also would have been 0. In case of material, if you have not produced any unit, you would not have used any material, so incurred cost is 0, but recovered cost is as well as 0. So as far as, my friends, variable costs are concerned, incurred and recovered are always same. But as far as fixed overheads are concerned, incurred and recovered are not same, my dear. Like here, I have recovered nothing because I did not produce anything, but I have to pay 9 lakh rupees. So, first of all, the thing that you need to understand is you cannot calculate actual, total fixed overheads cost variance like this. That it should have been 10 lakhs, it happened to be 9 lakh, okay, 1 lakh favorable. No, my loss is 9 lakhs. So, for calculating total fixed overheads cost variance, I got to be taking difference of actual minus absorbed. So, here we have got actual overheads, whatever has been paid, minus absorbed overheads. How do we get absorbed overheads? It is actual level of activity multiplied by absorption rate, and accordingly this is going to be my adverse or favorable. Now let me say this example. 9 lakhs is actually paid, recovered is nil, so I got 9 lakh rupees adverse. Now what are the reasons for this? What breakup we can have for this? So we can have two breakup for this. Either if 9 lakh has been adverse, either my cost has gone up, like simply understand this. If 10 lakhs, your thought was 10,000, so you had done 100 rupees per unit. Now, now this is budgeted data, understand this. Okay, this is budgeted data. If we talk about actual data, if 10,000 units have been produced, so I would have recovered at the rate 100, so that is 10 lakhs. Actual production is also 10 lakh. And actual overheads incurred is also 10 lakhs. Then there cannot be any under over absorption, it is nil, simply. Right? Total fixed overheads cost variance is nothing but under or over absorption, my friend. Understand that? Right? So here we say that if your budgets and actual would have matched, there wouldn't have been any under or over absorption at all. So if under or over absorption has arisen because of two reasons, either your budgeted overheads has changed or your budgeted number of units have changed. Simple. So let's talk about second, that is fixed overheads expenditure variance. Fixed overheads expenditure variance. So when we talk about fixed overheads expenditure variance, we simply say that what should have been standard fixed overheads minus what is actual fixed overheads, and the difference is going to be your fixed standard fixed minus actual, that will give you a variance of expenditure. And then next we talk about fixed overheads volume variance. In case of volume variance, we say that what should have been the standard production? We say the standard output, or you can say budgeted output minus actual output multiplied by absorption rate. Right? That's how I get it. Now, if volume variance is adverse, now say for example, I should have produced 10,000 hits. I actually produced only 9,000 hits, say for example. Why? What are the reasons for it? So now we want to break volume variance. So volume variance is further divided into four parts. So if units produced are less, there could be many reasons. Like in this example, if I say that 5 units produced are 0, first reason is sir, we could not come to factory. We could not come to factory because of lockdown. So if you could not come, let's talk about fixed overheads calendar variance. In fixed overheads calendar variance, I'll ask, okay, how many days you should have come for, and how many days did you actually come for. So how will you calculate variance? We calculate it as budgeted number of days minus actual number of days. Use the difference and multiplied by absorption rate. Okay, which absorption rate you will apply per day, because you got 5 absorption rates. So if you apply per day absorption rate, you will get your variance. Now after calendar variance, we'll check capacity. Capacity means, okay, you should have come for 25 days, but you actually came for only 10 days because of lockdown. Okay, in 10 days, how many hours you should have worked for, or you should have come for? That in those 12 days, were there any restrictions that you could not work for full capacity? So let's talk about next variance, fifth variance, and that is FOH capacity variance. So over here we say that standard hours in actual days. If days are less, now let's talk about actual days. Like, okay, if you came for 10 days, tell me how many hours you should have come for. So standard hours in actual days minus actual hours in actual days. We get this, and this is hours gained or lost. If hours are more, you gain it. If it is less, you lost it. And multiplied by rate per hour, the absorption rate, right? And that's how you get your capacity variance. The next is you take up idle time variance. So let's take FOH idle time variance. Now, in case of FOH idle time variance, it is very simple. Idle hours multiplied by rate per hour. So that's how we get idle time variance. And fifth and last, reason. So why units produced are less? Either because you could not come, or you came but you came for lesser number of hours, right, due to restrictions and all that. Okay, in whatever number of hours you actually came, there was some idle time, and for the number of hours that you were working, probably you were inefficient, right? So these are the reasons when that we can figure out for your lesser production. What are the reasons? 4 reasons. If you could not come for one day, in 24 days you could come for lesser number of hours. In the lesser number of hours that you came to factory, there were machine breakdown, and when the machines were working, you were inefficient. These 4 reasons can be stated for adverse variance as far as volume variance is concerned. So now last we'll calculate FOH efficiency variance. And for that we say that standard hours for actual output. How many hours you should have taken for actual output? Minus how many hours did you actually took? So we say actual hours for actual output These are your hours lost or gain multiplied by rate per hour, and you get your variance. Now efficiency can be calculated two ways. One, for actual unit, how many hours you took and how many you should have taken, or in actual hours you worked, how many units you should have produced and how many did you actually produce, right? There are two ways of calculating efficiency. So here we have taken hours. Next thing we can do is this way. Standard output in actual hours minus actual output in actual hours. These are units gained or lost. And multiplied by rate per unit. So you get your rate. So with this, we are able to complete the fixed overheads cost variance, and not only fixed overheads cost variance, my friends, we have been able to complete the entire cost side. Like we said just few minutes back in this session, that if my profit is on the lesser side, there can be two possible reasons. Either my cost has gone up or my revenue has come down. If my cost has gone up, there can be four reasons: material, labor, VOH, FOH. All the four have been taken care now. Now we go to revenue side. And let me give you the heading: change in profit due to revenue. Now, due to revenue side, there are two possible reasons because of which your profit will affect. Either you would have reduced selling price, like you should have sold at 21, but you sold at 21. So for every unit, 1 rupee is your straight away loss. Your profit would have been affected by 1 rupee. So for that, first variance I calculate is selling price variance, sales price variance. How do I calculate sales price variance? I say that how many, what should have been the standard selling price minus what is actual selling price? Standard selling price minus actual selling price into actual sales unit, because whatever sales price has been deviated from standard, that loss or gain, if it is more, it is gain; if it is less, then it's a loss. You make an actual sales unit, right? And then either sales price would have been more or less, or the number of units could have been more or less. So if we talk about number of units, let's talk about sales volume variance. I say that standard quantity, how many should have been sold, minus actual quantity into standard profit per unit. Into standard profit per unit, so that you will come to know that how many units of profit you have already lost for, right? And now if sales volume variance is less, or if sales volume variance is favorable or adverse, it can be further divided into two more variances. One is sales mix and one is going to be your sales quantity or sales yield variance. So let's talk about third variance, that is sales mix variance. So what happens is, or you can say sales mix profit variance, because we are looking at only profit. It is also possible that manager might focus more on that product which is having higher profit per unit, and despite selling less, despite say for example, if in case of a jeweler, if manager is not able to sell, but at the end of the day he just sells one diamond, he'll be recovering for everything, because diamond will have really high profit margin, and we don't want that, right? We want customer base. So what we're going to do, we'll check the mix. As you change the mix, so as always, for material, for labor, as we have told, Same concept will apply over here, that when you're calculating the mix, you don't take the difference of quantity, that okay, this many should have been sold, this are actually sold. You take just the difference of mix. So first thing first, what I'm going to do is standard mix for actual sales. Standard mix for actual sales, we'll be calculating that, and then we'll be calculating our variances. How do we calculate variance? We calculate variances like standard mix for actual sales. And please understand that material mix, labor mix and sales mix are possible when in case of material there are more than one type of material, in case of labor mix when there is more than one type of labor, and in case of sale when there is more than one product. If there is only one material, one type of labor and one product, mixed variance cannot be calculated and yield will also not be there, right? So we have standard mix for actual sales minus actual mix for actual sales and multiplied by standard profit per unit. And the last variance that we get is, few people call it sales quantity variance, few call it sales sub volume variance, some call it sales sub volume variance, right? And few people also call it sales yield variance. That is also fine with us. Now here it's going to be very simple. We say that what should have been the standard sales minus actual sales, but as explained in earlier variances, it has to be actual sales in standard mix multiplied by standard profit per unit. So these are the variances that you need to calculate, and these are the things that you need to keep in mind while doing standard costing sum, right? So with this we are completing standard costing. We are not discussing much. Let's move to the next chapter, and the next chapter is going to be, next chapter is chapter number 12, and that is service costing, operating costing. One of the easiest chapter that we have, and it will not be taking much time as standard costing did. Now, service costing or operating costing, as it is called, is to be followed when typically an organization is engaged in providing services. Organization is engaged in providing services, right? So that is where operating costing, service costing should be used. Typically what we do in this entire chapter is prepare statement to estimate, statement to calculate operating cost. Statement to calculate operating cost. Now my friend, this is nothing but the cost sheet of service costing. Nothing but the cost sheet of service sector. So you just have to take all the total cost. So you divide total cost into two parts. One is going to be your standing charges, which are your fixed cost. Take all the standing charges, right? You have to take all the standing charges. And then second, take up running charges. So running charges are all your variable cost. Now once you get this total cost, then comes an important point, that once you get total cost, you have to divide it with number of units. And what is number of units? What is going to be the units? So units in service sector can be of two types. One can be simple units and one can be composite units. Now, what is simple unit, my friend? Simple units are there where your cost depends on only one factor. Like simple units are those units where your cost depends on only one factor. Like if you hire a cab, your meter, your the fare that you pay to taxi driver will depend on only one thing, and that is the number of kilometers. Whether you alone go or whether two people, whether three people, it doesn't matter. Right? It depends on only one factor, that is number of kilometers. So simple unit example is going to be number of kilometers. Now if you go to restaurant, your bill will depend on number of meals, right, that you order. There are no two factors. If whether you go one, two, three, it's the number of meals that you order that's going to be the matter. But now, if in case of a transport industry, say for example a passenger transport, then amount you will pay will depend on two things. One, how many kilometers you want to travel and how many persons are going to travel. If you book 2 tickets, 3 tickets, it will be different. If you book from one station to another, it will be different, right? So there are two things that depends on passenger as well as kilometers. So we multiply it and we get our composite unit as passenger kilometers. Same way in case of a goods transport company, your bill, the amount that you'll be charged depends upon what is the weight of it and how long you want to send, what distance you want to cover. So tons multiplied by kilometers, we get our next composite unit, that is ton kilometers. Now in case of a hotel, it depends on which type of room you are taking, whether you are taking simple room, deluxe room, suite room, executive room, and how many days you want to stay in that. So it depends on room days. Same way in case of hospital. It depends upon which type of bed you have taken. Whether you have taken dormitory, general ward, super deluxe room. In hospital also there are various kinds of beds available. And how many days you will remain admitted. So in case of hospital, we have got a composite unit, that is bed days. So according to industry, you have to decide the composite unit or simple unit and then accordingly divide by it. It's a very simple chapter. You just have to add it and divide by number unit. Your job is all done. Now few things about this topic is what we want to talk. Now when you have to calculate number of kilometers or number of ton kilometers, few things that you need to be aware about. If you're given that the distance from your factory to where you want to send the goods is 20 kilometers, then you got to be saying that kilometers going is 20. If your truck or whichever vehicle you are using, if it will go to destination, it will go from destination A to destination B. Definitely it has to come back. Right? So we'll say kilometers coming, that is 20. That is one thing that you need to keep in mind. That if it will come down. Many students make mistake over it. They do like this. 20 into 5 days into 25 days or something. Do not do that, okay? So do not do that. 25 into 5 into 25, right? You got to be understanding, you got to be applying your common sense. Operating costing chapter is all about applying common sense, because you must be knowing that if a vehicle will go, it has to come back to the origin, right? That is one thing that I have to tell you. Second thing, whenever you are given kilometers per trip, now trip, when you given that round trip means going plus coming. So when you're given kilometers per trip, you can start doing multiplied by number of days and all that. So that is one thing that you need to understand. And apart from that, there is nothing great in this chapter. Many questions are like this. When you have to calculate commission on takings means the selling price. So what simplest way you should do is like this. So first of all, you should arrive at total cost excluding commission, which is your statement of standing charge plus running cost. So arrive at total cost excluding commission. To that you add commission So you will get total cost. Many sums are like this. To that you add a profit and you get your total takings. Now, say for example, something like this is given to you, that driver and conductors are shared 5% commission on total takings. Takings means sales. Drivers and conductors are shared 5% commission on total taking, and organization wants 25% profit on taking. So what you simply got to do not get into any formulas and all that, just keep it simple. Take your takings as 100. Take your takings as 100. If you want 25% profit on takings, so if your takings is 100, your profit is going to be 25. And 5% commission on this, so you got to be taking 5. And just come reverse, you will get 70 over here. 100 minus 25 minus 5, so that's 70. And then simply just cross multiply. Like if this cost was 70, so you're going to say that 70,000, 5 is how much? So it's going to be 5,000. 25 is how much? So it's going to be 25,000. It's going to be 1 lakh. And then once you get total taking, simply divide it with number of units. Again, which number of units? It depends on whether you are having ton kilometers, passenger kilometer. If drivers and conductors, typically it's going to be ton passenger kilometers. Divide with passenger kilometers and you get your answer, right? So these are the few things that I had to tell you about operating costing, not spending much time on it. It's really easy chapter. We go to the next one. The next chapter that we are looking at is, next chapter that we are looking at is chapter number 11, that is your joint product byproduct. Again, I can explain joint product byproduct in just one chart. One chart will be more than enough, but let's understand this. So joint product byproduct, how it goes. First of all, what is joint product and byproduct? Now say for example, if you are putting one material, I always give this example. Say for example, you input crude, right? You input crude, then you do distillation process, and the point comes where from one crude different components start to emerge, like petrol, diesel, kerosene, naphtha, last, right? We have all studied this. This is the best example of a joint product byproduct. It's a joint product, right? So what is a joint product? Definition wise, joint products are the product which emerge from a joint process. Like crude was being processed, all this petrol, diesel, naphtha, until this point came. Now technically this point is called split off point. Technically, until this split off point comes, all the products were processed jointly, and that is why, because they were processed jointly, they are called joint products. Now what is the difference between joint product and byproduct? It is very simple. Now if business of Reliance is mainly to sell petrol and diesel, they are mainly focused on petrol and diesel. That is what really they want to sell and make money. But if in the process of getting petrol and diesel, naphtha is something that automatically emerges. You cannot avoid it. You have to take naphtha, because if you want petrol diesel, you have to take naphtha. So petrol and diesels are basically called joint products. And naphtha is what we call it as a byproduct. That's simple. Okay, that's the difference between joint product and byproduct. The product which you want to sell are called joint products, and kind of scrap which you do not want to sell are what we call it as byproduct. I hope that is understandable, right? So that is joint product byproduct. Now what is the main question that we have got? Now say for example, if cost of crude is 10 lakhs and the processing cost was 5 lakh, so we get joint cost, we call it joint cost, of 15 lakhs. Now our main focus is how to allocate this joint cost to petrol and diesel. Now ignore byproduct for 2 minutes. Let's just for the sake of understanding, understand this one. That whenever I process, I get only two products, which is petrol and diesel. Nothing like naphtha, vapta, nothing. Simple, right? Petrol and diesel, only two things are emerging. So the main question, the main thing because of which we are learning this entire chapter is how to allocate this 15 lakhs to petrol and diesel. Now there are three main methods, or rather four main methods about joint product. So let's first talk about joint products. The first method is output method, or it is also called physical value method. Now what do we do in this physical value method? Now if 500 liters of petrol and 400 liters of diesel output 500 liters and 400 liters of petrol and diesel emerged from this joint product, we charge 15 lakhs in the ratio of 5:4 or in the ratio of 5:400. That is simply the output method. But now the best method that we are discussing next is called sales value method. So if I have to write one line for this, joint costs are charged. JC stands for joint cost, right? Joint costs are charged in the ratio of output. This physical method. Then we got sales value method. Here we say joint costs are charged or apportioned in the ratio of sales value at split off point. Very simple. Like what I'm talking about is this. Say petrol and diesel. 500 liters of petrol and 400 liters of diesel are emerged. Now the selling price is just, I'm putting any number to differentiate. Selling price per liter is 100, so it's going to be 50,000, and selling price of diesel is rupees 80. So I'll be apportioning my joint cost of 50 lakhs in this ratio 50:32. That is sales value. Don't get it number and all that. Just understand the concepts, right? So when you apportion your joint cost in the ratio of 50:32, that becomes your sales value at split off point method, and undoubtedly this is best method. Now why am I saying this? Why am I putting this? Because in examination many times you are asked question on joint product, byproduct, you are given data, but more often than not questions don't tell you that which method you have to follow. Then of course we are CA student and we always love to do the best things, right? So if no specification about method is given and sales value split up point method is possible, then it is always going to be a priority to follow sales value method. But sometimes what happens is your products are not sellable at split up point. Once petrol and diesel arise, they have to process further before they are sellable. These are very raw product. They are not sellable. So now say for example, petrol processed further at the cost of 1 lakh and now the petrol becomes sellable. Diesel had to be processed further at the cost of 1 lakh and now diesel becomes sellable. Or just take the cost as 10,000 and 15,000. Right? This numbers are not important, just concepts are important. 10,000 and 15,000. Then what is to be done? See, then whatever sales value we have got, say for example, this way. Right. Again, let me prepare a table. So we have got petrol and diesel. Output that we have got is 500 and 400 liters. Selling price as we have checked is 180. So that is 50,000 and 32,000. But my friend, 50,000 and 32,000 is the selling price over here, because petrol now under the my changed condition cannot be sold over here at later point. So that is final selling price. Now you cannot charge your joint cost in this ratio, because probably while reaching at the final selling price, this cost would have helped more. This cost would have contributed more, right? So you cannot charge your cost up till this point, split of point in this ratio, where this product, now say for example, if petrol has taken 30,000 cost over here, because of this 30,000, the selling price of petrol is higher. Now what will happen if you just charge in this ratio over here, in the ratio of selling price? Petrol will take higher cost over here at split of point, because joint cost is the cost up to split of point. Now it took higher because its selling price was higher, but the logic is its selling price is higher because of this. You can do that. So ultimately what simply we are doing is, we are making it comparable. Like if you are taking cost up till this point, always remember joint cost is up to split of point. Then sales value we want at split of point. But then someone said, Amit, it is not possible. If it was possible to sell the product to split of point, we would have followed method 2, sales value method. But now my products are not sellable at split of point. How can I get sales value split of point? Simple, come reverse. Whatever is sales value over here, minus 30,000 minus 15,000, done, your job is done. That's NRV method, very, very simple. Let me do that. So if I do that, 50,000 and 32,000. So over here we have got 30,000 minus and 15,000 minus. So this is called your final sales value. This is called post separation cost, and you get NRV. This is called NRV, net realizable value. So 50 minus 30 is 20, and 32 minus 15 is called 17. And now whatever is your joint cost, 15 lakhs, 10 lakh, 1 lakh 50,000, whatever it is, I'll just take any number. You have to divide in this ratio. That is your NRV method. Right? Let's talk about third method, NRV method. How do we get NRV? So NRV is equal to final sales value minus post separation costs. All costs you got to take, whether you are given admin, S&D, every cost is subtract and reach till split of point. So that's how we get NRV. That is final sales value minus post separation cost, right? And once we get NRV, that is final sales value minus post separation cost, you got to apportion the joint cost in this particular ratio. Now for this method, we say that it is next best method and when it is to be followed. See, always we prefer to follow the best method, but when will we follow next best method? When products cannot be sold at split of point. It is when product cannot be sold at split of point. You have to process it further before you take it forward. That is the point when you have to follow this NRV method. So these are the three methods that you can follow. So now having learned 4 methods of apportioning joint cost to joint products, now it's time to talk about byproducts. So when we talk about byproducts, my friends, byproducts, as I said, is the product that emerged out of joint process, though we didn't want to sell it, right? Like I give example of, if crude distillation process is done, Reliance Industries basically wants petrol and diesel, but along with that project, along with that process, naphtha will emerge. Whether they want it or not, they cannot avoid naphtha. They have to bear with naphtha. Even if they do not want to do it, it is like a scrap for them. But now, for byproduct there are two treatments, right? Just let me talk about it. So if I say treatment of byproduct, there are two treatments basically that we do. First is it is treated as a byproduct. And second treatment that we can talk about is it is treated as joint product. Now, if the byproduct has emerged and company treats it like a byproduct, that okay, it's a scrap for us, we do not want it, we do not want to waste our time and energy into it, so what can you do? Just scrap it, right? And if you scrap it, then what will happen? Scrap value of byproduct to be deducted from joint cost. Simple. Whatever scrap value you got, just subtract the scrap value from the joint cost and balance amount just apportion to the joint product. So we say that scrap value byproduct to be deducted from joint cost and balance joint cost to be apportioned to joint products and now in which ratio, in which method we apportion joint cost to joint products? It is same as we studied. It can be output method, that is the last priority of ours. Best method if possible, sales value split up point method. If sales value split up point is not possible, then we follow NRV method. And if profit percentage is also is given, you got to follow reverse cost sheet method. And now if it is treated as a byproduct, if it is treated as a joint product, it is really simple. Apportion total joint cost to all products including byproduct by methods 1 to 4. Now, some companies, what do they think? That it's okay. Naphtha is something that always emerges. We cannot do anything with that because it's a joint process. It is not like I'm manufacturing naphtha. I want petrol and diesel, but naphtha emerges. I cannot do anything about it. So some companies think like this. Okay, if it is anyway coming, if it is anyway getting emerged, why not put some efforts and make some profit if that is possible, right? So they start marketing naphtha, that okay, we have to live with naphtha for the rest of our life, because if you want to deal in petrol and diesel, naphtha is something that we have to bear with. And when they started doing like this, right, they start treating it as a joint product, that it's okay, we'll deal with this, we'll make business out of it. And if they start treating it like a joint product, then it is not a byproduct. The moment company decides that we will be doing business into it, it becomes a joint product for the company. And if it has become joint product, just follow methods 1 to 4, sales value, output, NRV, and give it to all the products including byproduct itself. And now technically it has not remained byproduct, it has become a joint product, right? So these are the two things that you have to study. And third and last thing that you have to study in this chapter is called depth of processing. Now I'll give you a simple example of depth of processing. Now, like some products, see, understand this thing very, I want to tell you two things. I want to tell you three things. First, few products has to be sold. I want to tell you three conditions. Few products have to be sold at split of point method. They must be sold at split of point. If that is the case, they cannot process further. Compulsorily you have to sell at split of point. Then, my friends, the method that you follow for apportioning joint cost is going to be best method, and that is sales value method. Second, product cannot be sold at split of point and must be processed further. If it cannot be sold at split of point, it cannot be, even if you wish, you cannot, then compulsorily you have to follow NRV method. Just go to final sales value and subtract post separation cost so that you arrive at a split of point. So second condition is product cannot be sold at split of point. And third one that we want to talk about is, this is very important, where I'll be coming to the next topic, and that is depth of processing. As well, I want to explain you something where it will help you a lot in the sums. So third point is, product can be sold at split of point. So first you need to understand is that sales is at split of point is possible. Also, it can be sold at higher price after processing further. This is very important. So understand the difference between the three scenarios. First, in the first scenario, I said that product can be sold at split of point, and importantly, what is not written but you have to understand is there is no opportunity of processing it further available. You have to sell at split of point, no further method available. That is scenario 1. So compulsory you have to sell at split of point, no post separation, no further processing possible. Okay, second condition, second criteria is product cannot be sold at split of point. This is in fact relatively simpler to understand. Product cannot be sold at split of point and must be processed further. In that case, you have to follow NRV method. But here the third condition is product can be sold at split of point. Also, it can be sold at a higher price after processing further. Now I'm going to write something very important, so be focused on this. Follow compulsorily sales value at split of point method even if company is presently selling product after processing further. This is the crux. Presently, it might be possible that you are given in the question that company is selling it after processing further, and then there can be a question of depth of processing. Now, what is question of depth of processing? Question of depth of processing is whether should I process further or should I stop at split of point. That is simply depth of processing. But this is very important that I wanted to teach you, that even if presently you are given in the question that presently company is selling after further processing at this price, it's okay. when you are apportioning joint cost, you have to follow sales value at split of point method, because that is best method unless asked otherwise. Of course, if question is clearly telling you that follow NRV method, you have to do that. But if nothing is given, compulsorily you have to follow sales value method, because that is best method, my dear. I hope that is clear. Okay, now let's come to depth of processing. How can we decide depth of processing? So whether should I process further or not? Okay, let me give you some example. If I say that final sales value means after processing it further is 1 lakh. Sales value at split of point is 80,000, and the cost of processing further, so I'll say further processing cost is, say for example, 50,000. Should we process it further or not? The answer is no. Okay, why no? Because by processing it further, you gained 20,000 extra, right? That is what I call it as incremental revenue. By processing it further, I gain 20,000 more. But to gain this 20,000 extra, how much I had to spend? I had to spend 50,000 extra. Should we do that? Obviously, no, we should not do that, right? Because it is resulting in loss. And if it is loss, we should say that don't process further and sell at split of point. Simple. Isn't it really simple? Right? That's what we say. Now, few points that, okay, let's first clarify this. How to decide depth of processing? So depth of processing can be decided at final sales value minus sales value at split of point So if you take a difference of this, this is going to give you incremental revenue. Okay, this is going to give you incremental revenue, and from incremental revenue, if you subtract incremental cost, you'll get the result. And how to interpret this result? It's very simple. If this result is positive, right, it means there is a gain. And if there is gain, it should be processed further. If something results in gain, I would do that, because ultimately the end objective is that organization should gain. See, what is the ultimate objective with which we are learning all this? It is so that how can we suggest the ways which can optimize the profit of an organization, right? And if it is negative, it's a loss. And if it's a loss, don't process further, because if something results in loss, why should I do? Right? I should not do that. So that is depth of processing. And we are completing chapter, but before I complete this chapter, before I complete the rapid revision of this chapter, one thing I would like to assure you, I would like to tell you is very, very important. While deciding depth of processing. Joint cost is irrelevant. Joint cost is irrelevant because the joint cost that has been apportioned has been apportioned. Now the question is only whether we should process it further or not. If it results in gain by incurring further cost, do it. So only relevant cost is incremental cost, and even if you have seen this, there is nowhere mention over here of joint cost. So while calculating depth, while deciding depth of processing, joint cost is irrelevant. And what is most important, this is the important point, but if you have still not understood this, let me tell you very clearly from an exam point of view that in exam, if sum relates only to depth of processing, then no need to apportion joint cost. This is something that you must understand, that if in exam sum relates only to depth of processing, you are not asked to apportion joint cost. Yeah, more often than not, sums are like this, that part 1 says apportion joint cost, part 2 says prepare profitability statement, which is your cost sheet, and part 3 says should it be processed further. If that is the case, it's okay, you have to apportion joint cost for part 1 and 2. But if the question relates only to depth of processing, like you are only asked should it be processed further or not, like we have got one sum in Navkar module, where we are talking about 4 products A, B, C, D, and if A, B, C and D is there, we only have to decide whether something is to be processed further or not. So in that particular case, if you don't apportion joint cost, it's okay, just go on to decide depth of processing and sum is done, right? So with this, we are completing the rapid revision of this chapter, joint product, byproduct, and the next chapter that we have to do is a very, very important topic, and that is process costing. Let's do rapid revision of process costing now. So let's learn process costing, a very important topic. There are a few points that you need to understand. What are those points? Let's take one by one. First of all, process costing is to be followed when final product emerges after more than one process. Like if your product is passing through process 1, process 2, process 3, and then your final product is coming, then you have to follow process 1. Now what process costing will help you to do? Like process costing will help you to value WIP stocks. Right? Process costing will help you to value WIP stock, because at the end of process 1 might have completed, but for company perspective it is still a WIP. Like let me give you an example. If you want to become CA, chartered accountant, there are 3 processes. Process 1, clear foundation. Process 2, clear inter, and process 3, clear final. Now say for example you have completed process 1, your foundation clear, but for the final product, that is CA, you are still a WIP, right? So if you are preparing a separate account for foundation process, what all material is needed, what all labor, it will tell you what cost has so far been incurred, and based on that you can value your WIP, right? So that is one thing. Now how do we prepare process accounts? What are the things that you need to consider, right? So let me just directly go to process accounts and the procedure in which I need to prepare process account. First of all, process accounts are to be prepared in 3 columns each side: particulars, unit total or units and amount, and same way on the credit side, particulars, units and amount. Let me do that. So if I have to prepare process 1 account, as I said, it will be comprising of 3 columns each side. Over here I'm going to say units and amount, and same way on the credit side I'll have 2 columns: amount and units. So if we do this, units amount, this is the format in which we need to prepare. Now all the cost pertaining to process 1, debit on the credit, put it on the debit side, and output, put it on the credit side. Like, first of all, I'm first simply talking about simple process account where there are no opening stock, no closing stock, simple, so that you can understand it first and we can move on. So first of all, you got to start with materials. Whatever number of units are input and whatever is the cost, you put it on the debit side. After material, next should be labor. So material followed by labor, followed by overheads, and typically factory overheads. That's it. These are the main 3 costs that comes on the debit side. Now over here, first of all, you can write normal loss. What is the percentage of normal loss? Say for example, you have input 10,000 units over here and normal loss percentage is 5%. Then you got to write over here 500, and whatever is the scrap value of it, whatever is the scrap value, they got it on the credit side. Okay, then whatever is the final output that is emerged, what will you do with that final output of process 1? You will send it to process 2, right? So I will say over here, by process 2, whatever units has come into that, and based on this data you will get whether it is abnormal loss or abnormal gain. So if you don't have to worry about it, just simply do balancing. What I'm telling is, say for example, if 10,000 are input, 500 is the normal loss and 9,000 is processed by process 2, then there's a gap of 500 on the credit side. This is your abnormal loss. You lost 500. Ideally, if you have input 10,000, 500 is your normal loss, then your output should have been 9,500. But it is not 9,500, it is only 9,000. That means there is a 500 units of loss. And over here, we will write down by abnormal loss. Contrary, if having expected 500 units of normal loss, if 10,000 is the output, then you're going to get your abnormal gain at 500 units. So over here we say 2 abnormal gain, and it is going to be 500 units. So that's how typically your process account should look like if there are no stocks. Stocks are there, of course, opening stock on the debit side, closing stock on the credit side. There is nothing great that I need to explain you over there. Okay, now so over here we got the final data. Now we have to calculate cost per unit. In all the process accounts, like simple process account where there is no statement of recurring production, we have to calculate cost per unit. So how to get cost per unit? Right. We get cost per unit as total of debit side. Now of course, when you will be doing total of debit side, you will not be having this figure because this is something that you are valuing abnormal gain, right? So total of debit side except abnormal gain. If you are, I'm just removing the confusions. Okay, total of debit side minus scrap value and divide by input minus normal loss. And input minus normal loss is also called as expected output. It is also called expected output. Now there's a big logic behind this. Understand this logic and you will get the things very clear. The simple logic behind input minus normal loss or dividing it with expected output is the very simple thing about costing is normal loss should always be borne by customer and abnormal loss or gain should be borne or taken home by company. I repeat myself. Normal loss should always be borne by company and abnormal loss or gain should be borne or taken home by, I think I goofed up. Let me take away. Normal loss should always be borne by customer. And why it should not be? Understand the very simple definition of normal loss. Normal loss is the loss that you expected right from the beginning. Right? Normal loss is something that you expected right at the beginning. And if you had expected something right at the beginning, if you had expected a loss right from the beginning, isn't that fair that a businessman will charge it to customer because he knows that this is going to happen? That's the simple logic. And abnormal gain is, or abnormal loss is, the loss which you did not expect. And if you did not expect, you cannot put in the selling price. Very simple, right? Now, what is the concept behind that? What is the logic behind that? So the simple logic is, if, say for example, the total cost is 1 lakh. Now, in this case, 10,000 is the input, 500 is the normal loss, and suppose that expected output is 9,500 only. Expected output is 9,500 and actual output is also 9,500. There is no abnormal gain loss. Then I got to be dividing it with 9,500. So this entire 1 lakh cost will be borne by this. Now, my friends, what will happen if 1 lakh you divide with 10,000? What will happen to this? This 9,500 units will bear the cost because that has sold. But this scrap, they will also be charged cost. But who will bear that cost? There is no one buying those units, right? So your company will be suffering huge losses. And do you think an entrepreneur will suffer this huge loss despite of the fact that he was knowing this right at the beginning? Right at the beginning? Obviously no, he's not going to bear it, right? So we do it 1 lakh divided by 9,500, that is input minus normal loss, or we can call it expected output. Okay, other way around. Now 10,000 was input, 500 is normal loss, actual output is 9,000. Actual output is 9,000, okay, and 500 is your abnormal loss. Now what will you do? Still, cost per unit should be calculated like this only. It is going to be 1 lakh divided by 9,500, that is 10,000 minus 500, that is your normal loss. 10,000 minus 500, input minus normal loss, because abnormal loss should be borne by company. This is your mistake, this is company's mistake, this is your inefficiency, and customer cannot be charged for that. Now, what will happen if you do it divided by 9,000? Then those 9,000 customers who are good will also bear the cost of your mistake. Okay, let's take another example. Let's take a very wild example. Now, because of your machine failure or something, actual output is only 500 and 9,000 is abnormal loss. Now you will absolutely clearly understand this. If actual output is only 500 but 9,000 is the abnormal loss, and now my friend, if you divide it with actual output 500, those 500 units will go crazy because of your mistake. Now 9,000 has got spoiled because of your mistake, and those 500 units are bearing the cost, right? It should not happen. So that's how we do it. Total of debit side minus scrap value divided by input minus normal loss. Then similarly you have to do process 2, process 3. Now process 2, what? One change will happen. Process 2 will change or will start only when it receives material from process 1, right? So process 2 will start after receiving material from process 1. And then same process. Process 1, material, labor, factory overheads, normal loss process. Here it will be sent to process 3. You follow that? Cost per unit, simple, total of debit side minus scrap value divided by input minus normal loss. Input minus normal loss is expected output, and get your cost per unit, multiplied with output, multiplied with abnormal loss, and multiplied with abnormal gain. Simple. Okay. Then if you are preparing process 3 account, process 3 will start only after receiving material from process 2, and the final output of process 3 will be sent to finished goods. So we'll be seeing by finished goods account. Okay, that's how you prepare process account. You get cost per unit. The next thing we are doing is normal loss account. Let's prepare normal loss account over here. So normal loss account, it depends on whether there is abnormal loss or abnormal gain. So first combination I am taking is there is normal loss and there is abnormal loss as well. So we will see units and amount. Again units and amount. Now I am taking it in the combination of abnormal loss, because if abnormal gain is there, then there is a bit of difference in which we prepare it. So we have got normal loss account, and over here we are saying abnormal loss account. Let's do this abnormal account, abnormal loss account. We do units and amount. Units, amount, units, amount. So first of all, the scrap value that you have credited in process account by normal loss, it will get posted over here. So let me say over here to process 1 account. And if there is abnormal loss, which I am assuming right now, so I am saying that to process 1 account. Say for example 500. Okay. Now here 500, say for example scrap value is 2, so here it will be 1000, and if cost per unit by this calculation that you got is 50, then over here you would have done 50 into 50, so 2500, and I'll be bringing it over here. Oh sorry, there are 500, okay, I'm sorry, so 25,000. Okay, now what is to be done with normal loss units? Simply they have to be scrapped, and if they are scrapped, you will receive cash or bank. So you will see over here cash or bank 500 at the rate 2, that is 1000. Now so with this normal loss account gets tallied. On the debit side you say by process, to process, whichever process is charging this, and even you have to prepare normal loss account for each and every separate process. Like it will be normal loss process 1 account. If you are doing, then it will be separate normal loss process 2 account, normal loss process 3 account, so on and so forth. Okay. Even if there are abnormal loss units, you have to scrap it. So you will say over here by cash or bank 500 and at the rate 2 rupees. See, understand very simple logic, my friend. The person who is dealing in the scrap, he doesn't know whether this is abnormal loss or this is normal loss. For him it's a scrap. And understand, my friends, in this sum the only fact is 10,000 is your input, 9,000 is the output, 1,000 is scrap. That's the simplest fact about the sum. Yeah, for you as an accountant, out of this 1,000 units that actually got scrapped, if you had expected 500, it becomes your normal loss. And if 500 was beyond your expectation, it becomes your abnormal loss. Right? What you expect is your normal loss. What you didn't expect is your abnormal loss, right? And it's okay. If you had expected, you call it accountingly normal loss. If you had not expected, in accounting language, you call it abnormal loss. But the person who is dealing in scrap, for him it is simple scrap, right? So we do this by cash and bank. And now whatever loss has been suffered will be taken to costing P&L, and that's how we say that abnormal loss is borne by company. That's how it works out. Okay. Now we'll take up normal loss and abnormal gain. We'll be taking combination of normal loss and abnormal gain. So now if I have to prepare abnormal gain account, let's prepare abnormal gain account now. Again, it is going to be simple 3 to 4 liners. And it is going to be amounts and units. Now when there is abnormal gain, even there is an impact on normal loss account as well. See, understand this. This is very crucial. I'll go to process account one more time. Now I'll remove this abnormal loss because it is all done and dusted, right? And if I expect that 10,000 was the input, 500 was the normal loss that I expected, so my expected output was 9,500, based on which I have calculated my cost per unit. Now if I know that my actual output is 9,800, so there's the total of 10,300 over here, and accordingly I get 300 of abnormal gain. Now say for example cost per unit is still 500, so 30 into 50, 15,000 is something that I would have debited over here. Now this will be posted to abnormal gain account. From here we have said two abnormal gains. So in abnormal gain we will say by process 1. So we will say over here by process 1 account 300 and 15,000. Now it's a very important fact. See, you had input 10,000, you actually got 9,800, so there is a loss of 200, but you had expected 500, right? So typically if I split the normal loss, I had expected normal loss of 500, but 300 went to abnormal gain and 200 is actually resulted in loss which I had expected. So my point is, my friends, this 300 units that have emerged as a gain is nothing but the normal loss that did not occur, the loss that actually did not occur though you had expected, right? So abnormal gain units, so if abnormal gain is arisen, it is mainly, my friend, because the normal loss didn't happen, right? So this 300 units should be charged to normal loss account. So that 300 units must be transferred to normal loss account as scrap value. Your scrap value is 2, so it will be 600, right? And over here we will be saying by normal loss 300 and 600, and as you can see that ultimately 200 units are going to go into scrap, right? 200 units will go into scrap. So we will say over here by cash and bank 200 into 400, right? So that's one way to understand. Second way to understand is that if you just look at normal loss account in isolation, there are 500 units at the debit side, but we only be able to sell only 200 units as scrap. So where has 300 units gone? So we can say that 300 units have gone into abnormal gain. So by that logic also, oh my gosh, I'm sorry. I should be transferring it to abnormal gain account, right? That's how it will be working on. So if there is abnormal gain, year 2 normal loss account will also get affected. If there is abnormal loss, simply buy cash and bank and buy cash and bank. That's how we got to be doing it up, right? So that's basic about your process 1 to 3 account. Now the next thing that we want to discuss is what if there is inter-process profit sums. The next kind of sums that you're asked is inter-process profit. So inter-process profit sums are to be, okay, first, when do we charge inter-process profit? Inter-process profit sums are basically done, to motivate employees for being efficient. Now, if you transfer everything at cost, and at the end of it, right, okay, one more thing. Process accounts are always prepared at cost, unless explicitly it is a sum of inter-process profit. Now, what I mean is there is one sum in our Navkar book where in case of process A, process 1, some part of output is going to process 2, but some part is directly sold. Like, to give you example, if milk is being processed, few quantities of milk gets sold as a milk as well, and few quantities of milk goes to next process to manufacture curd, buttermilk, butter, ghee and all that. But milk as it is also, it is sold. Now if milk is sold over here, now how it will do? So those part of milk which has gone to next process, it is simply will be saying by process 2, and that is at cost obviously. But that part of milk which has been sold, please do not write selling price over here. Please only write by finished goods, or if it is directly getting sold, you can even write by costing P&L. But my friend, record cost only on the credit side, not the selling price. Just record cost. Selling price will record in P&L account and will get the profit. That is something that you need to keep in mind. Okay. Now let's talk about inter-process profit sum. First of all, how inter-process profit sums will happen. So inter-process profit sums will be happening like this. On every side, we are going to have 3 columns. Total or amount, then one column for profit, and one column is going to be for cost. Then one column is going to be for amount again, one column is going to be for profit, and one column is going to be for cost. Okay, that's how ruling will happen. So we will say cost, profit, amount, cost, profit and amount. Now how this account will be prepared? Now say for example, this is process 1 account. I am preparing as if process 1 account. I'm going to put some numbers so that you can understand better. Now I'll say 2 opening stock, 600 unit, and in process 1, 600 rupees, there cannot be any inter-process profit. Inter-process profit can be there in process 2, where process 1 would have charged something. Now process 1 is the first process where you buy material from outside, so there cannot be an inter-process profit, right? Then to material, say for example 10,000, 10,000. Then we'll say to labor 4,400, 4,400. To overheads, say for example 5,000 and 5,000. Okay. Now if you are told that the output of process 1 is transferred to process 2 at 25% profit on transfer price. Now do not get confused in transfer price and all that. Transfer price is simply the selling price for process 1, nothing else, right? So now what you're going to do is, you'll be saying like this: cost plus profit is equal to transfer price, or you can say sales price. Now you want 25% profit on transfer price. So if you assume transfer price is equal to 100, profit is going to be 25, cost is going to be 75. Now we have got the total cost, right? If we total this, and one more thing, that generally the sums which are there in this module, let me introduce one more point. If there are closing stocks in the modules, the sums that we have, as well as in the Navkar that we have got, that is one thing is there in every sum, and that is stocks are valued at prime cost. So what I'm going to do is I'll be totaling this prime cost over here. So it will be 10,000 plus 4,400 plus 600 is going to be 15,000, my friend. And over here also we got 15,000 minus closing stock. Instead of writing closing stock on the credit side, I would prefer to write it right over here because of some reason. Now say for example there is 1,000 of closing stock, and of course in closing stock of process 1 there cannot be any inter-process profit. So we have got 14,000 and 14,000, and now let us say two overheads, 6,000 and 6,000. Okay, now cost we have got 6,000. Let's get the selling price. 6,000 is 75. 100 is how much? So if I do this, I get 8,000. Oh my gosh, sorry. Cost is 20,000, right? 14 plus 6, 20,000 is going to be the cost. So if 20,000 is cost, what is going to be the selling price? I say 20,000 divided by 0.75, and I'm getting 26,667. That is going to be the selling price. Okay, which I'll transfer over here. So I'll say by process 2, 26,667. Cost is obviously 20,000. So 6,667 is going to be the profit, and over here also we will say to net profit. 6,667. So we'll get our process account tallied on both sides. So it is going to be 20,000 over here, 6,667 over here, and 26,667 over here, and that's how it is done. Now I'll be taking last thing, that is process 2 account, because I got to explain you a few points and then we'll be moving on. So now let's talk about process 2 account. Few confusions that students have, and I would like to remove it. Oh my gosh. This is going to be very, very important. Few confusions that you might be having, I'll be removing it right over here, and that's why I'm putting some number rather than talking about things here and there. I thought that if I put some numbers, it will be better for you guys to understand. So we have over here so again 3 columns: cost, profit and amount. We have got cost, profit, amount, cost, profit and amount. Now very, 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 very important point. Now the question gives you like this. Question is like this. I'm talking about process 2. Opening stock 2600 and inter-process profit, say for example 600. If this is the way question is given, question is giving you column now, process 1, 2, 3. but I'm basically focusing on process 2 where I want to explain every concept. Once it is done, process 3 is automatically understood. So now my friend, if question is telling you like this, opening stock is 2600 and inter-process profit is 600. Okay, inter-process profit 600 is to be written over here. The question is, where should 2600 be recorded? Then the answer is over here, and the cost is going to be 2000. Let me just simplify it for you guys. The simplest thing, my dear, I can tell you is process manager will be having access of only this amount column. This, if you understand this, everything is going to be clear to you. The process manager, whatever answers he gives you, he'll be giving only in regard to amount column. And my dear, what I'm highlighting with yellow, cost and profit column, he will not be even able to see. It is only management that will be able to see that. Yellow highlighted are not visible to process manager. So if that is understood, whatever question gives you as far as process 2, you have to write in amount column. Whatever you have to see, you have to see from amount column. Let me clear this thing. Okay, sure, I'll write further and probably then I'll come to more about this. So now process 2 will start once it has received material from process 1. So it is 20,000, 6667 and 26,667. Then materials, say for example 5,000 and 5,000. Labor 4,000 and 4,000. Now the manager of process 2 tells you that closing stock he is having is 3667. Or let me confuse you. Manager is saying you, manager of process 2, that cost of closing stock lying in process 2 is 3667. Rapid. Cost of closing stock lying in process 2 is 3667. That is the manager of process 2 is telling you. Now, where will you record closing stock? First of all, meanwhile you think it, I'll just make the total of this. So 20 plus 2, 22, 27 and 31,000 over here. Then 6667 plus 600 will give me 7267 and plus 31,000. So we have got over here 38,267. Super cool. Tell me, my dear, if manager B is saying you that he is having the stock of 3667 in his account, in his process, where will you be writing it? Then answer is over here, 3667. Someone might shout, sure, it is cost. Arey my friend, the cost of process 2 is written in amount column only. If you are getting any doubts, let me simplify it. Let me go back to process 1 again. Cost goods worth 20,000 was sent at 6667 profit and 26,667 was charged to process 2. Now tell me, what is the cost for process 2? If I am process 1, I have sold goods worth 26,667 to you. What is your cost? Your cost is 26,667, my friend. So it is possible you might see 26,667 over here in amount column, but for process B manager it is the cost. Please understand, that is the cost for process B. For company it can be something different, but for process B 26,667 is nothing but cost. I hope you understand. And hence, I'm again saying, my friends, manager of process B will not be able to see the columns highlighted with yellow. He will be, and if you understand Excel language, MS Excel, cost and profit column will be hidden. He cannot unhide this. He will only be, and this is literal fact. How much profit process 1 has charged, process 2 manager will never be aware about. He will know only one thing. Okay, I have to pay 26667, that is my cost. And accordingly, when he says that 3667 is my cost, it is his cost. For company, it will be calculating differently. Now, what would have been the profit included in it? Simply cross multiply. That if 38267 is the total, 38267 over here, 7267 is the profit, 3667, then how much? So 3667 into 7267, 3667 into 7267 divided by 38267. So the profit amount included over here is 697, and the cost is going to be 3667 minus 697, 2970. This is the first important point that I wanted to tell you. Okay, now we add over here 31,000 plus 2970, so it gives me 33,970. Oh sorry, I need to subtract, I'm really sorry, because it's the closing stock. I'll say over here minus closing stock, then 31,000 minus 2970 gives me 28030. 7267 minus 697 gives me 6570, and 38267 minus 3667 is going to be 34,600. To that you add factory overheads. Say for example we keep it 6400, so 6400 over here, 6400 over here, and it's going to be 28030 plus 6400, so that gave me 34,430, and 34,600 plus 6400, that will give you 41,000. Now, very important point. Now the last very important point about this session is, if you're given the question that output of process 2 is transferred to process 3 or transferred to finished goods at 20% profit and transfer price. So if you have to calculate 20% profit and transfer price, it's going to go like this. We will say cost plus profit and transfer price. Okay, cost plus profit is equal to transfer price. You want 20% profit and transfer price, so it's going to be 100, 20 and 80. Now what is going to be the cost? Tell me. This is the most confusing part. If product B's manager tells you that, process B's manager, that I charge 20% profit on transfer price, so we got to be doing like this. Transfer price is 100, profit is going to be 20 and cost is going to be 80. So tell me, what is the cost? And the moment you say 34430, this, it is wrong. My friend, for process B's manager, cost is 41,000. To explain this point, I have put all the numbers along the way. Otherwise, it is a rapid revision. I know putting number takes a bit of time, but if this can give you 10 marks in exam, this video is worth. If only this point can give you 10 marks, if this kind of question comes into exam and it gives you 10 marks, it is worth all the efforts that we have put in preparing this video, circulating it, and if you put your time and efforts in watching it, it is worth. Please understand, my friend, for process B manager, cost is 41,000 because this cost is only for company, my dear. I told you, see, 26,667 is transfer price for department A, but for process B it is cost, and every cost of process B is over here. So 41,000 is something that you have to understand. And then 41,000 divided by 0.8, so that will give you transfer price of 51,250. So now we're going to be doing like this. We'll say buy finished goods. Over here we'll be saying 51,250. over here, of course, cost column will remain as it is, 34,430, and you got to take total profit. Now this column will be showing accumulated profit of process 1 as well as process 2. So 51,250 minus 34,430 gives you 16,820, and if you transfer over here, see, you need this way, 51,250, 34,430, the balancing figure is 16,820, and let's do this, 51,250 minus 41,000, over here you are getting 10,250 as a balancing figure, and 16,820, I'm balancing profit column now, minus 6,570, again it gives you 10,250, and over here also you will get 10,250. So this is ultimate proof. If entire sum is right, this amount that you calculated, it should be obtained over at this 2 column. If this is right, you are right, nothing to worry about, right? So this was inter-process profit sum. Now let's move to the next point, and that is statement of equivalent production. Very, very important over here, and you need to understand the impact of normal loss, abnormal gain while preparing statement of equivalent production. Let's understand that now. Now NRV is the next best method. Best method is a sales value method that we follow, but NRV is the next best method. Now if given a choice, we have a choice to follow best method, obviously we would love to follow best method, but if not possible, right, like, you know, when we'll have to follow NRV method, so we'll simply say that where product cannot be sold, when products cannot be sold at split off point. If product is not sellable at split off point, you have to process this further to make it sellable. Compulsorily you have to, you know, follow the NRV method, which is the next best method. Now the fourth method that is typically not a specific method, but few authors say it, and it is reverse cost sheet method. Now before I tell you the reverse cost sheet method, I got to first show you how cost sheet is prepared in this particular chapter. Now you might say, sir, what is there to teach in cost sheet? It's already we know. Yeah, my friend, already know, but let me just tell you something else. Now say for example, if this company is is preparing its cost sheet for petrol and diesel, right? Then what is the general format of cost sheet? General format of cost sheet is going to be direct material, then we have direct labor, then we have direct expense, right? Then we have prime cost. Total is prime cost. Prime cost should be followed by factory overheads. Now, my friends, very important thing over here. The logical question is, can you get direct material, direct labor, direct expense, FOH separately for petrol and diesel? No, because there were no separate materials put in petrol and diesel. There was one material that was put in, that was crude, one labor was working, one overheads were put on, and then at a split of point we got petrol as well as diesel. So my friend, that's the logic that you need to understand, that petrol, diesel, direct material, direct labor, you cannot get it differently. What you need to do then? So if you want to prepare the cost sheet format of joint product byproduct chapter, then as I explained, you cannot have direct material, direct labor, direct expense, factory overhead separately, and accordingly you got to start with joint cost apportion. You got to start with joint cost apportion. Now, how do you apportion joint cost? It can be either by output method or by sales value method or by NRV method, whatever you apportion. To that, we add post separation cost. So here we have got post separation cost. So this is straight away, my friends, we will be getting cost of production. You get cost of production, and then after cost of production, the normal routine format will arise. So after cost of production, we will say add opening stock of finished goods less closing stock of finished goods. So that will give you COGS. If stocks are there, that will give you COGS. If stocks are not there, that's great. To the COGS, you add the rest of the two expenses. One is going to be your administrative overheads, and another one is going to be your selling and distribution overheads. So we have admin overheads and selling and distribution overheads, and hence we get cost of sales. Cost of sales, add profit and sales, right? Simple. That's right. Now, when we follow reverse quotient method, generally, you'll be able to easily understand what is the sum of reverse quotient method. Generally, one hint that I can give you is when you're given the profit percentage, you can usually follow reverse quotient method. So how you'll be given? You'll be given sales value, so start with sales value, subtract profit because we're going reverse, right? And that is why it is called reverse quotient method. Subtract profit, you will get total cost. Just go in the reverse order. Minus, you say admin, minus S&D. If stocks are there, adjust stocks. If not there, then this will give you cost of production. If stocks are not there, definitely adjust. I just want to get rid of concept very fast. Then you say minus post separation cost. And now you will get your answer that it is joint cost apportion. It is joint cost apportion, right? That's how you get your joint cost apportion by reverse quotient method. Now, one thing that I want to tell you, be very, very careful is when the sales value is given, be very careful. This is something we have done one sum from a book as well. That is something like C15 and M16. You are given that sales value is 72,000, 7,200 and 8,000, something like that. Now, be very, very careful, my friend. This is something where students go wrong, and that's why I want to bring it to specific to your knowledge about it, right? So 7,200 and 800 sales value is given. So someone might think, oh my gosh, sir, sales value method, sales value given ready, let me apportion in this. No, because if there are stocks, let me tell you, in this sum, if I'm remembering the data properly, produced quantity was 100 and sold was 90. Forget that sum, I'm just simply explaining everything, right? And over here it was 150 and 120, something like that. Okay. Now they have given sales value, final sales value. My friend, it is of sold quantity. Please understand that. And you have to apportion joint cost to produced quantity and not to sold quantity. So if in any sum you are given sales value directly, like sales value for C15 is 7,200 and for M16 is 8,000, please do not apportion joint cost directly straight away in this ratio. You will get messed up. You got to get sales value for produced quantity, my dear, sales value for produced quantity. is what we want, not the sales value of sales quantity. We do not want that. Okay. So now moving on, how to get it? So 7200 divided by 90, I'll get my selling price. So let me just show you how it actually goes. So I'll say calculation of selling price per unit. In case of C15, it will be 7200 divided by 90. So 7200 divided by 90 gives me 80 rupees. In case of M16, it will be 8000 divided by 120 because 120 units are sold. And accordingly, 8000 divided by 120 gives me 66.67. Now what we need to do? Again, we need to prepare a table for finding the sales value. So we said product, quantity, selling price and sales value. This is a very important point that I wanted to tell you. So there are two products, C15 and M16. Quantity, take up produced quantity, it is 100 and 150. Selling price, we've got 80 and 66.6667. And then it will be 8000 plus 150 into 66.6667 will give you 10,000. And my friends, you have to apportion your joint cost in this ratio, sales ratio. So now let's try to understand when statement of equivalent production needs to be prepared. So the next point that we are trying to learn is statement of equivalent production. Now, over here, when statement of equivalent production needs to be prepared, the first question is, then the answer is statement of equivalent production needs to be prepared when the process is incomplete. I repeat, when, see, if your process is complete, still the product is WIP as I said earlier. But when your process itself is incomplete, like you are in intermediate, your intermediate is incomplete. If the process itself is incomplete, that is intermediate, I need to ask you percentage. That, okay, what is the stage of completion? You might say, okay sir, our syllabus is 80% complete, my syllabus is 90% complete, so on and so forth. So, when the process is incomplete, in that case you have to prepare statement of equivalent production. Now, statement of equivalent production, one simple hint for examination is whenever you see percentages in the sum of process costing, it is a hint that you have to prepare statement of equivalent production. Now, what is the statement of equivalent production? Very quick way. See, we are not doing anything new in this statement. Absolutely anything new we are not doing. Like what we are doing till now. So what we used to do up till now? We were preparing process accounts. So let me draw the process account very, very quickly. So let us say process account. In that process account, we used to have three columns each side: particulars, unit amount, particulars, unit amount. Okay. So we have got over here particulars, amount, unit. Again, particulars, amount and unit. So I'll be basically focusing on unit column because that is where I need to explain you something. So units and amount. Now let's begin. Let's say there are some opening stocks as well. So if I start from this, I'll say 2 opening stock. Let us say 500 units. 2 input to material that has been input in the current process is 9,500. Then we have labor, but that will affect only amount column, not the unit column, and same way over here, right? Over here, if I write by normal loss, and let me say it is 300 by process 2. Let us say it is 9,000. We say over here by closing stock. Let us say 400. So we will get over here by abnormal loss 300, I think. Yeah. So my abnormal loss is going to be 300. Now if that is going to be the way in which you prepare process account, which we normally do, then what we do then, after putting all the amount and all that, we have to put the calculation of cost per unit. So let us calculate cost per unit now. We explained the formula just a few minutes back. So cost per unit is going to be total of debit side minus scrap value divided by input minus normal loss. Right? That is what we do. Now, total of debit side minus scrap value, that's okay, we will get that. Total input is 10,000. As you can see, it is 500 opening stock plus 9,500 put in, and minus normal loss. So let us say we got cost per unit to be 50 per unit. So multiply 50 with here, we'll multiply 50 over here, and multiply 50 over here. Now that is something easily used to do. You have done in case you're calculating cost per unit like this and you're preparing process account like this. Now the only question that I have got is, my friends, this closing stock units are WIP, not finished goods. Okay, let me just clarify this. When I say WIP, it was always WIP since I started process costing. But earlier, see, when this kind of sum should be done, understand this. This is very important, right? When you do sums like the cost per unit, total of debit side, you get cost per unit and move forward. So I'll be putting like this for company and for process. Normal sum and statement of equivalent production. Okay. Now, this is important to understand. When a unit is complete in process, it will be WIP for company, as I talked about. If your foundation is complete, your process is complete. If your inter is complete, your process 2 is complete. But your main product CA is still in WIP. If someone asks you, have you become chartered accountant? You will say it's WIP, right? That way. But the process is complete. Then we do normal sum, because ultimately we are calculating the cost of process. And if the process is complete, you can simply do cost per unit, total of debit side minus scrap value divided by input minus normal loss, and boom, you get. Now, when statement of equivalent production is to be prepared, of course, that unit will be WIP for company. And this entire process costing, whenever we talk, more often than not, 99.98%, the product is WIP for company. But now, if we say that it is WIP for process itself, that is where percentages are given. You have to follow statement of equivalent production method. I hope that is understandable, right? So what I am talking now is, if this closing stock is WIP for process, means these are incomplete units. If someone says that this closing stock is 100% complete as far as material is concerned and 60% complete as far as labor and overheads is concerned, so percentage is given, it's an indication that it's a sum of statement of equivalent production. Also, you need to understand this, my friend, that if you do it this way, as you can see on the screen, normal sum, right? Normal sum, 50 per unit you got, you multiply it with 50, multiply it with 50, multiply it with 50. Now, This is illogical. Why this is illogical? Because 9,000 units are complete. Still you multiplied it with 50. Those 9,000 units which are complete have taken 100% of material and 100% of labor and 100% of overhead. That's where they have become complete. But these closing stock units are incomplete. They have only taken 60% as far as labor and overheads, so you cannot give them 50 full cost. That is simple, right? But I have to calculate cost per unit. Now the issue is, sir, I cannot do this 10,000 minus 300. Why? Because those 9,700 units which we are talking about are not complete. Some units are incomplete, some are incomplete. So what do I need to do? To get this cost per unit, please remember that ultimately my objective is to get this only cost per unit. So to get cost per unit, I have to convert incomplete units into complete units. And then I can do this input minus normal cost. Very simple. Right? I got to convert incomplete units into complete units. Then only I can get cost per unit. Because the simple formula for cost per unit is going to be total cost divided by cost per unit. Cost per unit is going to be total cost divided by number of units, and those number of units must be complete units. If they are incomplete, like we have over here closing stock, then what we do? We convert it into equivalent complete units. Means we say that, okay, 400 units are 60% complete. It is as good as 240 units, 100% complete. So now what I can do is, I can do this 9,000 which are complete, 300, and over here I'll take 240. So I'll be dividing my cost per unit with that. That's it. This is the simplest cost statement of equivalent production for you. Simplest statement of equivalent production for you, right? So I'll be showing that very quickly now. Statement of equivalent production. So first of all, statement of equivalent production. I will show you all three methods and then we'll end this chapter. So we have one column for labor and overheads. We have one column for material. We have one column for total. Then percentage in units. Percentage in units. So we will say particulars, total, material, percentage in units, labor and overheads, percentage in units. Again, what I am trying to do, I am just trying to find this cost per unit. And for that, wherever incomplete units are there, I will be completing into a complete, and I will be converting it into a complete unit. Okay. Now, this is the closing stock percentage I have assumed. And for opening stock, I am assuming that the stages of completion are material 100%, labor and overheads. Okay, let's keep it 60% so that you can understand the difference between these two. Now, statement of equivalent production depends on the method you follow. Now, I am assuming that first of all I am following FIFO method. Okay, first of all I am following FIFO method. So in FIFO method, what will happen? These opening stock units which were there will get completed and transferred to next process first, right? So we'll assume the breakup like this: that this 9,000 consists of 500 units of opening stock and 8,500 units of current input. Now, always keep in mind, this is the simplest thing I can tell you, my friends. If it was a normal sum, there was no incomplete procedures, something, then the denominator would have been 9,700. Yeah. Input is 500 plus 9500 minus 300. So 9007 would have 100 would have been the denominator. Now I'll tell you something. Okay, so if 9700 is what you're going to get, so ultimately it's all about 9700, but because they're incomplete units, we're going to be dividing by this. So we've assumed that 500 units of opening stock have been processed first. Now, if you do like this, 9700, this is 10,000 minus 300. You get 9700. Now, I cannot do this 10,000 minus 300 because there are some incomplete units also, and I got to consider the stage of completion. So, other way, alternate way of getting 9700 is this: 9000 plus 300 plus 400. That's simple. You can always get that way, right? And in statement of equivalent production, we follow this process: 9000 plus 300 plus 400. And why do we do that? Because there are some incomplete unit and I got to consider the stage of completion for that. Okay, so let's first consider 9000, and I'll be saying for them they are units completed. It has two parts. First of all, opening stock, processed further, and there are 500 such units. Now, there are 100% complete, so 100% material on these units were put in last year. So how much cost I need to incur current year? Current year, it is nil. See, I am finding the cost per unit in the current year, right? So if last year every material was input, current year I would not have incurred any expense on material. And labor and overhead 60% complete last year, so I would have had to put 40% material. Now 500 units, and if I incur cost to the tune of 40%, it is as good as 200 units complete. That is statement of equivalent production. So whenever I am calculating cost per unit for labor and overheads, I cannot divide with 500, but definitely I can divide with 200, and that is what my objective is, right? So we say opening stock, process further. Then units started and completed. How many such units are there? It is 8500. And of course, if it has been started in current year, completed in current year, 100% would have been put over here. So we say 100% and 100%. So 8500, 8500. Now, let's talk about this abnormal loss. And I'm interested in not giving any percentage about abnormal loss. Now, abnormal loss, if you are given the percentage that units scrapped are 100% for material, 80% for labor and overheads, it's good. Take those percentage. But my friend, if nothing is given as far as abnormal loss is concerned, then you have to take 100 and 100 if nothing is given. So let's say over here 300 and 300. And then last we take a closing stock. There are 400 units in closing stock which are 100% complete in material. Now closing stock is something that you started in current year, and if they are 100% complete, means 400 would have been put over here, and 60% stands for 240. That's it. Total now. And we are ready with statement of equivalent production. Okay. So here I will say 8500 plus 300. Okay. First thing first. If I just total this total column, it is going to be 500 plus 8500 plus 300 plus 400. This is 9700, and whenever you want to check whether your sum is right or not, whether you are on the right track or not, just check this. Input minus normal loss was 9700, and this total should become 9700. If that's tallying, everything is right. Don't worry about it, right? So then we have 8500 plus 300 plus 400, and that gives me 9200. Then we have got 200 plus 8500 plus 300 plus 240, and that gives me 9240. Simple. Then whatever is the material cost, divide with 9200. Whatever is the cost of labor and overheads, divide with 9240, and you will be ready. And then once you get cost per unit, what we used to do over here, once we get cost per unit, we multiply it with units. Similarly, you multiply it with units. And while multiplying, I'm not getting much into it. You just have to follow this table. Like units completed, so first write down units completed. Over here, 200 equivalent units, so say 200 into labor and overheads cost, then 8500 into cost, and then cost incurred last year should be added. Then abnormal loss 300 into total, closing stock. If you want to volume carry closing stock, say 400 into material cost and 240 into labor cost. That's it, done and dusted, right? Your personal account will tally. Now, if you're following this same sum with LIFO method, then what will happen? If you're following LIFO method, my friend, then your the opening stock unit will be there in closing stock as well. So the units last came in, that is 9500 when we first going out of the process, so that is there, and then we are left with 500 units. So 300 will go to abnormal loss, and then we are left with 200. So effectively closing stock will be remaining out of opening stock, right? So you can say this way, units completed, entire thing is units started and completed in the current year itself, because last year units were there, we are not touching it at all. Amount is, and there are going to be 9,000 such units. Whatever has been completed is there. Okay. So 9,000, 100% and 100%. Then abnormal loss is there, and closing stock. Now this is important. Opening stock was 160% complete, and closing stock stage of completion is still the same, and we are assuming that closing stock is out of opening stock, so actually no work has been done. So just ignore it, because no work has been done. It was 100% complete last year, it is still there. Labor and overheads, it was 60% complete last year, still it is 60% complete in current year, and hence we have done nothing. So that's how we do LIFO method. And when you are following weighted average method, my friends, in case of weighted average method, you just total up everything. You forget about last year, current year. You simply say this way, okay, units completed 9,000. Even you don't have this kind of breakup out here. So when you say units completed, it is going to be 9,000. 100%, 9,000, 100%, 9,000. Then abnormal loss, then closing stock. It is 100%, so 400, 60%, so 240, and then we have a total, right? So the total is going to be 9,700 and 9,540, right? That's how you get it. And when you calculate cost per unit, see over here, average means what? Average means club. There is no opening stock, there is no closing stock. There is no breakup like, okay, these units are from last year, these units are from current year. There is no breakup like this. It is simple, units completed. So when you club the units of last year, previous year, everything, so my friends, similarly you have to club the units as well. You have to club the units as well. I mean, you have to club the cost as well. So what will you do? Whatever is the material component in opening stock, say for example 5, plus material cost incurred current year, which you might have recorded here, you have to add. Similarly, labor and overheads component of last year opening stock plus current year you have to do, and then you'll be able to do the weighted average sum, right? And I'll be telling two final things about this chapter, and then we'll move to the next chapter. Weighted average method, when it is to be followed, this will help you a lot. Okay. So first, when it can be followed, let's first answer that. When it can be followed. It can be followed if and only if breakup of opening stock is given. Breakup of opening stock is given means you like if opening stock value is 8,000, that's it. You cannot follow this because just now I said that you need material component of opening stock and you labor and overheads component of opening stock. So if only 8,000 is given, you cannot follow it. Yeah, if you are given like this, 4,000 material, 2,000 labor, 2,000 overheads, then you can follow it, right? So then you can put over here 4,000, 2,000 plus 2,000. So if breakup of opening stock is given, then and then only it can be followed. And next is when it has to be followed. It has to be followed when stage of completion for opening stock is not given. Like if stage of completion of opening stock is not given, like when you are doing FIFO method, we say that unit opening stock process further. Last year it was 100%, so no. Last year it was 60%, so current year it was 40. Now, what if this percentages are not given? Opening stock percentages are not given. Then you have to club the method because you cannot get those percentage, you cannot get those equivalent units of opening stock. Then you have to club it and then only you can get it. So it is when it has to be followed, right? So there's many things you need to keep in mind as far as process costing is concerned. I hope it would have clarified majority of your things. Now it's time to move on to the next topic. See, this chapter is of great depth. We have to keep in mind that this is a rapid revision and I want to complete in certain time. I cannot take more than 7-8 hours because if I have to give a fair weightage, 15 chapters if I complete half an hour on an average, then I have to be completing this around 7.5 and 8 hours, and I cannot take hours and hours in this chapter. Then you can always watch this video. So I am trying my level best to cover main important topics of everything. Now let's go to the next topic, next chapter, and the next chapter is the next chapter that we are going to discuss is job costing and contract costing. Now it has become very, very simple, nothing to tell. Earlier in old syllabus, it was a bit difficult. Now, where contract costing is to be followed? So, contract costing is to be followed generally by the person who is engaged in the activity of construction activity, right? Now, what he needs to do? He simply needs to prepare a separate contract account for each separate contract that he undertakes. Like if he is undertaking contract 1, contract 2, contract 3, let's have a separate contract account for each of them. So what we're going to do is we'll be simply preparing contract account. Like say for example, if I prepare contract 1 account, so contract 1 account, it's really simple, really simple. You got to simply do nothing. Whatever expenses are pertaining to this contract, put it on the debit side. If it has been material issued to site, put on the debit side. Material issued from stores, put it on the debit side. See, from wherever material comes, if it is relating to this contract, if it has been used to this contract, put it on the debit side, right? So we'll be saying over here to material. It can be from stores, from other side, purchased directly, whatever. If this material is used in this contract, simply put it on the debit side. Okay. Then we've got labor, then we've got overheads, whatever contract, like there are subcontract costs, whatever cost has been incurred for this, put it over here. Then over here we put by WIP. Now WIP consists of two things, work certified and work uncertified. So what is work certified? Now, see, bigger issue with these contracts are, why contract costing was developed. Of course, the way we are solving it, it is not making much of a sense. Earlier, it was making a lot of sense when we were in old syllabus. But anyway, see, the bigger issue with people in construction industry is they're one unit. Now, this is nothing but one unit for them. One contract is one unit for them. Right? Their one unit takes a lot of time to get produced. It can take 2 hours, it can take 2 years, 3 years or something. Now, until and unless the units are complete, they cannot sell it. And unless and until they cannot sell it, they will not be getting any profit. Right? So, what used to happen earlier was, say for example, if you do not recognize your, of course you cannot recognize sales because the products itself are incomplete, right? So if the products takes 2 years, 3 years to get completed, and if they do not record anything, then what will happen is, for first 2-3 years when the products are going on, there will be losses because cost incurred, no sales, losses. And third, fourth year, when the product is complete, when the contract is complete, you will be showing huge profits. So there were fluctuations in profit, and to eliminate those fluctuations in profit, we started recording WIP stock in contract costing. Now WIP consists of 2 things. One is work uncertified, and one is work uncertified. What is work certified? Work certified is work which is completed and certified by architect. So you call up the architect and say, okay, I have completed this much, just give me a certificate. If you give certificate that, okay, out of the 6 floors that you're constructing, 3 floors are completed and the value of this is this, that is called work certified. And one important thing that you need to notice over here is work certified is recorded at contract price. Work certified is always recorded at contract price. And okay, you might be feeling this as wrong. Like, sir, it is stock. How can we record it contract price? But my friend, if we recorded cost, then every year profit will be 0 and last year there will be substantial profit. So problems will continue. Right? So work certified is to show some profit, work certified, the completed part we recorded contract price, so to that extent we can show the profit. And work uncertified is the work which is not yet certified by architect. So it is work which is not yet certified by architect, and work uncertified is recorded at cost, right? Work uncertified is recorded at cost. Now, when I say that work uncertified is always recorded at cost, let me tell a few things. In few sums, the typical type of sum that is generally being asked is, sometimes we are asked like this. Contractor, this is the typical type of question that we more often than not get, has completed two-third contract and architect certificate has been obtained covering 50% of contract price. I'm definitely sure you would have also come across this kind of sums when you do the other chapter. So in this case, typically they are asking you to calculate the work uncertified, right? So it is going to be like this: if total work completed is two-third of the total contract. One half of total contract has been certified. So remaining 1 by 6, how did I get 1 by 6? It is 2 by 3 minus 1 by 2. So I get 1 by 6. So that's how I get 1 by 6. Now what you need to simply do is, please understand, if work certified is 10 lakhs, you shouldn't do this mistake. Okay, 1 certified, 1/10 is 10 lakh, 1/6 is how much? No, my friend, you cannot do that, because work certified is at contract price, my friend, and this is something that you do record at cost. So never do that, please. Okay, now what you need to do? You need to get the cost of this, cost of work completed. Now how do you get that? I'll explain this. How do you get that? So you have to get cost of work completed simply by total of debit side. Now total of debit side will typically be all your cost and less credit side. Now what do you mean by less credit side? Do not subtract work certified. You have to calculate the cost of work certified. So from credit side, what all you need to subtract? It can be material at site, it can be material return, and as far as recording depreciation is concerned in contract costing, there are two methods. Few people write over here straight away depreciation. Whatever is the depreciation, they just write the amount of depreciation. But few people, what they prefer is they write over here to plant at site, and over here also they write plant at site. So if 1 lakh is the plant at site, 80,000 is the WD. Some people write it this way. So effectively you debit 20,000 of depreciation in the contract account. Few people write 20,000 depreciation directly, right? So if you are following this second method, then you also got to subtract plant at site. In short, just take the cost of entire year, this year. I mean, of course, if there are only you take that, so that you get the cost of work completed, and then simply say, if this cost is 2/3, 1/6 is how much. These are the typical sums that are generally being asked, right? So that's how we record, closing credit side. We have plant at site, we have got material at site, and then whatever profit you get, simply transfer it to P&L account, right? That's it. So that's the contract account that you need to do. And one more thing, few things that I want to tell you more. First of all, so that's how you can get the value of work uncertified. If you are not given the question, that is a typical question that is generally asked once you get uncertified. And having got the notional profit, having got the P&L, now let me talk about a few things that I want to discuss with you guys. First thing, there is one more type of question that is generally asked is about escalation clause. Now, escalation clauses typically to protect contractor against the rising cost beyond his control. Okay, let me just elaborate. What I'm actually talking about is, now when a contractor quotes his contract price, of course, as we just said, that contract lasts for 2 years, 3 years. So when he quotes the contract price, he reasonably estimates the future. So he estimates future cost and gives his quotation accordingly after adding certain problems. But now, if the prices go beyond the control, go up beyond a limit, then he will start to suffer losses. And now, this is something that is not his fault. That is not his fault. The prices are going up, inflation is set in, everything is just getting costly, some abnormal reasons have come out. It is not his fault at all. But still he is suffering the losses from that. So he can include an escalation clause when he is preparing the contract to safeguard himself against the increase in cost, right? But escalation clause is not for any increase in cost, understand that. Escalation clause is for increase in cost beyond his control. What do I mean by beyond his control? I just explain you one thing and everything will be clear. And probably that is going to be the last thing that we're going to talk about in this chapter. Now, when the quotation was submitted, let us say budget. When the quotation was submitted, he had thought that 5,000 kgs of cement will be used at the rate 100, and amount is going to be 5 lakhs. Actual, it happened that 5,200 kgs of cement were used at the rate 120. So price is 5,000 into 120, and that will come 6 lakhs. Now there was an escalation clause inbuilt in this contract. So contractor is asking for the extra money apart from the stated contract price. The extra money because of on account of escalation clause for the increase in cost. Right? He is asking 1 lakh rupee extra from the contractee. There's one sum also in recent MTB that we did, that is this claim admissible, 1 lakh extra? Then the answer is no. Now understand what I mean. His cost is increased over here from 5 lakh budget to 6 lakh actual because of 2 reasons. One, the quantity that he had thought of was 5,000, but actual quantity used is 5,200, and the rate is 100 and 120. Now, I repeat myself, escalation clause is to protect contractor, to safeguard contractor against increase in cost. I repeat up to this because last word is going to be very, very important. Escalation clause is to protect contractor against the rising cost, against increase in cost. The last word is beyond his control. That is the most important thing, beyond his control. So as according to us, the admissible escalation clause is going to be 120 minus 100, the price increase, 20 rupees, into 5,000, right? There's just calculation mistake as well. So here total is actually not 6 lakhs, it is 6,24,000. Right? So for us, the amount of escalation clause admissible is 1 lakh and not this entire difference of 1,24,000, because the rise in price is considered to be beyond his control. The rise in price is beyond his control, but my friend, increase in quantity is something that he could have controlled by effective supervision, by using his material efficiently. Right? So whenever any sum of escalation clause comes into your examination, you have to do this way. You have to do actual price minus standard price into always standard quantity, because quantities are always considered to be within his control. Right? That is something that you have to keep in mind when you are talking about escalation clause. So I think that is important. This is sufficient for this chapter. Now let's go to the next chapter. The next chapter, as per your study material, is unit costing and batch costing. Now this is nothing great, my friend. Unit costing and batch costing. This is absolutely a small chapter. Unit costing is where basically these are methods of costing, unit costing and batch costing, which we have studied, which we've discussed in our chapter number 1, that is theory chapter. Unit costing is where the company is following unit costing, where single unit can be produced and accordingly cost sheet is prepared that way. And batch costing is where a single product cannot be produced and your production has to happen in batches. In that case, you have to follow batch costing. Okay. Now, what is typically asked in this chapter? If you are asked cost sheet of unit costing or batch costing, do not worry about it. We have already covered in our sums of cost sheet chapter. Like majority of the sums that we have done in our cost sheet chapter, where did we say that quantity of finished good produced, sold, and then we got particulars total per unit? That was nothing but unit costing. And batch costing is where you have to do your production in batches. Now, one thing that is generally asked in batch costing, it will hardly take 2 to 3 minutes for me to cope up with this chapter, is economic batch quantity. Economic batch quantity talks about in which quantity I should produce, what should be the batch size. So when you want to decide the batch size, you have to follow the formula under root of 2AS divided by C. It is very similar to what you have understood about EOQ, under root of 2AO divided by C. So now here we say A is equal to annual production S is equal to setup cost and C is equal to carrying cost, right? Same format, same funda, same concept. Just when you're talking about how much material to order at one time, you talk about ordering cost, and similarly over here, how much you want to order, how much you want to produce each time, you take up setup cost S, right? That's it. Nothing great in this chapter. Majority of the things of this chapter have been taken care of. Cost sheet, and even if you look at the study material, it's a very small chapter. Just you need to understand this, right? So with this done, let's move to the next chapter. And the next chapter that we will take up is, just let me check up. So yeah, next chapter that we are looking at is cost accounting system. Now, in case of cost accounting system, there are 2 broad cost accounting systems that we follow. One is going to be your integral accounting system. And second is going to be your non-integral accounting system. Like in case of a non-integral accounting system, cost and finance are kept separate. Cost and finance are kept separate, and in case of integral accounting system, cost and finance are merged. So first, let me talk about non-integral accounting system. If cost and finance are kept separate, in our syllabus, because we are costing, we are not finance, we will not be asked financial books. We will be asked about to prepare costing books. A few things very quickly I want to tell you is, in costing books, we do not prepare balance sheet. In costing books, we do not prepare balance sheet, and accordingly, you will not be having any ledger pertaining to balance sheet, like all the ledgers of fixed asset, current asset. Current asset includes cash, debtors, and current liabilities. There's creditors and capital employed and all that. So you will not be having any ledger relating to balance sheet. And also, you are not supposed to pass any entries relating to balance sheet, like fixed asset purchase, nothing to do. See, understand one thing, my friends. Costing should always and only be concerned about the cost of product. If something is not related to cost of product, costing has got nothing to do with that, right? Simply ignore that. So that is something that you need to do. Now, having said that, so we do not pass any entries relating to balance sheet where both the debits and credit are going into balance sheet, like fixed asset to cash, cash to debtors, debtors to cash, creditors to cash, cash to creditors and all that. But what about those entries where one effect goes into P&L and one effect goes into balance sheet? So we need to give we need to pass those entries. We cannot completely ignore it. Like if I purchase the material credit, purchases are something that I have to record in cost sheet because that will affect my cost. But two creditors I don't have. And cut the long story short, whenever there is a balance sheet part, see, understand, if both debits and credit pertain to balance sheet, we will not pass that entry at all, like fixed asset to cash, like cash to debtors, like creditors to cash. Both the effect, debit as well as credit, are going to balance sheet, and hence we ignore that, we do not pass that entry. But, if we talk about entries where one debit or credit is going into P&L, which we need to prepare, because ultimately the job of costing is to find out the cost of product. So anything which is relating to your cost part, you have to record it. Okay. Now, having said that, say for example, purchases is something that definitely I want to record. Two creditors, I'm not having creditors, so what I need to do? So we will say 2 GLC. So there are three names to it. One is called General Ledger Control Account, or we say Nominal Ledger Control Account, or we can say that it is Cost Ledger Control Account. General Ledger Control Account, Nominal Ledger Control Account, or cost, whatever you can. So whenever there is any item pertaining to balance sheet, you can use this ledger and you will get it done, right? So whenever you get GLC over here, right? Generally we'll be using GLC. So that's how you need to use this ledger as a balancing act whenever one effect is going into P&L but second is going into balance sheet. Then, as far as scheme of entries is concerned, there are very simple entries that you have to pass. Like, first of all, you have to talk about purchase of material. Then you have to pay wages. Then you have to pay overheads and all that. See, ultimately, whatever entry you are passing in integral or integral accounting, you got to be ensuring that you are ultimately preparing cost sheet. Right? So now, very quickly, we'll be looking at every possible entry that we do in this integral, non-integral chapter, or in this chapter of cost accounting system. Very quickly, I'm going to walk you through every entry that we pass in the system. Okay. So first entry is going to be purchase of materials. Now, what entry we pass for purchase of material? I'm not going to get into logics and everything. This is just going to be a quick recap of everything. So, purchase of material, I'm going to pass entry SLC account debit to GLC. Why SLC and everything I've explained in great depth in my chapter explanation, so I'm not getting into it. First is purchase of material. Second entry that we pass, my friend, is issue of material to production. Right. When we talk about issue of materials to production, it is going to be WIP account debit to SLC. Third entry. Third entry we pass is issue of material for factory maintenance. issue of material for factory maintenance. So when we talk about issue of material for factory maintenance, the entry is going to be FOH account debit to SLC, FOH to SLC. That's how we get it done. So these are the entries relating to few entries. Then next entry, that general question we get is material return from shop floor, or it is called production. Production is shop floor, one and the same, right? So when we talk about material return from production, see, material was issued by stores to production. So when it gets returned, production will return it to stores, and accordingly your entry is going to be SLC account debit to WIP. Then, now this faulty material which production returned to stores is returning to creditors saying that, yeah, man, what kind of material you are sending it, take it back. So when we study next entry, material return to supplier, when we talk about this entry, material return to supplier, we pass the entry. It is supplier means creditors, we do not have the ledger, so we say GLC account debit to SLC. That's how entries relating to material should be passed. Next, let's talk about entries relating to wages. So first entry, if we say that wages paid, then entry for wages paid is going to be wages control account debit to paid, but we do not have cash account, so we will say GLC, right? That's how we pass entries about wages paid. The next thing is direct wages allocated. Okay, next things are direct wages allocated. So when direct wages gets allocated, it will go to WIP. So entry is going to be WIP account debit to wages control. WIP to wages control. The next third entry that we pass is indirect wages allocated So when we talk about indirect wages allocated, it is FOH account debit to wages control. That's how we pass entry for that. Then, if they're talking about direct expenses, let's talk about that. Third is going to be direct expenses. Direct expense, first thing we talk about is pay. So when you pay direct expenses, it has to be direct expense account debit to cash, but we do not have cash, so we say it is to GLC. Now, how to close this account? Where to close this account? Close direct expense account. So when you want to close your direct expense account, it should be going to WIP account debit to direct expenses, right? So direct expense will go to WIP, and as I said, ultimately you should be forming cost sheet. So while forming cost sheet, you got to be keeping in mind that WIP stocks include direct expenses, and direct expense should go to WIP, right? Then next, after wages, next we talk about factory overheads. See, if you're understanding, I'm only moving in the order of cost sheet: direct material, direct labor, direct expense, FOH. Right? That's the same thing I'm doing. Now, FOH, when we talk about paid, the entry is going to be factory overheads account debit to GLC account, and when these are absorbed, or sometimes questions tells you it is charged to production. Again, effort will be absorbed to WIP. Logic I have explained at great depth in my regular video section. This is just a rapid revision, so it will be going to WIP to effort, right? Whatever is going to be the WIP, it will get effort. Now, let me give you one more here. What about under or over absorption? Because actual and absorbed can be different. Now, as far as under or over absorption are concerned, in case of a non-integral accounting system, by default, we have to follow carry forward method, and accordingly whatever under or over absorption arises, simply got to say by balance carrying forward or to balance carrying forward in case of a non-integral accounting system. But in case of integral accounting system, I am yet to reach integral accounting system, but still I will tell you, it is costing P&L or P&L. Let's keep this point pending, and when I will explain you integral accounting second, just in a while, I will be telling you that. Okay, so that's how factory overheads is done. Then next is, so after that, we will discuss that in great depth, that is straight. But after factory overheads, the next is administrative overheads. Next is administrative overheads. Now, as far as administrative overheads are concerned, once they are paid, the entry should be admin overheads account debit to GLC. Right? When it is paid, the entry should be admin to GLC, and when it is absorbed, though book is not mentioning, but I will mention two probabilities over here. If administrative overheads are related to production, if they are related to production, then entry will be FG account debit to admin. Because if it is relating to production, then admin should be part of the physical stock. But if it is general, then entry should be COS account debit to S&D overheads. To admin overheads. Okay, so this takes care of administrative overheads. Once administration are done, the next thing that we look at is selling and distribution overheads. Okay, so when we talk about selling and distribution overheads, again we will have two entries. First of all, selling and distribution overheads paid. So when we talk about paid, it is S&D overheads account debit to cash and bank, but we do not have cash and bank, so we say GLC. And when it is absorbed, the entry is going to be COS account debit to S&D overheads account. That's how S&D overhead should be absorbed. Then the next entry that we got to pass is for actual sales. So when actual sales happen, my friend, the entry is going to be GLC account debit to sales. GLC stands for debtors, and that's how we do it up, right? So these are the main entries that we got to pass. And then a few more entries that I would like to tell you when generally it is asked is, first of all, goods completed during the year. So when we ask or when we talk about goods completed during the year, which department would have completed? It is WIP department which would have completed the goods, and once the goods are completed, it is sent to finished goods. So we'll say over here FG account debit to WIP. That is how we say goods completed during the year. Then next is cost of goods sold, COGS. So when we are passing the entry about cost of goods sold, the entry is going to be COGS account debit to FG. Right? Because cost of goods sold will be coming from warehouse FG. That's how we pass this entries of non-integral accounting system, and whatever difference you get in costing P&L as a profit or loss, that should be transferred to GLC. So I'll give that as the last one, profit or loss to be transferred to GLC. I think that will make a lot of sense to you guys. Now, this is all about non-integral accounting system. When we talk about integral accounting system, nothing great is going to change. In integral accounting system, first of all, we combine finance as well as costing. We have only one set of accounts, so now we'll be preparing P&L as well, and we'll be preparing balance sheet as well. So very shortly, in integral accounting system, let me give the heading first of all. In case of integral accounting system, what we do is, in case of an integral accounting system, we combine both this. So when we combine both this, the simplest funda that you need to do is P&L account should be prepared as per the concepts of costing. Understand that? P&L account should be prepared as per the concept of costing, and balance sheet should be prepared as per the concept of finance. So whatever entries we have learned about, that is the P&L of costing, all the entries will be true, with only difference being, wherever there is a GLC, now GLC will be replaced with actual ledgers. Now we had GLC because earlier we said that we are not preparing balance sheet, so we are not having ledgers of cash, bank, fixed asset, debtors, creditors. Right. So now nothing that is going to change. Whenever we have written GLC, the original entry was debtors to sales, but because debtors account was not there, we say GST to sales. So now again say debtors to sales. Wages paid, so we said wages control to GLC because cash and bank was not there. Now cash and bank is there, so say wages control to GLC. Wages control to cash and bank. Wages control to cash and bank. That's how we'll be working on. Okay, so integral accounting system is the basic simplest thing. And just wherever you recorded GLC, you have to record it with actual ledgers. One important note that I want to give: entry for first, which I can recall as financial incomes and expenses. Entry for financial income and expenses. Second, purchase of fixed asset by, because both the effect fixed asset to cash and bank both goes to balance sheet. Payment to creditors, collection from debtors, etc. are not done in non-integral accounting system. But these entries must be done in integral accounting system. That's the one important note that you need to keep in mind while doing sum. Okay. So if you can do this, I think this will be sufficient and will be enough. Now, one thing that I need to explain is why you cannot follow carry forward method in integral accounting system, because the purpose of cost sheet is only to find cost. Only to find cost of product and not to find profit and loss, right? So, yeah, we prepare profit and loss account, but the ultimate purpose is not to find the profit. The ultimate purpose is to get cost of sales, right? Now, that's okay, but when we are selling, when we are preparing integral accounting system, costing and P&L account both, and balance sheet, where our purpose is to find cost of product as per the costing concept and also to get profit as per finance concept, both. That is where you need to be careful. That if you are only looking at the cost of product, whatever under over absorption. Now, what is under absorption? Under absorption is the amount that has not gone into the cost of product, that has not been charged to product. And if something has not been charged to product, it's okay, we don't care. Wherever it goes, we don't care. So we simply say buy, balance, carry forward. But when you also want to find out the profit, you cannot say buy, balance, carry forward. You have to transfer it to costing P&L, because now in case of integral accounting system, the P&L account that you are preparing must also reflect the current profit, right? And that is why in case of integral accounting system, you should not be following carry forward method. Okay, so these are the few things that I will tell. Apart from that, the chapter of reconciliation is also covered in this chapter in your study material. Reconciliation is very simple. It needs to be prepared only in non-integral accounting system. So let me give the heading first of all. It is reconciliation. Okay. So first of all, the need of reconciliation. Okay, when reconciliation needs to be prepared. So reconciliation needs to be prepared when there is a difference between profit as per costing and profit as per finance. So when profit as per costing and profit as per finance differ, you have to prepare a reconciliation statement. So now the bigger question is, when profit as per costing and finance can differ, the fundamental thing is the profit as per finance and profit as per costing differ only if there are two different accounts. If there is only one, there cannot be any difference, and hence reconciliation statement needs to be prepared only in case of non-integral accounting system. That's the first thing, and it is asked in theory question as well, that reconciliation statement needs to be prepared in non-integral accounting system. Explain. Then this is the explanation, right? Because in non-integral accounting system, costing and finance will be kept separate, and when there are two separate accounts, the profits might differ, and when the profits differ, we have to prepare reconciliation statement. In case of integral accounting system, costing and finance are merged, combined. There is only one figure of profit that comes out at the end of year, and if there is only one profit figure, the question of reconciliation does not arise. Now, what are the reasons for difference? So broadly, we discuss 4 reasons for them. Reasons for difference. So the first reason for the difference of costing and financial P&L is financial incomes and expenses, which are recorded in finance but not in costing. So say for example, dividend received, interest received, rent received, profit on sale of fixed asset, loss on sale of fixed asset, donation, income tax. All these financial expenses are getting recorded in financial accounts. So it might affect the financial profit, but costing does not record all that, and accordingly we may not get affected by that. Then second reason is stock valuation. In stock valuation, what we say? In financial accounting, stocks are valued at cost or NRV, whichever is low, whereas in cost accounting, stocks are always valued at cost, right? Finance records, again I repeat, finance records it at cost or NRV, whichever is low, whereas finance records always at cost. So because of this, there can be difference of these two. Third reason for difference in these two can be under or over absorption. Because of under or over absorption, the profits could differ. Like we discussed about under and over absorption just a few minutes back. So if there is under and over absorption, because of that, costing and finance profit will differ, because finance will debit actual overheads to debit side, whereas costing will debit the absorbed overheads. And if there is under and over absorption, that is the difference between actual and absorbed, your profit will differ. And fourth reason can be difference in accounting policies. The fourth reason can be the difference in accounting policies. So whenever there is a difference in accounting policies, like costing follow FIFO method, finance follow LIFO method, costing follow weighted average, finance follow FIFO method, costing provides SLM depreciation, finance provides WDV depreciation. So because of these reasons, there are general reasons that where there is a difference in accounting policies, your profits will differ. Now, how you need to approach the reconciliation? If first of all, prepare financial P&L if not given and find the profit. Prepare cost sheet if not ready given. And third step is going to be the reconciliation of both the statement. Okay. Now, few things that I want to tell in reconciliation chapter is, while preparing cost sheet, I have explained these points in my sum, but these are crucial points, so I would like to reiterate again. So we say that while preparing cost sheet for the chapter of reconciliation, first, WIP stock can be recorded same as finance. WIP stock can be recorded same as finance in the absence of data or in the absence of information. Right? We need stage of completion for valuing WIP as we did in process costing. Right? But unless those stage of completions are given, we cannot value WIP stock. And second thing, finished goods stock must be valued at cost of production and cannot be recorded same as finance. Right, if you want to refer question number 4 of Navkar book, or you can look at the videos of question 4, and I have explained this point in great depth with proper explanation, right? So that's the one thing that you need to be careful about. And next note is, as far as reconciliation is concerned, we prefer to start as per profit as per costing. Then how we prepare reconciliation account? If I give a small recall of the shortcut that we use. The shortcut that we use, even you can find it in the video, is, my friend, prepare two P&L account, costing and P&L, and mind you, this is rough work. The fare is the statement itself that we prepare, right? Which we start from profit as per costing. Finance P&L, costing P&L. I'll just explain one transaction. Now, say for example, you started with profit as per costing. Your starting point is profit as per costing, right? Now, opening stock, finance is recorded 10,000, costing is recorded 15,000. Now, because of this transaction, finance is recorded 10,000, costing is recorded 15,000. There will be difference in the profits of these two sets of account, which I want to tell. The simple thing I can understand is, if both the stocks tally, profit will automatically tally. Like, I have two options. Either I can put 5,000 on the debit side or I can put 5,000 on the credit side of the costing book. Now comes the main question, what will you do? Then our answer is, my friends, we will credit 5,000 to costing book because our starting point is profit is for costing, and when our starting point is profit is for costing, it does mean that we are costing, my friends. Very important this. When our starting point, my friends, is profit as per costing, it does mean that I am costing, and if I am costing, I can change only my books. I cannot change the book of opponent person. It is same as bank reconciliation statement concept, where your starting point, if it was profit as balances per passbook, it means you are a bank and you cannot change the cash book, or vice versa. If your starting point was balances per cash book, it means you are a company and you cannot change the bank's book. Similarly, always I am going to start with profit as per costing, so I am going to be costing and I can only change my book. So accordingly, I have to put 5,000 on the credit side. And now the very simple accounting logic is, in costing period, already I have started with profit as per costing, and if I credit 5,000 further in all profit, if I credit 5,000 further, what will happen? My profit will increase, so I put it on the add side. This difference, 5,000, I will put it on the add side. If I take one more transaction, like rent received 10,000, interest received 2,000, credited by financial books, not done by costing because it is financial. Now, because of these two reasons, the profits are different. What I'm going to do now, I'll put on the credit side, and if I credit, my profit will increase and I put on the add side. Similarly, donation, bad debts, income tax, finances debited, nothing done by costing. So to tally the profit, now I have to debit. And in profit, if I debit something, my profit will reduce, and hence I'll put it on the less side. So this is the shortest and finest way to get your reconciliation tallied. You will never go wrong with that. And another way of preparing reconciliation is preparing a memorandum reconciliation account. Right? You can prepare a memorandum reconciliation account, and this is even simpler. Memorandum reconciliation account, it is very, very simple. I'll tell you one simple thing about it. Obviously, you're going to be starting with costing, and in costing books, if there is a profit, you start your memorandum reconciliation account on credit side because profit should be written on the credit side. So we say profit as per costing. Then follow this procedure. If this is add, put on the add side. If these two things have to be added, credit side. So memorandum reconciliation account is even simpler because earlier when we were preparing statement, we had to think like, okay, credit means I got to add because my profit will increase. Okay, in profit I have put on the debit side, so I need to subtract. But here, there is no such thing like this. If you are crediting in costing books, credit, because this is nothing but a costing book itself. We are preparing an account form. If three things are debited, just debit three things. Really simple. You will get opposite figure as profit is for finance, and if they are matching, your reconciliation is tally, done. Right? If you want to see this, you can refer to question number 7, question number 11, and question number 2 of Navkar books. You'll be able to get it, right? So that's it about cost accounting system. Very quickly, let's move to the next chapter. And the next chapter, where we will spend some time, again, is going to be cost sheet. Let's spend time on cost sheet right here. So cost sheet is typically the chapter which is, it can be considered as a base of entire costing, as well as it is scoring as far as your exams are concerned. So first and foremost, what we're going to do is we'll prepare the format of cost sheet first of all. So if I have to tell you the format of cost sheet so that you can get it recorded very, very fast, we're going to say cost sheet for the period. Not necessarily cost sheet for the year, it can be for any period, it can be for a month, it can be for a quarter. Then, if it is unit costing where unit data are given, we say that quantity of finished goods produced and then quantity of finished goods sold, right? Then, if I have to prepare the format of cost sheet, just let me do the format very, very quickly and we'll take on. So we've got three columns over here: particulars, total, and per unit. Now, what is the format of cost sheet? The format of cost is going to go like this. First of all, we start with direct material consumed. Now, how do we get direct material consumed? If you want calculation of direct material consumed, then it can be like this. It can be opening stock plus purchases plus purchase expenses. Purchase expenses include freight inward, GST, octroi, whatever expense you incurred for bring the material from supplier place to your place. That is all purchase expenses, right? So after purchase expenses, we subtract it with purchase returns. Then we have got closing stock. So if you subtract closing stock and all that, you will get your direct material consumed over here. Right? After direct material consumed, right, you'll get your direct material consumed over here after doing all this add less and everything. So opening stock plus purchase expense minus purchase return minus closing stock, that gives you direct material consumed. To direct material consumed, we add direct labor. So let us add direct labor over here. Then direct labor should be followed by direct expenses. After direct labor, we make a total, and that total, as we all know, it is called a prime cost. Prime cost is the total of direct material, direct labor, direct expense. So we get prime cost over here. Prime cost should be followed by factory overheads. So we say add factory overheads. So we record factory overheads over here. And of course, which factory overheads are to be recorded in cost sheet? Just now we studied the reconciliation chapter as well. Again, I am repeating that in cost sheet, always absorbed overhead should be recorded. Right? And that is why under over absorption difference needs to be recorded in your reconciliation statement. So in cost sheet, please keep in mind always absorbed overheads are to be recorded. Having done that, next thing we get is gross factory cost. From that gross factory cost, gross factory cost, I add opening stock of WIP. So let us say add opening stock of WIP. It is not recorded in per unit. So WIP will be only recorded in amount column, nothing to do with per unit column. And then say less closing stock of WIP. So let's subtract closing stock of WIP and we will get over here net factory cost, works cost. Now few things are to be recorded over here, which I'll tell you right away. After you get net factory cost, works cost, few things that your institute asking you to add over here is, first of all, research and development cost. Next thing that they are asking you to do is quality control cost. One thing that is subtract over here is scrap value. Research and development cost, quality control cost, scrap value, and of course one last thing that we need to add is administrative overheads. If it is related to production. If it is general, then we don't need to do anything, but if it is related to production, we need to do it. If it is general, we'll be adding it after COGS, not right over here. Okay, so if you do this much, you get the next total, and that is your cost of production. So once we got the cost of production, next thing we need to do is adjust the finished goods stocks. So we adjust the finished goods stock over here. So we say add opening stock of finished goods and subtracted by closing stock of finished goods. So we say add opening stock of finished goods less closing stock of finished goods. So we subtract closing stock of finished goods, and now we'll be getting cost of goods sold. And that's how we get cost of goods sold. And after cost of goods sold, we add administrative overheads, which are general, and selling and distribution overheads. So add admin and S&D, and mind you, COGS itself and everything that you record after COGS should be divided with sold quantity and net, not with produced quantity. In study material, there is one somewhere in there you have recorded administrative overheads after COGS, and they have divided it with production quantity. That should not happen. It should be divided with sold quantity only. So after recording S&D, we have got cost of sales, and to cost of sales, if I add profit, we get sales, right? That is going to be the format of cost sheet that you got to keep in mind. And as and when the things come, just do record it over there, right? So cost sheet is a simple chapter. There's few things I want to tell you. I want you guys to keep in mind is first, few important points that you would have noticed is, first of all overheads that is factory administration should be recorded at absorbed amount in cost sheet absorbed amount is in cost sheet and not actual. That's the one thing that you need to keep in mind, that it should be recorded at actual and not at absorbed level. Okay, second thing is direct cost and variable cost should be kept same if nothing is given. On per unit basis, and if any change is given, it should be applied on per unit basis. This is a very important point where you can go wrong. If you want to refer question 3 of Navkar book, right, wherein they have given us that direct material and direct wages will increase by 10%. In year 2006, there was some data like 90,000 and per unit was 9 because 10,000 units were produced, and 60,000 per unit was 6 because their 10,000 units were produced. And that question has told us that direct material and direct wages will increase by 10%. You got to keep in mind that direct costs and also the variable cost got to be adjusted on a per unit basis and not on the basis of total. That's one thing. Then next, fixed cost should be kept same. Okay, if nothing is given, in total, and if any change is given, it is to be applied on total. This should be applied on total. That's a very important thing that you got to keep in mind. If you want to understand this point, you can refer question number 6 of Navkar book, wherein we are given that fixed overheads will increase by 3,000. Fixed overhead charges are anticipated to show an increase of 25%. This kind of data is given to us, so you've got to apply in total, right? These are the main things that you've got to keep in mind. Apart from that, there is nothing great in costing. You just got to follow the format. You just got to be applying the concepts in the way as I told, and few things as we given over here: R&D cost, quality control cost, and all that. You got to record it like this. Of course, there are few disputes like scrap value. Few people like to subtract it from factory overheads, and few people prefer to write it after net factory cost as it is written in the format. Now, why also subtracting factory overheads from efforts can be proved right? You need to understand the logic of process costing, and probably when you correlate cost sheet and process costing, you will also understand that. Now, understand, my friend. So, if you connect process costing and cost sheet, you will find that even if you record your scrap value as factory overheads, it will be right. Now, let me tell you why. My friends, when we are preparing process accounts, we took up process costing in this rapid revision session itself. So when we are finding out cost per unit as per the process costing funda, what we used to do, we were saying total of debit side, right, minus scrap value divided by input minus normal loss. We should do that. Okay. So total of debit side minus scrap value divided by input minus normal loss. That's what you used to do. Now, I told you in that video that process costing used to help you in valuing WIP. Whatever stock was in process 1 or whatever stocks are there in process 2, they are essentially WIP, my friend. Right? And now it means, see, understand this thing. You are valuing at this cost your WIP. Yes or yes? Because they ultimately are WIP stock and you are valuing at this. Now, while valuing WIP stock, the very important thing is you are already subtracting scrap value. You are subtracting scrap value while valuing WIP. That's a great fact. But now, when you come to this format, if you are writing scrap value after WIP, means your WIP stock will be without adjusting scrap value, whereas your process costing it should be after adjusting scrap value, right? That is why if some people subtract scrap value over here, that should also be okay, because then WIP will get adjusted as well. But I told you the format, and that's how it should be done, right? So these are the few points about cost sheet that you must be kept in mind. You must be keeping in mind, and if you follow these principles what I told, definitely you will be able to grab marks. Now, having done this chapter, we very quickly move to the next chapter, and the next chapter that we need to study is activity based costing. Now, what are the things that you need to keep in mind as far as activity based costing, or why activity based costing was developed? So understand this. As far as fixed overheads are concerned, there are two broad treatments, as I told earlier when I was taking up marginal costing. Right? As far as fixed overheads are concerned, there are two broad things. two main treatments which are concerned. One, convert fixed overheads into per unit cost, and one treatment says keep fixed overheads as fixed. I explained this, and logic of this and everything has been explained, right? So I'm not getting again into it. Now, converting fixed overheads into per unit cost is known as basically absorption, and it is necessary, it must be done, because when you convert fixed overheads into per unit, then only you'll be able to recover your cost on the products. Unless you convert your fixed overheads into per unit cost, you'll not be able to charge your fixed overheads to the product, and you will not be able to recover accordingly, right? And when we keep fixed cost fixed, that technique is something that we call it as a margin. Now, as far as converting fixed cost into per unit are concerned, there are two techniques. Let me talk about it. One is a traditional technique. If you want to learn traditional technique, definitely which we are going to learn, you have to refer to your chapter 4 of absorption costing, when we talk about output method, machine hour, labor hour, etc. 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 We'll talk about that when we'll take up chapter 4. Presently we are in chapter number 5, right? And the modern technique is what we call it as activity based costing. Now, activity based costing basically believes in charging overheads to product based on the activities, not on the basis of hours. Because ABC clearly believes that hours cannot be the reason for which cost is being incurred. Like when I've explained this chapter, I've taken an example. If one guy goes to a coffee shop and spend 4 hours there, just orders one coffee. 4 hours, one coffee. And there is another guy who is just spending 1 hour over there, but has consumed 3 coffees, then who should be charged more? Of course, the guy who has charged, who ordered 3 coffees, because the reason for cost being incurred is the number of coffees that you order, and not, my friend, number of hours, right? It is not about number of hours. It is about number of coffees that you order. That's the activities that you do, and you should be charging your cost based on the number of activities and not on the basis of hours and like this. So that's typically activity based costing. Now, the sum of activity based costing, how generally sums are asked? Generally sums are asked like this. Generally I'm talking about part 1, required part 1. Calculate cost of products as per traditional costing system. That's the first thing that you are asked. As per traditional costing system. That is the first thing that you are asked. Part 2. Calculate cost of products as per activity based costing method. So that is how generally they ask. First, they ask you to prepare calculate cost based on traditional method, and then they shift to activity based costing. And more often than not, we have part 3. Explain reasons for difference in cost. So in doing this kind of sums, if 10 mark sum is asked, you can easily grab it. What you need to do is, first of all, calculate cost as per traditional costing, direct material, direct labor, prime cost, and then follow the method of overheads that they talk about. Right? If they're telling about output method, follow output method. More often than not, they mention it, that companies following labor hour, machine hour. Then whatever method they follow it, get your absorption rate. Like absorption rate is going to be budgeted overheads divided by budgeted number of either machine hours or labor hours or whichever method they follow. Calculate this absorption rate, charge this absorption rate to product, and get your rate, get your product cost. Now I want to talk about activity based costing because that is the main chapter that we need to talk about. Now when we talk about activity based costing, what are the things that you need to keep in mind? There are 5 steps in which you can do the sum of activity based costing. Step 1 is define activity. So we always prepare in a tabular form, and I am showing the tabular form right away so that you can solve the sum. And this is rapid revision. This is not an explanation session, right? Explanations have already been done. It's a time of rapid revision, so I'm going to be telling you how sums of activity based costing can be done in a tabular way. So we first prepare a table like this. In that we prepare 4 tables, and always in the sum of activity based costing have this table first. Never just start preparing the product costing table first unless and until you get this one. So step 1 of activity based costing is going to be define activities. Now what are activities? Activities are the reasons because of which you incur the cost. Like in practical life, why you incur cost? So probably you incur cost because you do setups. So setup is an activity. You incur cost because you order the things. So ordering is going to be an activity, right? Electricity is going to be your activity. Electricity cost. So that is your step 1. Step 2 is cost. Allocate cost to these activities. So now say for example, if you come to know that setup cost is 20 lakhs, ordering cost is 30 lakhs, and electricity cost is 50 lakhs. So that's the step 2, that is allocate cost to your activities, and we have done that. So setup cost is 20 lakh, ordering cost 30 lakhs, electricity 50 lakhs, right? After that, step 3. Step 3, we talk about cost driver. So when we talk about cost drivers, setup. Now what is cost driver? Cost driver is typically the factor which can affect the cost level of an activity. I repeat, cost driver is the factor that can change, that can affect the cost of an activity. Means which factor can increase or decrease the setup cost. So the factor that can change setup activity cost is going to be number of setups, right? So number of setups is going to be that factor which can increase or decrease, which can change the setup cost. Similarly, if you think about ordering activity, then the factor which can change ordering cost is the number of orders you place. If you place more number of orders, your ordering cost will be more. If you place lesser number of orders, your ordering cost is going to be less. Very simple, right? And then electricity, we can talk about, say for example, number of machine operations. The more operations you carry out, the more electricity will be done. Or it can be machine hours also for electricity consumption. But okay, we can take it up. And then step 4 is going to be calculate cost per cost driver. Now, typically cost per cost driver is nothing but the absorption rate. Simple absorption rate that we calculate in chapter 4. We get it like this. So, if I get like this, 20 lakhs is the setup cost and 20,000 setups are going to happen, then the cost is going to be 100 per setup. That's how we get that. Okay. Then, if I talk about ordering cost, 30 lakhs is the ordering cost, and divide by, say for example, I'm going to put 10,000 orders, so we get rupees 300 per order. Charge it to products at the rate 300 per order. And now machine operations, the cost is 50 lakhs. Divide by, say for example, 1000 operations. So I'm going to get cost at the rate rupees 5000 per machine operation. So these are the 4 steps that you always got to do. Always do this table first. That is going to be activity, cost, then cost driver, and last is going to be cost per cost driver. That's how you need to do it, right? Now once you do this, define activity cost driver and cost per cost driver. Then once you got the absorption rate, the next thing that you got to do is to charge it to product. So then we prepare the product table, calculation of cost of product. Whatever number of products are there, 2, 3, and I've told you while explaining the activity-based costing in this original video section that when you are following activity-based costing, ideally there should be more than one product in the company, because if there's a single product company, activity-based costing is of no use to them. And in fact, they will not be following it. Why should they be following such a complex system if they are having only one product? Right? And forget about activity-based costing. If there is a single product company, there is only one product in company's profile, they forget about using activity-based costing. Even they don't need machine or labor or anything. They simply need one technique, that is output method. Whatever is over it, divided by budgeted number of units, and they are ready, done and dusted. Okay. So now it's time to charge our absorption rates to the products. So say for example there are 3 products, A, B and C. Now if you are asked part 1, like as I just said in sum, that part 1 is generally calculate the cost as per traditional costing method, then you do not have to calculate anything till prime cost. Direct material, direct labor, and you will get prime cost. No change till here. Just copy and paste. One more important thing, very important thing that I want to tell you is, actually it is conceptual part which you should keep in mind. While calculating the cost of product as per activity-based costing, you don't have to prepare per unit column, because logically activity-based costing can never give you answer on a per unit basis. It cannot give you answer on per unit terms directly, and that is where why it cannot give you answer on per unit basis. Let me explain it over here, right over here, and there is one theoretical point also that we'll understand. Now say for example the ordering cost is 300 per order, right? Or you can say, okay, let's understand it with the help of setup. Your cost per setup is rupees 100, right? Now it is possible that in case of A, in one setup I might be producing 100 units. In case of B, in one setup I am producing 200 units. And in case of C, in one setup I am producing 10,000 units. It's okay, I can produce 10,000 units as well. There is absolutely no relation that in one setup I cannot do this. I can do anything, right? Setup is what? Once you set up the machine, until and unless you switch it off, it will be giving you production. Now, if I remove this one setup, and if I put cost over here, because one setup is rupees 100, one setup is again rupees 100, and one setup is again rupees 100. So 100 rupees I produce 100 units, 100 rupees I produce 200 units, 100 rupees I produce 10,000 units. If you calculate it per unit, it will be different everywhere. And the essential point that we want to understand over here is that setup is non-volume related cost. In this example, okay? Now what is the volume related cost? Like material is a volume related cost. 1 unit, 1 rupee, 2 units, 2 rupees, 3 units, 3 rupees, so on, so forth. But setup, 100 rupees, okay, 100 units, 200. You can produce any number of units with setup. So setup is a non-volume related cost. And the bigger advantage of ABC is ABC helps, activity-based costing helps in charging non-volume related cost. ABC helps in charging non-volume related cost to products, right? And if it helps in charging non-volume related cost to product, I guess you will understand that there is not much sense in making or preparing per unit column, right? Because it will not be making any sense. So what we're going to do, we'll just keep it simple, A, B and C, and then start charging overheads. So when we do charge overheads, let us say add overheads, added overheads. First of all, I'll charge setup cost. Whatever number of setup happens, say for example 100 setup happens, so 100 into 100, 2000 has happened for B, so I'll say 2000 into 100, and 17,000 for C, so 17,000 into 100, and keep charging all your cost. First is setup, then similarly charge ordering costs, and third charge electricity costs, like similarly total it up. So we get total cost, and once you get total cost, say divide by number, whatever number of units you actually produced, and that is where you will be getting cost per unit. Okay, that's how we got to do the sums of activity based costing. Really simple, nothing great to do about it, and at intermediate level the sums are asked. Very simple, not that tough, right? It just requires a bit of practice. So for practice you can do Navkar spiral, and also we have solved RTPs, MTPs which are there in app. We have calculated recent RTP as well, recent MTP as well. It's everything. Probably RTP, MTP is there on YouTube as well. You can go and watch these videos and you can practice as much as you want, right? So that is how about that's all about activity based costing. The only limitation, not only but the biggest limitation is activity based costing is a complex system. It requires so much data. Like here, there are 3 activities, 3 products, and we are charging it. If there are hundreds of activities, hundreds of products, you need data for hundreds of things. Like if I talk about number of setup, you need number of setups for A, B, C, D, and whatever number of product you have. If I talk about ordering activity, you need to have the data about number of orders for product A, B, C, D. So it's a complex system. That's the limitation, but the better point is it charges overheads to product based on actual resources consumed rather than random basis like hours, labor, etc. And this is something that you got to write in comment section every time. Whenever you are asked part 3, that is explain the difference in the cost as per ABC and as per traditional costing. So first and foremost line, you can write this. In traditional costing, overheads are charged to product based on machine hours, labor hours, etc., which are not the basis for cost being incurred. Whereas in activity-based costing, we charge cost to product based on actual resources or actual activities done, and hence activity-based costing results in better allocation of overhead. This is something that commonly you can write, right? That activity-based costing helps in charging overheads on a more rational, logical basis. Is it? And then you can pick up specific things like, okay, my product C was taking more number of hours, so under traditional costing I was charging more overheads to that. If you want to refer, you can refer question 1 of the Navkar book, wherein we have commented like this, that product C is taking more number of hours, more time, so we are charging more to that product. But if you look at the resource consumed, probably product C is taking the least number of resources. You can always refer question number 1, it's from Navkar book, and you'll be getting that. Okay, so you can comment like this, right? Okay, common comment I told you, common comment is always going to be there. Like activity based costing results in a more and better allocation of overheads to products based on actual resources consumed rather than random basis like machine hours, labor hours, etc. That's going to be the common comments. Then look into the data that what you can figure out from the data. Like as I spoke about, you can always refer to question number 1 of our classwork section. You will get what type of comment we can make. Like C is taking more hours but lesser resources, A is taking lesser hours, more resources, and then you can see the difference in the cost being charged accordingly. So That's how you need to understand activity-based costing chapter. Then again, let's come back closer to the end of this rapid revision session. We started from chapter number 15 and we have come to chapter number 4. Chapter number 4 is the chapter of overheads. Very interesting topic. So, as far as overheads is concerned, how we go about it? Why do we learn overheads? So, in the chapter of overheads, basically the thing that we are looking at is absorption costing. How do I charge? How do I absorb my overheads to my product? Now, why we need to learn this topic? Because direct costs are directly related to product. Now, as far as, see my friends, the thing is very simple. Total cost plus profit, right? Total cost plus profit is going to be selling price per unit. That's the simplest conclusion you need to have. Ultimately, at the end of the day, you got to be fixing your selling price per unit, and that's the goal of your business, right? Now, to decide selling price per unit, we want profit. Okay, that is something management will decide how much profit they want. As a cost accountant, our job is to give the total cost to management. Now, as far as total cost is concerned, there are two costs. One is direct costs and another is overheads. Now, as far as direct costs are concerned, I have nothing to worry about. Direct costs are direct because they are directly related to product. The name direct itself suggests that they are directly related to product. And if they are directly related to product, their cost can also be directly charged to product. Their cost can directly be charged to product, easily be traced to product, and accordingly it can be recovered. Now the issue is overheads. As the definition of overhead goes, they are all indirect costs. They are indirect costs. So when we talk about indirect costs which are not directly related to product, but the fact is those costs are not directly related to product, we got to charge it to product. And how? That is the question that we want to answer from over here. So the simplest technique that we can get is, okay, if say for example your rent for the year you are estimating to be rupees 10 lakhs. Now this rent is fixed rent. It will remain fixed irrespective of 1 unit is produced, 10 units is produced, 10,000, 10 lakhs is 0. So we say that these are not related to production. Now the question that we need to answer is, how do we charge it to product? How do we charge it to product? Then the simple thought that absorption costing gave you is, calculate an absorption rate. So we will say absorption rate is equal to budgeted overheads divided by budgeted level of activity. Sorry. So budgeted overheads divided by budgeted level of activity. Based on the budgeted data, you calculate your absorption rate and charge it to product. Now someone asks me, sir, why are you taking budgeted data? Take actual data now. But my friend, I take budgeted data because selling price is something that I have to fix right at the beginning of year, not at the end of year. I have to fix selling price at the beginning of year. Like if you are coming to take admission, I got to tell you the fees before I know how many admissions are actually going to happen, right? And that is why we say budgeted level of activity. Now there are 6 methods based on which we can calculate this budgeted level of activity. The first and simplest method is going to be output method. Formula is going to be AR is equal to budgeted overheads divided by budgeted number of units. Simplest method of all. Then we have second method. Second method is going to be machine hour method. Formula is going to be AR is equal to budgeted overheads divided by budgeted number of machine hour. Now what is the limitation of output method? If the products are dissimilar, What will output method do? Divide by number of units, and it will give same cost to both the product, whereas the product can be difficult. It can be different. Like say for example, if we talk about a basic feature phone and a smartphone, very high-end smartphone. If a Samsung company is manufacturing both the types of phone in its factory, what will output method do? Divide by number of unit 10,000, and both the products will be getting same cost. That should not happen. And in that case, we follow machine hour method where products are getting differentiated by the machine hours that it takes. Okay. Now, after machine hour, third method that we can study is going to be labor hour method. So labor hour method is going to be absorption rate is equal to budgeted overheads divided by budgeted number of labor hours. Concept is very simple. You got to follow labor hour when products are different because of labor hour, and you follow machine hour when products are different due to machine hour. Ultimately, a product has to be different, right? Then fourth method, fourth formula that we need to study is labor cost method, where formula is going to be AR is equal to budgeted overheads divided by budgeted labor cost into 100. So that's the fourth method, that is labor cost method. Now fourth followed by fifth one. So if I talk about fifth method, which is going to be material cost method. So as far as material cost method is concerned, we will say absorption rate is equal to budgeted overheads divided by budgeted material cost. When your products differ because of the material cost involved in it, you should be following the material cost method. Okay. Then sixth and final method that we have is prime cost method. So when we discuss prime cost method, we will see that absorption rate is equal to budgeted overheads divided by budgeted prime cost into 100. This is to be followed when your product differ because of the prime cost. Where material is important, your products differ because of the material cost involved in it, you follow material cost method. When your products differ because of the labor cost involved in it, you follow labor cost method. But when your product differ because of both the factor, material as well as labor, both are equally important, then you got to be following prime cost method. If you want to see the sum done with all the six methods, you can follow question number 14 of our Navkar book, wherein we have calculated this, all the six type of absorption rate, and we have charged it to job 857 as well. Now, there's one more thing that is asked as a theory question as well, and that is something that you need to understand from an exam point of view, is types of absorption rates. So when we talk about types of absorption rates, there are two types of absorption rates that we broadly need to be discussing. One is a single absorption rate, or it is also called blanket absorption rate. And the second type of absorption rate that we can think about is departmental or multiple absorption rate. This is something asked in exam as a theory question as well, and also it will help you to understand the sums better in coming time. So my friends, I say this way. Single absorption rate meaning is one absorption rate for entire company, and here the meaning is different absorption rates for different departments. Different absorption rates for different departments. Now, when you can follow blanket absorption rate? You can follow absorption rate when departments of company do similar jobs. Like if there are four departments, Department A, Department B, Department C, Department D, all of them are machine oriented, all of them work on machine. So in that particular case, for that company, you can follow machine hour method as a company whole. But when departments of a company do dissimilar jobs, you got to follow departmental multiple absorption rate. Like if department A is machine oriented, department B is labor oriented, department C is something else. So in that case, for department A you have to follow machine hour, for department B you have to follow labor hour. You cannot follow one method for across company. Like okay, entire company's overheads I'll be charging based on machine hour. You cannot do that. Now why can you do that? Why can't you do that? See, you need to understand this very, very carefully that this absorption rate ultimately decides selling price of your product. And selling price is something very, very vital that will, you know, that selling price is something that will be deciding the future of your company. If you come out with wrong selling price, you're going to be wiped off. Then, majorly the sums that are asked is calculation of machine hour rate for one machine. Like for machine A, for machine B, machine X, machine Y. Right? These are the kind of sums that are generally asked very frequently. In about 5 marks, that is question number 1, or if it's a bit lengthy sum, then they ask in question 10 as well. Now this is typically example of a department absorption rate, because we are not calculating absorption rate for the entire company. We are calculating absorption rate for one department of the company, right? That is where this calculation of machine hour rate for one machine typically comes into picture. Now, what are the things that you need to keep in mind? First of all, when solving the sum of this kind in exam, always look for time period first. How do you get, what do I mean by look for time period first? Like you got to be finding out that if machine hours are to be found, then you know how machine hours are given to you. Sometimes they give you that calculated absorption rate if machine hours are 2000 per annum. It means you have to do this entire sum on a per annum basis. Sometimes they say that machine hours are 400 per month. Then you got to be realizing that you have to calculate this absorption rate on a monthly basis. And once you realize that, calculate all overheads pertaining to that machine for time period decided in step 1. Like, what do I mean by this? Calculate all overheads pertaining to that machine for the period decided in step 1. Pertaining to that machine means if we are given the rent for the entire factory, then we cannot charge the entire factory rent to our machine. Then rent should be charged to our machine based on area. If question tells you that machine occupies 25% area, then charge 25%. If 20%, then 20%. Then if electricity you are given for the entire company, then based on light points, find out the proportion that our machine should be bearing. So that way, that is what I am talking about. Calculate the overheads pertaining to that machine. If it is given for the entire factory, entire workshop, whatever, relate to your machine, find out what is the cost that is bearable, chargeable to your machine, my dear, specifically specifically define that what is chargeable to your machine. Okay, then having done that, get the total overheads, divide by number of machine hours, and your job is done. So these are the major type of sums that are asked. You can refer to question 1, 2, 3, 4, 5 and all that in our Navkar books. You will easily get that. Okay. Now next thing that we need to consider in this overheads chapter is service department. Where in some there is a presence of service departments. Now, service or support departments are those departments which do not actually participate in revenue generating activities, but they help those departments which are part of revenue generating activities. Like in a textile company, the department which is manufacturing shirt is a production department because it is manufacturing the product that is want to sell, that is into revenue generating activity. Trouser manufacturing department, production. But if there is a maintenance department, now we do not earn anything by maintenance, but maintenance is needed so that production departments can function properly, right? So that is your typically service department. Now when there are service departments, the bigger question is, because the fact is service departments are those departments which are not having any product, because if they would be having any product, they would also be classified as a production department. So service departments are the department who do not have any product. And when a department incurs a cost, but has no product of itself, then the bigger question is, how will we recover cost of service departments? How will we recover the cost of service departments? How are we going to do that? That is something that we need to do. So for that, there are 3 steps that we need to follow. I show it in a table. Very quickly you will be doing it. So prepare a table like this. What we do? First of all, view column for service departments. Let's say there are 2 service departments, X and Y. Let's say there are 2 production departments, A and B. Then one column we keep for basis and one column we keep for total. Right? That's how it will be working. So this is the kind of table that we prepare every time when the sum of service department comes into examination. Then we have particulars over here, total over here, basis then we have 2 production departments, A and B, 2 service department, X and Y. Now, first thing, the basic contention of that we are working with is how to charge the service department cost of the product. So, to charge service department cost of the product, the first thing first, we need to know what is the cost that we need to charge. What is the total of service department? And for that, the first step that we do is allocation. I'm not getting into it. Allocation means what are the specific cost of service of all the departments, charge it to all the departments. Specific cost, charge it to all of them, right? Then, second step that we follow is, my friends, apportionment. Common costs which are common across all the departments, like rent. Rent can be common across all departments. So I'll be saying rent 10,000. Basis can be area, charge it to all the departments. Electricity can be a common expense. Based on light points, charge it to all the departments. Indirect labor, whatever. Indirect labor, the basis is going to be direct labor. Charge it to all the department, right? That's how we do it. Then we total this. we total it, and this total is something that will give us an idea about, okay, how much we need to charge, how much we need to charge to product as far as service departments are concerned. Now say for example, if 10,000 and 20,000 is the total of service department, then I know that 10,000 and 20,000 is something that I need to charge to my production department. And then the third step, an important step that comes in this journey, is reapportionment. In reapportionment, what we do is we transfer service department cost to the production department. We transfer service department cost to the production department. And there are three methods for reapportionment. Listen to this carefully, because these are also asked as a theoretical question that describe three methods of reapportionment of service department cost to the production department. They are asked as a theory question itself. Describe three methods for reapportionment of service department cost to the production department. So three methods, the first of which is going to be direct method. I'll be going at a very quick speed now. Now what do we do in direct method? If I am following direct method, this 10,000 will be charged to department A and B, say for example 6,000 and 4,000, and this 20,000 will be charged to production department A and B in the ratio of 16 and 4,000, and you have already done the sums. It is a rapid revision. You know these ratios are always given by question. So this is direct method, where each service department is independent of each other. So when this method is to be followed, this method is to be followed when service departments are independent of each other. When service departments are independent of each other, right? Like Y is not giving any of its cost to X, X is not giving any of its cost to Y, because they will not be giving the services to each other, they are totally independent. Then the third method that we follow is non-reciprocal method. Now what do we do in case of a non-reciprocal method? One line has just gone. Okay, I'll try it again. So my friend, when we are following a non-reciprocal method, say for example department X cost 10,000, I will be charging in the ratio of 5,000, 4,000 and 1,000 to department A, B and C. And now department Y will have to reapportion 21,000. It has to recover 21,000 because 20,000 was already there as its cost, and now 1,000 has been charged by X to it. So now 21,000, and now 21,000 I will be charging in the ratio of, say for example, just don't worry about numbers, just focus on what concept I am teaching very quickly. So it will be 16,000 and 5,000. This is, as you can see on the board, as you can see on the screen, is nothing but your second method, that is called non-reciprocal, or it is also called step ladder method. It is also called step ladder method. Right? If you want to do this, if you want to know how this sum is done, you can always refer to question number 13 of our Navkar book, and you will come to know how exactly this elaborative way. I am of course explaining it right over here. So this is non-reciprocal. Why this is non-reciprocal? Because department X is charging its cost to Y. It's charging its cost to Y, but Y is not reciprocating. Y is not reciprocating. Y is not giving its cost back to X, and that is why it is not reciprocating. So we call it as non-reciprocal method. So whenever you ask sum of non-reciprocal method, do remember that. In question number 13, if I just give you very quick and sharp recall, there are four departments, four service departments, P, Q, R, S. So now what will happen? P will give its cost to Q, to R, to S. But now when you are apportioning Q should not come back to P, it should give its cost to R and it should give its cost to S. Then when you come to R, It should not come back to this. No, just give your cost to S, right? That's actually working. So if you know this concept, you can get rid of it. Now, when non-reciprocal should be followed, so theoretically it is given that non-reciprocal method is followed when service departments are partly independent. Partly independent means department X is independent of Y in this case, because X is charging its cost to Y, but Y is not charging it back to X. So you can say that X must be providing services to Y, and hence Y depends on X. X is not getting any services from Y, because if it would have been getting any service from Y, it would have got the cost also. The logic is simple. If I take some service, of course cost will come to me. And if no cost of Y is coming to X, it means X is not receiving any service from Y, but it is giving services to Y. And hence this kind of partly dependent departments are following non-reciprocal method. And then the third and final and the last method that we have is reciprocal method. Now what will happen in case of a reciprocal method? I'll just remove this quickly. What will happen in case of a non-reciprocal method? Now, as you know, non-reciprocal means it was not responding back. In case of reciprocal, it will respond back. So forget about production department now, just focus on service departments. X is giving its cost to Y and Y will reciprocate, so Y will give its 2000 to X. Now, until and unless service department cost goes to 0, you cannot close that. You cannot just total and say, okay, sum is over. Because as we said, service departments do not have any product, and if they do not have any product, it is essential that their cost should go to 0. Unless and until their cost goes to 0, you cannot be assured that every cost will be recovered. Now, by going at 0 means the cost of service department have been transferred to production department. Once they have been transferred to production department, they'll become 0. They'll be charged to product, right? But over here it is not gone 0. So what you need to do? You need to reapportion 2000 again. So 200 will go over, 200 will go again. Say for example, 40 will go over. Again reapportion 40, 10 will go over, 10. So you have to do this, and that is why reciprocal method is also called as continuous distribution method. Now, conceptual part is, if you continuously keep doing reapportionment, your life will come to an end, but some will not. So what is to be done? As per our ICI, you have to end this sum on third cycle. That is, do reapportionment X and Y1, that is first cycle. Again X and Y, that is second cycle. And now when you come on third cycle, means this is your first cycle, this was your second cycle, and now when you reapportion 40, it's okay. If you don't give anything to department Y, just charge 40 to department A and B. Say for example, in the 2550, nothing to 0, and that goes to 0. Right? That's the thing that you got to keep in mind. And also, this is also called simultaneous equation method, because if you don't want to reapportion this 3 times, you can prepare a simultaneous equation. You can look at the percentages and you can get rid of it. And it is also called trial and error method. Right? That is also called trial and error method. So these are the things that you need to know about chapter 4. Now the next topic is treatment of under-over absorption. There are 3 methods for treatment of under-over absorption. That is also asked in theory question. Let's divide that very quickly. Now let's focus on learning treatment of under and over absorption. Now basically there are 3 treatments of under and over absorption. And again, before I get into treatment of under and over absorption, I would like to tell you one, that how under and over absorption can be calculated. So it can be calculated like this. First of all, let us take actual overheads, whatever you have paid, minus absorbed overheads. And how do we get absorbed overheads? We get absorbed overheads by multiplying actual level of activity with absorption rate. Actual level of activity multiplied by absorption rate, and that's how we get our absorbed amount. So this is your absorbed amount. We get this difference. Now, for the simplicity of understanding, I'll tell you this way, that if this amount is positive, we say that if it is positive, it is called under absorption. Right? And if it is negative, it is over absorption. Right, that's how you should be understanding it. Now, I'll explain it why positive is under absorption and negative is over absorption. So if you take it this way, if your actual overheads are 10 lakhs and absorbed are 9 lakhs, so if you want to understand this logically, you have absorbed less. 10 lakhs is actually, you should have absorbed 10 lakhs, but you absorbed only 9 lakhs, you recovered less, and hence the 1 lakh is called under absorption. And that's what I'm saying, that if this positive, actual minus absorbed, if this figure comes positive, you should be treating it as under absorption, and if it comes negative, then you should be treating it as over absorption. Like if actual paid is 10 lakhs, absorbed is 12 lakhs, so this 2 lakhs negative means you have recovered more, absorbed amount is more, that is why we get this negative, and that's why we call it as a over absorption. Now there are three treatments basically of adjusting the under over absorption, so I'll be explaining that. Let's again give me the heading, treatment of under over absorption. Treatment of under or over absorption. So broadly speaking, there are two treatments and there are three methods. The first treatment that we can talk about is, let me just do it a bit proper. The first treatment that we can talk about is, whatever is the under or over absorption, we'll be adjusting it in next year. So first treatment, if I had to speak about, it is adjust in next year, and that method, the method that we follow for this is called carry forward method. Like this is the simplest carry forward method, and your profit or loss of current period is not affected by this method, right? Let me write that as well. So how actually do you treat that? Now if you're preparing FOH account like this, assuming non-integral accounting system, so you would have recorded over here FOH to GLC, that is 10 lakhs. Now as we just read, FOH will be absorbed to WIP, say for example that is 9 lakhs. So this 1 lakh is your under absorption, and if I'm following carry forward method, I'll be writing by balance carried forward, right? And the one liner about this is no impact on profit of current year. That is something that you need to understand. No impact on the profit of current year. But now few authors argue that, okay, now someone might say that, sir, it is a cost of current year, why you want to transfer it to next year? Because my friend, I am into costing. I am not concerned with what is actual cost, what is under absorption, what is under over absorption or something. I am concerned with only one thing, how much has gone into my product cost. If someone tells me that Amit, 9 lakh has gone into your product cost, my job is over. I am just concerned with 9 lakhs, nothing else. Nothing else. I am only concerned with 9 lakhs. and that is why whatever is under or over absorption, I carry it forward to the next year. Now, moving on, the next part is adjust in same year. That whatever is that, you got to adjust in same year, and in adjust in same year we got two methods. The first method that we can discuss is adjust in cost of sales method, and also it is called costing P&L, right? So what is going to be the treatment? The treatment is whatever is under or over absorption is transferred. Oh my gosh, whatever is under or over absorption is transferred to costing P&L account, right? Whatever is the under or over absorption is something that you transfer to your costing P&L, and your profit or loss is directly affected by the amount of under or over absorption. Right? Then third method that we need to follow over here for under or over absorption treatment is, okay, first of all, before that, if you want to see the treatment of this, again, if I have to tell you in this, so actual overheads is 10 lakhs, WIP is 9 lakh. Now earlier I had written by balance carried forward if I was following carry forward method, and now I'll be writing by costing P&L over here, and it will directly get transferred to the costing P&L. That is your second method. So what will happen over here is your costing P&L will be adjusted in the same year by the amount of under and over absorption. That is why we say this method is adjust in same year. Okay, the next method that we follow is supplementary rate method. So in case of supplementary rate method, supplementary rate can be calculated like under or over absorption divided by actual level of activity. That's how you get your under supplementary rate, under or over absorption, whatever has been the under or over absorption divided by actual level of activity, like in this example which we are just taking, right? So if I have to find supplementary rate, my supplementary rate is going to be 1 lakh, and if I say divided by 9,000, right, 9,000 unit has been actually incurred, so 11 point whatever, 11.111, that is going to be a supplementary rate that will be charged to your product. Now supplementary rate, I've got the supplementary rate method. Then what will be the impact on P&L, right? So we can say that supplementary rate will be charged to all products and P&L will be affected by those units which are already sold. Guys, we have done the sums on treatment of under and over absorption, but still, very quickly, if I have to explain you, it can be like this. Like, you adjust the supplementary rate to all the products. Now, say for example, 9,000 units which are produced, you have charged it to this 11.1111. Now, out of that 9,000 units, 8,000 are already sold. 8,000 units are already sold. So whatever supplementary rate you charge to those 8,000, now the units which are sold are sold. You cannot recover any amount further after it has been sold. Yeah, those units which are in stock, you can add the cost, you can increase the cost of those units which are in stock, and you can increase the selling price as well. But the units which are sold, you cannot get anything recovered from that, and that is why we say this. Now, when each of this method is to be followed. So my friends, adjusting cost of sales method is followed when under or over absorption is due to abnormal reasons and supplementary rate is to be followed when under or over absorption is due to normal reasons. When under or over absorption is due to normal reason. And now, if you just recollect everything that we have studied in process costing, we learned that a normal loss should always be borne by customer and abnormal loss should be borne by company. And we are again reiterating with that same funda that look over here, when the under or over absorption is due to abnormal reasons, we are charging it to costing P&L, and when under or over absorption is due to normal reason, we are charging it to product. So concepts will remain same irrespective of which chapter you are into, right? So if you are asked, there are theory questions in this that describe 3 methods of treatment of under or over absorption. Yeah, if you have to describe 3 methods, it's okay if you don't write this like adjust in next year and same year. You can directly say first carry forward method, second adjust in cost of sales method, third supplementary rate method. It's all okay, job done and dusted, right? So that is how we are taking care of this overheads chapter. Now coming reverse order, we are coming to chapter number 3, which is labor chapter. So let's do chapter number 3, which is the chapter of labor. Now as far as labor chapter is concerned, few important things that you need to recall is, first of all, what are the types of wages system that we need to learn. So as far as types of wages system are concerned, there are 2 types of main wages system that we need to learn. One is a time rate system and second is a piece rate system. Now what is a time rate system? Time rate system, the system of payment where worker gets their payment, worker gets their wages based on the time. Like rates are going to be over here 10 per hour, 20 per hour, it is per hour. If you are here at the factory for 2 hours, you will be getting 20. If you are here at the factory for 8 hours, you will be getting 80. How much you have produced is not relevant, okay? And in case of piece rate system, you get your wages based on number of units you produce. Number of units that you produce, right? Now here your rate is going to be rupees 2 per piece, 3 per piece. So if you produce 100 pieces, you'll get 100. If you produce 300 units, you'll be getting into rate. So it depends on your work. Now what is the pros and cons of each and every method? As far as time rate system is concerned, the positive about it is, first let me talk about negative. The negative about time rate system is your efficiency is not considered. Like if I'm here for 8 hours, right? If I'm here for 8 hours, one worker produces 10 units, only 10 units, one worker produces 100 units. Both of them are at factory for 8 hours. One worker is producing 10 units, another is producing 100 units. Still, both of them will be getting same wages based on hours, right? So your efficiency is not considered in time rate system and workers may feel demotivated. Now in piece rate system, workers efficiency is definitely considered, because if in 8 hours I produce only 10 units, I'll be getting wages for 10 units. If I produce 100 units, I'll be getting wages for 100 units. But the issue over here is to get more wages. To get more wages, workers will start to compromise with the quality. That is the issue with piece rate system. So that's time and piece rate system for you. Now these are basic wages system. Now what are the bonus systems? So let's talk about bonus systems now. Now again, bonus system can be divided into two parts. One are the bonus systems that you can apply when you are following time rate system, and few bonus system you can apply when you are following piece rate system, right? So when you are following time rate system, you can follow two main bonus system which are asked in your examination. First is ACCA and second is going to be Rowan. So these are two main bonus systems that are generally asked in examination. Based on this you get your sums. Okay, now how to calculate bonus as per ACCA system? So as per ACCA system, bonus is going to be 50% of time saved multiplied by rate per hour. Now how do we get time saved? Time saved is time allowed, say for example 8 hours, and time actually taken for the production is, say for example 5 hours. So we can say that 3 hours are saved, right? This is time saved. So the simple concept of ACCA was, if you are paying your worker at the rate 20 rupees per hour, right? 20 rupees per hour is what your payment rate is. So if you allowed 8 hours for 1 unit, right, it means you are ready to pay 160 for 1 unit, but he completed the same job in just 5 hours. So obviously he'll be getting salary for only 5 hours, 5 hours at the rate 20, 100. So effectively he has saved your wages for 3 hours, and that is 3 hours into 20, so 60. So the simplest logic ACCA had was, if your workers are saving for you, they should be getting part. And the simplest formula that ACCA said was, okay, whatever is your saving, 50% give it to bonus, 50% you keep, everyone is happy. So we say 50% of time saved into rate per hour. Like if I check over here in this same, 50% of 3 multiplied by 20, so it will be 30 rupees. As I said, 60 rupees was saved, 30 rupees you pay to worker, and 30 rupees you keep. Both are happy and both are in a win-win situation. Organization is also in a win-win situation, and so is the employee, because they are also getting motivated, they are also getting benefit because of their efficiency. That's one thing. But there are certain issues that popped up with ACCA system. Let me tell you that. Now what I'm going to do is I'm going to preparing a table very quickly to show you certain limitations of ACCA Rowan and to teach you something else as well. Just give me a moment, friends. Oh my gosh, I don't know why it is not working. Just give me a moment. Yeah, finally it worked. So now what I'm going to do is, time allowed for a job is 8 hours. And I'll be making few calculations progressively for each hour saved progressively, right? Means first I'll be taking 8 hours, then 7 hours, then 6 hours, then 5 hours, then 4 hours, and so on and so forth. So let me prepare some columns. This column is if I take only 1 hour, if I take 2 hours, if I take 3 hours, if I take 4 hours, if I take 5 hours, 6 hours, 7 hours, and 8 hours. So time allowed in entire sum is 8 hours. Now let's talk about time taken. So first I'm assuming he has taken 8 hours, then 7 hours, then 6 hours, then 5 hours, then 4 hours, then 3 hours, then 2 hours, and then 1. Control yourself, don't go to 0, please control yourself. Okay, 0 is Superman, you can do that. Now let's calculate time saved over here. So 8 hours is time allowed, 8 hours is taken, so time saved is 0 hours. 8 hours allowed, 7 hours time taken, so you'll be saving 1 hour, 2, 3, 4, 5, 6, and 7 hours have been saved. Now let us first calculate basic wages at the rate rupees 20 per hour. So over here he has taken 8 hours, so he'll be getting 160, 7 hours, so he'll be getting 140, 6 hours at the rate 20, he'll be getting 120, then 100, 80, 60, 40, and 20. That's the basic wages. To that, now let's start calculating bonus. If I have to calculate bonus as per health system, it is 50% of time saved multiplied by rate per hour. 50% of time saved multiplied by rate per hour. So here there is no bonus. Now here in case of a second column, time saved is 1 hour into 0.5 and into 20, so my bonus is going to be 12. Then 2 hours saved into 50% is 1 into 20, so my bonus is going to be 20. 3 hours saved, so 3 into 50%, that is 1.5 hours bonus he will get, and 1.5 hours at the rate 20, so he'll be getting bonus of 30. Then 4 hours saved into 50%, that is 2 into 20, the bonus he'll be getting is going to be 40. 5 hours saved, so 5 into 50% is 2.5, and 2.5 into 20 is going to be 50. If time saved is 6 hours, 6 into 50%, 3 into 20, your bonus is going to be 60, and 7 into 50% is 3.5 into 20, so your bonus is going to be 70. Now if you notice one limitation over here. Now what is the limitation of piece rate system? We said in piece rate system that in order to earn more, worker may start compromising with quality. Now if you follow health system, same issue is still there. Same issue is still there because look, his bonus is continuously increasing. 0, 10, 20, 30, 40, 50, 60, 70. So to get maximum bonus, again he'll be starting to compromise with quality, and the same issues might again pop up. So for that we need to, we can follow Rowan system. Formula for Rowan bonus is he takes the proportion of time saved upon time allowed. Right, simple proportion, and simple thing that he has done, the simple brain that he has applied is he multiplied it with basic wages instead of rate per hour. See, understand this. What happens in case of Rowan? 50% of time saved. So as time saved increases, your bonus increases. In case of Rowan, if you just understand this much, which I have highlighted with yellow, time saved upon time allowed. So again, as the time saved will increase, this proportion will increase. But the smart thing that was done by Rowan is he multiplied it with basic wages, because what will happen with that? Your rate per hour will remain constant as per I'll say, but basic wages will keep reducing. Okay, let's see this same table how and what will happen if I calculate the wages as per Rowan system in this. So bonus, let's calculate as per Rowan system. Okay, so as per Rowan system, the bonus is going to be time saved upon time allowed into basic wages. I'll not be putting any number, I'll be calculating on Calci. Here of course bonus is going to be 0. Then 1 hour saved divided by 8, so 1 by 8, and his basic wages are 140. That's the reason I had calculated basic wages over here. So that is going to be, my bonus is going to be 17.5. Then 2 by 8 into 120, that gives me bonus of 30. 3 by 8 into your basic wages is 100, so I get 37.5 as my bonus. Then 4 by 8 into 80, so I'm getting 40 rupees as my bonus. Then 5 by 8 into 60, so my bonus is 37.5. Then 6 by 8 into 40 rupees, so I get my bonus to be 30. And last 7 by 8 into 20, so I'm only getting bonus of 17.5. So if you're noticing that your bonus is increasing up to you save 50% of time, but if you're saving more than 50%, then probably Rowan was thinking that if you're saving more than 50%, means time allowed was 8 hours, but you are able to complete the job within 5 hours, so your time saved is higher than 50%. You are able to complete the job within 6 hours, 7 hours. You are able to complete the job within 3 hours, 2 hours, 1 hour, right? When your time saved is 5, 6 and 7 hours. Time saved is more than 50% of time allowed. Rowan believes that now you are compromising with quality. Okay? And the reason I did this table was, you're also asked this question theoretically, that bonus paid under Rowan system will be equal to the bonus paid under Halsey system at 50% of time saved. This type of question is coming to examination, and if such kind of question comes, you can prepare this kind of table, right? So that is about Halsey and Rowan system. Now there's one more thing that I can and I have to teach you is effective hourly rate. Sometimes you are asked in examination, calculate effective earning rate or effective hourly rate. So effective hourly rate can be calculated like this. Let me calculate total wages over here so that I can calculate effective hourly rate. Total wages is going to be basic plus bonus. So over here it is 160. First I am calculating as per Halsey. So it is 160, no bonus, whatever is the basic wages paid. Now at 7 hours time worked, time taken, your basic wages is 140 and Halsey bonus is 10. So it is going to be 150. And how you get effective hourly rate? Effective earning rate or effective hourly rate, if you want to calculate, it is going to be total wages divided by time taken. Right? You earned 150. For how many hours? You earned 150 for 7 hours. So when you do this, 150 divided by 7, you get your effective earning rate to be 21.43. I'm just keeping it to 2 digits. I'm sorry. Then at time taken 6 hours, your basic wages was 120, bonus was 20. So 140 and 140 divided by 6 gives you effective earning rate of 23.33. At 4, your basic wages was 100, bonus was 30. So you got 130 and 130 divided by 5. Your effective earning rate is 26. So sometimes you are asked this, right? Effective earning, so you can calculate it this way. I just complete the table. I'm not going to be calculating for Rowan. Rowan you can calculate same way. Basic wages plus add bonus as per Rowan concept, and then whatever the total wages comes divided with time taken, and you will be getting your effective earning rate. Okay, just let me complete this. So over here 80 plus 40 is going to be 120, and 120 divided by 4 will give you 30. Then we've got 60 plus 50, 110. And 110 divided by 3 gives you 36.67. Then next is 60 plus 40, 100. divided by 2 gives you 50, and 70 plus 20, 90 divided by 1 is going to be 90. So his effective hourly rate has gone up like anything, it's shot up like anything, right? Same way you can calculate as per the row 1 hours. So this is a basic wages payment system. There are two basic wages payment system, time rate and piece rate. As far as bonus systems are concerned, there are two bonus system when you're following time rate system, that is, I'll say row 1. We understood the limitations and all. These two systems are asked more often than not in examination in 5-mark question. There are some theory questions also that we learn. Now, as far as bonus systems on time rate system are concerned, piece rate system are concerned, there are a few bonus systems that exist on piece rate system like Taylor, Merrick, Emerson, Gantt-Task. Emerson is actually combined, but Taylor, Merrick, Gantt-Task, Bad-Exploit system and all that. Now, when you will go through your study material, all these methods are there, Taylor, Merrick, 100%, 125% and all that. But my friend, you are not supposed to do that. Last year November examination, when November examination was approaching, November 2019, our Honorable ICA has come out with a notification regarding what are the things that will be excluded from the syllabus that attempt onward. And in that notification, it was mentioned that all the system, Taylor, Merrick and all that are excluded from the syllabus. So probably if you've got old study material, it can still be there in your book, but you are supposed to ignore it. Don't worry about it. It will not be asked. Okay. Then few more things that we need to learn in wages chapter is overheads, or treatment of overheads. This is also asked in theory questions, that what is going to be the treatment of overheads, I'm really sorry. Treatment of overtime is what I'm talking about. Let me write over here. Treatment of overtime. First of all, what is overtime? Overtime is, now say for example, your normal working hours a day is 8 hours. But if your workers work for more than 9 hours, it's your policy that if a worker works for more than 9 hours, 1 hour here there, it's okay. But if your worker works for more than 9 hours, he'll be paid, okay. So greater than 9 hours, he will be paid overtime premium at the rate 50%. So when this kind of things are given to you, that when he works for more than 9 hours, his overtime premium will be 50%. So up to 9 hours, he'll be getting at the rate 20 per hour, the basic wages. And after 9 hours, he'll be getting rupees 30 per hour. 20 basic, that is something we have to pay in any case, plus overtime premium of 50%, so 10 rupees of premium, and that's why I'll be getting 30. Okay, before I discuss the treatment of overtime, there is something that is mentioned in the book of our ICA, and that is overtime as per Factories Act. There is one sum also that workers are paid bonus as per the Factories Act. So if nothing, see, first of all understand that overtime a company can decide as per its own. Like if company is very liberal and says that okay, the moment workers exceed 8 hours, I start paying him overtime. Right? So company can have its own overtime payment system, but if nothing is given, or it is given like companies following Factories Act, then let me tell you the limits of Factory Act. As per the Factories Act, overtime premium is applicable when on any day worker works for greater than 9 hours, or in any week worker works for more than 48 hours. So in that case, the overtime premium becomes payable and you got to calculate it, right? So that's how factories act worker will be working. There is one sum also in the study material which you can get and solve, and the sum goes like this. Normal working hours are 8. That's where students get confused. Normal working hours are 8, but overtime are paid at per factories act. So there you have to take that 8 hours is normal, but if 1 hour here and there, it's okay. We will start paying you overtime after 9 hours. Okay, so that's how it will be working. Now, overtime can be of 3 types, or there are 3 different treatments of overtime. First of all, if overtime is done at specific request of a customer, like a customer comes and tells you, oh my gosh, I want this early, please get me done this as fast as you can, then in that particular case, that overtime premium shall be charged to that job. Okay, overtime premium to be charged to that job or to that customer, to that job or customer. Okay, then second, if overtime is done regularly, if overtime is done regularly, just to give you one example. Now, say for example, I am working with Navkar Digital Institute at the rate for 8 hours a day for Monday to Friday. Monday to Saturday. I have to give 8 hours per day, Monday to Saturday. But now, we believe in best, as our logo says, as our tagline says. We have lectures on every Sunday. Of course, we are given option whether you want to take or not, but if you take, then every Sunday you take a lecture. And say for example, if I am taking lecture on every Sunday, so this is something I can say that overtime is done regularly. Overtime is done regularly. In that particular case, overtime premium should be added to direct wages and product costing should happen on inflated wage rate. Right? Product costing should happen on inflated wage rate. Now, inflated wage rate means, if say for example, I am expecting that normal hours during the year is 1 lakh. So 1 lakh at the rate 20 is going to be 20 lakhs. Okay, and overtime hours, which I normally do, is 20,000 hours, for which I'll be paying at the rate 50% premium if I am paying. Then 20,000 into 30 is going to be 6 lakhs. So total 26 lakhs divided by 1,20,000 is 26.6667. This is what I call it as inflated wage rate. And whenever you are calculating the cost of any product, any unit, any job, your wage rate you should consider as 21.6667, because you normally do overtime, you are paying it, so now inflate your wage rate. That's how you need to do if overtime is done regularly. And the last treatment that you can do is if overtime is not done regularly. Like if you are not doing it regularly, but also it is not at the specific request of a customer. Like say for example, if you are a mask manufacturer, if you are a sanitizer manufacturer, you do not do overtime regularly, but this is exceptional circumstances and you are doing overtime to produce more. Now you are producing more masks, more sanitizers, not at the specific request of any customer, right? So if this is the example of if overtime is not done regularly, then what you need to do? Then basic wage should be considered as wages and overtime premium should be charged to overheads. Like if I explain in this example, now this is what this treatment is if overheads is done regularly. Sorry, overtime. If overtime is done regularly, so you inflate the wage rate. But if it is not done regularly, then what you do? For this 1,20,000 hours, 1,20,000 hours at the rate 20, 24 lakhs is something that you'll be charging to wages account. And overtime premium, only premium component, that is 20,000 hours at the rate 10. No, I'm sorry. Yeah, 20,000 hours at the rate 10, and that is going to be 2 lakhs, is something that you charge to overheads. So that is treatment of overheads. There is one sum also in the study material on this, and it is asked in theories as well. So probably this was the last thing that I had to teach you about treatment of over absorption. Yeah, few more things is idle time. What is idle time? Idle time is definitely typically a worker is in the factory but is not working. That is what we call it as idle time. He is free. Now idle time can be of two types. One, it can be a normal idle time or it can be an abnormal idle time. What is an example of normal idle time? So my friends, normal idle time can be lunch break, tea break, time for personal needs. Normal means expected. So if we are hiring a worker, we know that he'll be taking lunch break, he'll be taking tea break, there'll be time for personal needs as well. That is normal, my friend. And what is abnormal? Which we are not expecting. Like, you know, in Ahmedabad, when I'm recording this video, we never expect power cut. But if there's a power failure, it is abnormal idle time, right? If say for example, power failure happens now, I cannot record video further and I'll be sitting idle, but still I'll be paid. That is abnormal idle time, right? So these are the things that you need to think about as far as your labor chapter is concerned. And let's come to the second chapter, second last chapter in this series of rapid revision, and that is chapter number 2, that is of material. Okay, so for materials, my friend, basically we have to answer two questions. Only two questions we have to answer as far as material is concerned. Okay, one, first question that I have to answer is how much to purchase. And second, when to purchase. How much to buy and when to buy. That's it, right? Now, when we talk about how much to purchase, there are two questions that we need to answer in how much to buy. How much to buy for the year. And next question is how much to buy at one time. Now, when we want to answer the first question, that how much to buy, how much to purchase for the year, typically what you should do is you should be preparing a purchase budget. Prepare a purchase budget and you will come to know how much you got to buy for the year. And when you want to think about how much to buy at one time, the answer to this is you should buy that much that minimizes total of carrying cost and ordering cost. Now there are two costs which are being incurred at the time of purchase of material, right? One is going to be carrying cost and one is going to be ordering cost. So it goes like this. Like, how do you incur ordering cost? Now, okay, I'm putting cost over here and I'm putting units over here. Say for example, your annual requirement is 10,000, which we will call it A in this chapter. If I just go and order 100 units each time, then 100, 100, 100, 100, 100. The less I order, my ordering cost will be more because I have to place more number of orders. And say for example, if I buy 10,000 at one go, boom, then my ordering cost will be minimum. So your ordering cost line can be like this: less units, highest cost, highest order at one time, right? Units, order, one time. You got the least cost. So this is the line of ordering cost. An exact opposite is the carrying cost. Now, what is the meaning of carrying cost? Carrying cost is the cost of carrying inventory. It can include storage cost, it can include handling cost, and it can include the cost that you incur on the working capital. Like, if say for example, I purchased 10,000 units at one go, you thought that, okay, let me save some ordering cost. So you purchased 10,000 units at one go and the purchase price of this was 500, right? So 50 lakhs is something that I have to pay upfront. If, understand this, okay, somebody might say, sir, we get 2 months credit, but it's okay, brother, 2 months. But the point over here is, if I'm producing 100 units, then I'll produce and I'll buy 100, I'll sell, I get money, I pay, I get money, I pay. If I buy 10,000 at one time, I'm not going to sell 10,000 at one time. So 50 lakhs is something that I have to pay, my capital will block. And as you would have studied in FM, your FM part, that capital always carries a cost, that is also included in carrying cost, right? So carrying cost line will be something like this. The less you order, less will be your carrying cost. And where these lines intersect, this is the quality that you should, this is the quantity that you should order, and that is called EOQ, economic order quantity, right? That's how you get your EOQ. See, in life, if you try to minimize your ordering cost, your carrying cost will reduce, carrying cost will be maximum. Like here, my ordering cost is minimum, but carrying cost is highest. Vice versa. If I try to reduce my carrying cost over here, so I have to buy small quantities and my ordering cost will be highest. You cannot have both of them. So where your total cost is minimized, ordering cost plus carrying cost, that is, the cost is minimized, it is economic, and hence it is named as EOQ, and that is what we call it as economic order quantity. It is called EOQ. The formula is going to be under root of 2AO divided by C. That we can have derivations of it, but presently we are not going into it. In your detail session, you would have taught this, So I'm not getting into the derivation part, but typically you can say ordering cost is equal to carrying cost, and you can get this. So what is A? A is your annual requirement of material that you would have got from your purchase budget. O stands for ordering cost, and my friends, C stands for carrying cost, but this is something that you need to calculate carefully. It is per unit per annum. Your carrying cost is per unit per annum. That is how you need to calculate your carrying cost. So under root of 2AO divided by C, you got to calculate your EOQ like this. These are the sums that more often than not is coming into examination. Like few more formulas that I want to teach you is how to calculate ordering cost. So formula for calculating ordering cost is going to be A by Q into O. A is the annual requirement. Like say for example 10,000 is my annual requirement. I'm ordering 1,000 each time. So typically I'll be placing 10 orders and into 200 rupees per order. So into 2, and that's how, my friend, we get this formula of ordering cost A by Q into O. Now how do this is something that you need to know, because you will be asked to calculate the total cost. Okay, then how to calculate carrying cost. The formula for carrying cost is going to be Q by 2 into C. Q is the quantity ordered, or it can be EOQ if you are following EOQ system. Q by 2 into C. Now what is the logic of Q by 2? The logic of Q by 2 is, now today if you purchase 10,000 units, your capital is blocked on full 100,000 units. So logic of Q by 2 is like if I was saying that if I have ordered 1,000 units, 1,000 quantity today, my full money is blocked on 1,000. But today I'll sell, say for example, 50 units. Tomorrow I'll sell 50, 50. So moment I keep selling, moment I keep using the material, right? It goes into the next process and my investment in material reduces. At the end, it will go to 0. So with that, today is my Q, last day is going to be my 0. So, you know, if you look at the stock chart, it will be like this. Today is the quantity I purchase, consume, I order, consume, I order. So that is how, you know, I get Q by 2. So that's how you need to calculate carrying cost, and this is your EOQ formula under root of 2AO divided by C. O is calculated by A by Q into O, carrying cost. C is calculated by Q by 2 into C. Now, what type of sums you are asked? First, generally you are asked part 1, calculate EOQ. So that is something that you need to do. Okay. Second, this is generally asked if supplier is ready to give 5% discount if, say for example, they'll give some quantity is purchased at one time. Should the offer be accepted? That is what generally you are asked. Should the offer be accepted? Right. If you have to answer this, should the offer be accepted, then the costing FM, both the subjects are really simple for us. Whenever we are asked anything in costing or FM subject, the ultimate answer is going to be, if it benefits me, I'll accept it. If it results in more cost, higher cost, I'll be rejecting it. That's the simplest calculation of all. So now what I'm going to do, I need to calculate total cost at both the level. First, at EOQ and at if offer is accepted. Right, that is something that you need to do. Then calculate the total cost in this tabular format. Have this format only, it will always give you right answer. First, take up the purchase price. At EOQ, there will be no discount. If offer is accepted, there will be discount. Second, take up ordering cost by the formula. Which formula? A by Q into O. So calculate your ordering cost by that. And third, calculate your carrying cost with the formula Q by 2 into C at both the places. Just take the total cost, and wherever the total cost is minimum, if total cost is minimum, if offer is accepted, we will accept the offer, we don't mind. Now, one important point where students go wrong is something that I want to tell you. So let me give it to you as a form of note. First, if carrying cost, this is important, right, is given in percentage terms. If carrying cost is given in percentage terms, where you do mistakes, that is what I'm going to tell you. It is totally practical out of experience. Nowhere written in theory. It is practically out of experience, right? Like, say for example, if you're given that carrying cost is 2% per annum. Now, how you would have calculated, in your part 1, that is calculate EOQ, you would have calculated your carrying cost, like if it is 2% per annum and your purchase price is 200, so 200 into 2%, you would have calculated 4. At the time of calculating EOQ only, you would have calculated this 4. Then again you use this carrying cost over here, like Q by 2 into 4, whatever it is you put in the EOQ section. But now, very important thing is, if discount is given, by supplier, don't forget to change carrying cost on new price. Okay. Now, if supplier is giving you 2% discount, 5% discount, your original purchase price was 200. Now, if he gives 5% discount, now your price will be 190, and my friend, you have to calculate 2% on 190, and that is going to be 3.8. This is where major students go wrong. They just forget to change the carrying cost. But I am sure you will not do this after watching this video. So, if with this video we can correct this small mistakes, it's really worth. Okay, that's about EOQ and all that. Now, answering to the next question, when it should be purchased, that is something we understand by understanding the concept of reorder level. Or it is very popularly called ROL. Now, the formula of ROL is going to be maximum consumption into maximum lead time. Maximum consumption into maximum lead time. Now, what is the logic behind taking this maximum consumption into maximum lead time? The simplest logic of this is, typically an organization thinks, when should I order? So when you ask an organization when you should order, the simplest question is, order in such a way that there is absolutely no stock out. Stock out means I got to be answering this very firmly. I got to be assuring that any day I would want to see in my factory where I want to produce the things, I told my manager that, okay, give me material I want to produce, and he says, oh my gosh, sorry, there is no material, you have to wait for a few days. That is something I never want. So what do I do then? I look at my maximum consumption. Okay, how much can I consumption on a daily basis? So someone said 100 kgs max. In the history of company, it has never gone beyond 100 kgs. Okay, how many days maximum it is taken by supplier? Someone answered 8 days. Normally he delivers in 5 days. Say for example, normally he delivers in 5 days, but max worst to worst cases till now he has taken 8 days. So okay, my reorder level is going to be 800 kgs. When my stock level reaches to 800 kgs, I'll be ordering that, because I don't want to see stock out any day in my life. Now if I order at 800 units, let my supplier take maximum time, let me consume maximum units, and still I'll not be running out of stocks. But there is a second formula also of reorder level, and that is, see, issue with max consumption into max lead time is the carrying cost is very high. Okay, why? Tell me this way. So tell me, what is the probability that you will be consuming maximum? Someone will say very less, sir. Okay, next question. What is the probability that your supplier will take maximum time? Okay, so very less. Generally 95% times he gives me in five days. Okay, so probability of you consuming maximum is less. Probability of supplier taking maximum time is also less, and this is not over. Next thing is, what is the combined probability that when you are consuming maximum, at that time supplier is taking maximum time? What is the combined probability of that? Very less. So because of that very less probability, hardly few fraction, you order at a really high level and you incur carrying cost, because your stock levels are going to be high, so you incur high carrying cost. So to avoid that high carrying cost, now we are shifting to more probable things, and that is average consumption, that is usually you do, and multiplied by average lead time. So this is the formula that we would love to follow. That okay, how much do you average usually consume? So someone says, okay, I consume 50 units. How much it takes? 50. Okay, order at 250. But then someone might ask you a question that, okay, if you're following average into average, what if someday you consume more? What if he takes one day more? You'll be running out of stock. So it's okay. For that, we keep safety stock. Keep some buffer stock always with you, and then follow average into average. That will reduce your cost, right? So these are the two formulas that you need to follow for ROL. It depends upon what data you are given. If you are given safety stock data, then it is a hint in examination that you got to follow this formula. And if safety stock is not given, then you have no other option but to follow max into max lead time and calculate by that way. Okay. Now, then we are generally asked maximum level. Now maximum level is going to be the max level immediately after the stock, the order has arrived. See, when you will be having maximum level, simply when you have ordered something has arrived and before you start consuming, that will be the maximum level. If you take 1 unit out, that will be a bit lower than maximum, right? So how do you get maximum level? This is important to know because you want to know your warehouse capacities, that at what point of what is the maximum quantity I got to accommodate, and I need to have my warehousing capabilities accordingly. So it will be like this. You ordered at ROL, whatever is your ROL, average into average or whatever. You ordered at ROL. Now I want to see the maximum what can be my stock level. So I ordered at ROL, then what happened is I was consuming minimum, and supplier also took minimum lead time. So minimum consumption into minimum lead time, say for example 2 days into 25 units, so that got subtracted. I ordered at ROL, bit came down and then order came, so I'll be saying plus ROQ. See, important thing I want you guys to note over here is, over here I am not saying EOQ, I am saying ROQ, reorder quantity, because your ROQ can be EOQ or it can be different if supplier is giving you some discount. Like just now we checked that if supplier was giving me discount, I was ready to purchase what he was telling me because still I was getting benefited. So here you have to use ROQ and not the EOQ. If EOQ and ROQ are same, it's different, it's okay, right? But if there are discounts, if there are some under conditions and you're ordering different than your EOQ, then it should be ROQ, right? So that is your maximum level. Now next is we want to check minimum level. Now where there will be minimum level, logically before the order arrives there will be minimum level. Once order comes, your level goes high, shoot up. So before immediately the minute before order is arrived is going to be your minimum level, and accordingly it will be at ROL minus average consumption into average lead time. Okay, now few people have got doubt over here that when you are calculating max consumption, you are saying minimum consumption into minimum lead time. Why are you taking average over here? Because if I take maximum consumption into maximum lead time, then minimum level is always going to be 0, but that is not the case, right? I want to look at the practical minimum level, because if I take maximum consumption into maximum lead time, then minimum level is always going to be 0, because then ROL, it will be ROL minus ROL, because ROL formula is maximum consumption into maximum lead time, right? That is high. That's why I take average consumption into average lead time. And last and final thing that you can be asked is average level. So average level is going to be maximum level plus minimum level divided by 2. That's how you need to understand. Okay, next thing, next type of sums that are generally asked is calculate safety stock. Like in ROL formula 2, we say that it is safety stock plus average consumption into average lead time. Then the question arises is how much safety stock to keep? How much safety stock to keep? Then again the answer is where my cost is minimum. See, costing and FM has got very simple answers. What thing to be done in costing? Answer is where your cost is minimum or where your revenue is highest. Same goes in financial management, paper number 8. Which option, which machine to be selected, where profit is highest. Simple. Be a logical businessman and you will get everything right. Okay. So now what will happen is, say for example, we say that, I'll just tell you one way and then you can follow the rest of the things. If say for example I keep 0 safety stock and I'll tell you the way in which you need to calculate safety stock. And if demand of 600 units will arise, I'll lose the contribution on entire 600 units because I have 0 safety stock during that period. And we are talking about during that period only. So if my contribution is 20, right, so 60 into 20 is going to be 12,000. But the probability of this is only 0.1. Say for example, there is 10% or not even 10%. There is only 1% probability that demand of 600 will arise during that stock out time. So I'll be losing 120 effectively. Now what if demand of 500 arises? So into 20, it is 10,000 and this probability is 5%. So I'll be saying 500 is my loss if 500 demand arises. Right? And if 300 demand arises, if the demand of 300 units arises, then I'll be losing 6,000. And the probability is, say for example, 10%, so 600. 200 units demand coming, so I'll be 4,000 and into again let's say 10%, so it will be 400. So that's how you calculate how much maximum you can lose, right? And then let's total this. So we say that 600 plus 400, 1000, 1500 and 1620 is the maximum loss that I'll incur. Someone might say, sir, why are you totaling? Beta, because I've already taken probabilities over here. And what is going to be my carrying cost? my carrying cost is going to be nil because I am not keeping any safety stock. So my total cost is 1620. Okay, now let me just take you extreme example. Then you have to check level by level. What if I keep a safety, say for example, buffer stock of 200, safety stock of 200? Then now it is important. Now if you are keeping a safety stock of 200 and if demand of 600 arises, you will be losing contribution only on 400 because 200 you will be able to save with your buffer stock. So I'll be saying 200 into 28,000 and into this probability 0.01. Please take probability of 600. Please, some students just take over here from 400 and they pick up there. No. Now what if the demand of 500 units arise? If demand of 500 units arise, it's okay. I have 200 with me and I'll be losing only contribution on 300 units. So 300 into 26,000 and multiplied by this probability 0.05. Then what if 300 units demand arise? I'll be losing only contribution on 100 units. So it will be 2000 into the probability of 0.10. Now what if 200 demand? It's okay, I'll not lose anything. And what is going to be my carrying cost? This is the most important sentence. Most important point is coming now. Over here, carrying cost is going to be 200 into, say for example, your carrying cost is 420, so it will be 4000. So take this total, and say for example, if it is just take any number, and wherever this number is lowest, that is the safety stock that you should keep. Now I said over here that this is the most important part. Why? Because I taught you the formula of carrying cost to be Q by 2 into C, and here I am not dividing it with 2 because, my friend, we are talking about safety stock. How safety stock happens? Like this. Understand this chart and you will understand this very, very clearly. See, there is one condition. When you are not keeping any safety stock, it will be like this. You order this, go to 0. Order this, go to 0. Order, use. Order, use. So we say Q by 2. But my friend, when you keep safety stock, your chart should look like this, my dear. A safety stock, a buffer stock will always be there. 200 units, say for example. It is always going to be there. Then you order, consume, order, consume. So for this part, it's okay. You say Q by 2, but this, there is no need to take average. It is going to be there always, and that is why I do 200 into 220. And my friend, this sum is not about carrying cost. This sum is only about safety stock, right? This is the mistake that usually people do. So that is what you have to understand. And then few more things about material chapter is you got to prepare store cards. You are asked to prepare store cards as well. So store card should be in this format, date, or you can take up something like this. Something like you're going to take date, then receipts, then we have got issues, and then we have got balances. And within each column you have 3 columns every time: quantity, rate, amount, quantity, rate, and amount. Okay. There are FIFO, LIFO, weighted averages. You know that, so I'm not getting again into it, but just keep it in mind. Store cards. One note I would like to give over here is, where students commit mistake. Whenever in exam you are asked some on preparation of stock cards, first thing first, what you need to do is arrange transactions in the order of dates. That is the most important thing that you have to do. Okay, what are we talking about is, you can be given transactions like this. I've solved one sum in recent MTB, so this is the important note I want to give you, that you are given transaction about purchases, and then you're given dates like October 10, October 20, October 25, 28, like this. Then you are given data about issues separately, and the data on issues is say for example October 8, October 17, 24, 28. Now it is very important and essential for you. The first thing that you got to be doing, my friend, is arrange this orders in date. Like what you should be doing is, first transaction is going to be October 8, then second transaction is going to be October 10, then we have October 17, then we have got 20, then 24, then 25, then 28, 28. It is the most important thing, my friend, because like say for example, before issuing this 24 is issue, okay, if you do not record this transaction of 28th by mistake, and you know that if you are following weighted average, now say for example your balance was 6,000, 20 and 1,20,000. On 28th you purchased 2,000 units at the rate 22. So 2,000 into 22 will be 44,000. Now what if you do not take, so if you take average, let me say first, so it will be 8,000, balance will be 6,000 was there plus 2,000. In case of weighted average method, I'm following average method, okay, and then 1,20,000 plus 44,000 is going to be 1,64,000, and 164 divided by 8,000 is 20.5. So my friend, average has changed. Now when you issue 3,000 units, it will be issued at 20.5. But if you do not pass this entry of 28th and directly issue, you will be issuing at 20. If you understand, you will be issuing at the rate 20, and then henceforward all your averages and all sum will go wrong. And then in exam, when you are already running out of time, and you do this cancellation, it will become so messy that you will get confused, a lot of time will be wasted, and you will start feeling frustrated. Just make sure this doesn't happen to you, right? So this is the last thing that I had to tell you about this material chapter. And now we move to the last chapter about this, and that is chapter number 1, that is all about theory, right? So let's talk about chapter number 1 now. So let's very quickly revise the last chapter that in this video, and that is chapter number 1, which is the basics of cost accounting, right? Chapter number 1 is basically your theories, right? It's all about theories. My friends, theories are very important part of your chapter, of your costing paper. It will carry approximate 20 to 30 marks. Right? 20 marks is bare minimum you can consider, considering the last question, question number 7, that you can count on theories and plus some other theories. So chapter number 1 is all about theories, and as I said that it can carry 20 to 30 marks. So of course you cannot take risk with theories. Also, my friends, I would advise, some people tell me, some students tell me that, sir, if we can take theory in option, like if you look at your paper style, question number 1 is compulsory, but from question number 2 to 7 you have to answer any 5, right? So student asked me, sir, if we can take theory in option, why should we do that? My friends, I would always recommend that you should prepare theories more. I mean, you should be opting for theories rather than sums, because in sums, if you do a minor mistake at a crucial stage, you can lose big marks. In theory, you cannot lose big marks, right? So theory has that added advantage, and in sums, you do not know which kind of sums can come. If something tricky comes and you have not done theory at all, then you will be losing your 40 marks, because one 20-mark question theory that you have not done, and one tough question that you don't know, so you will be losing 40 marks, and then you will be in deep trouble, right? So always prepare theories, and I would prefer theories over sums, honestly speaking. Now, few clarities before I start with chapter number 1. First, theories are there in chapter number 1, but it's not there in only chapter number 1. Chapter number 1 has theories, but theories are there in other chapters as well. Like in this video also I have spoken about like discuss 3 methods of reapportionment. Overheads, it's a theory question. Discuss treatment of under overabsorption, it's a theory question. Discuss reconciliation statement only needs to be prepared in non-integral accounting system, it's a theory question. Explain cost plus contract costing. So these are theories, my friend, and you can be definitely asked that. Okay, with that said, let's begin. First of all, chapter 1 starts with 4 important words that you need to know in your costing journey. One is going to be cost. So cost is taken as a noun, right? Cost definition that you can look at is any expenditure incurred or attributable to any product, service or type. That's your cost. Any expenditure incurred typically means direct, and attributable typically means overheads. And we know that cost has got major 2 components, direct cost and overheads. So that's the definition of cost that you can look at. Then going forward in this way, in the same sequence, costing has been followed by the cost has been followed by the definition of costing. Costing is the process of ascertaining cost. And I'm not writing, but I'm just telling you very clearly. Cost is a noun. Costing is the process of ascertaining the cost, that is costing. Then third, we have cost accounting. It is the process of recording ascertained cost. Right? Cost accounting is what? Cost accounting is the process of recording ascertained cost. So first you know about cost, then you calculate it, that is costing. Then you record it, then you write it, that is cost accounting. And whenever you get stuck up, you can always go to rule book, reference book, and the rule book, accounting, cost accounting standard, cost accounting conventions, guidance comes. All that are your cost accountancy, right? So these are the 4 words that have been defined. Then comes a very important question in your study material, and which has often been asked, is methods of costing. So when we talk about methods of costing, there are a few methods that you must know, and it can be asked as a question as it is in 4 marks that describe 4 methods of costing that has been asked, or other ways also there which I am just explaining right now. So methods of costing, first method is going to be unit costing. Now what is unit costing? Which company follows unit costing? So unit costing should be followed where cost of 1 unit of product can be ascertained. That is unit costing, right? Like you can ascertain the cost of 1 car, 1 blazer, 1 iPad, 1 iPad, 1 watch, one camera through which this recording is getting happened. You can record all this, but where you cannot ascertain the cost of 1 single unit, there you have to follow the next method, and that is going to be batch costing. So for batch costing, we will say that where cost can be ascertained for the batch and batch means group of similar years. Now when we say that where cost can be ascertained for the batch, it means cost cannot be ascertained for 1 unit. So where cost cannot be ascertained for 1 unit. Like if I give you example, say for example a medicine company, a pharma company producing medicines, small capsules, you cannot ascertain the cost of a small one capsule. Okay. Now here some students tell me, so I can decide if I am buying a strip of 10 capsules for 5 rupees, so 5 divided by 10, it is half 50 paisa. I have ascertained. No, my friend. We are not talking like that. We are not talking about dividing and then getting. By dividing and all that, you can even get the fixed cost. But you should be able to tell it that, okay, one capsule will take that much by its very nature. Okay, if this is getting too complicated, let me just simplify it. Whenever you get confused between unit costing and batch costing, you think that no, I can calculate the cost of 1 unit. But a theory says, no, you cannot calculate this cost for 1 unit. What do you need to do? If you want a simple trick, the simplest trick that I can give you is always ask yourself, forget about cost and all that, we don't want to learn costing, just keep it simple. Always ask yourself, can you manufacture this one thing? If that answer is yes, bindas, go and write unit costing. If the answer is no, the answer is going to be batch costing. Like, let me ask you a question. Can I produce one brochure? Yes. Can I produce one iPad? Yes, I can. Can I produce one iPad if I want? Yes, I can. Can I produce one car if I wish? Yeah. Can you manufacture one mobile? Yes, you can. Now, can you manufacture one small capsule in this big machine? No. You need minimum 10 or something to mix the material or something. You cannot, how can you take only this much material and mix it? No, it's not possible. So that's the simple test that you can always look for. That if you cannot manufacture it on a single unit basis, then you have to be following batch costing. Then third, unit costing, batch costing. Third costing is going to be job costing. Like job costing is where cost can be ascertained for the job. Now I am writing it because once in one attempt, 4 marks the question came like this. Very simple question. Like first they taught this, where cost can be ascertained for 1 unit. You just had to write the name method in front of that. So you have to write unit costing, okay, 1 mark here. Where cost can be ascertained for batch costing, okay, 1 more mark. That was the question asked for 4 marks, right? So now we say that where cost can be ascertained for the job, and job means where every product is different, where every unit is different from others. That's job. Like, I'll give you example. Industry straight away. Example can be interior decorator. Look, for interior decorator, every job is a different from other. Someone want this kind of designing, someone want other that way. Then you can talk about advertising agencies. Someone wants print media, someone wants electronic media, someone wants social media, someone want to run campaign. Other way, every requirement is different than other. So that is job costing, right? Then few things that you know, so we are not going to discuss anything about it. Contract costing, we have done the whole chapter about it. Service costing, which is your operating costing. Hotel, transport company, you learned the entire chapter, so let's not get into it. And last again I have to write is a multiple costing. Multiple costing is followed when production process is complex. Where production process is complex and one method cannot follow. It's a complexity, right? Some departments are producing units, some assembling. So in that case, you have to follow multiple costing, right? That's the question about that's the question about methods of costing. Then next, you are asked techniques of costing. Please understand, if I have to give the difference between methods of costing and techniques of costing in one way, methods of costing talks about ascertainment of direct cost and overheads is discussed by techniques of costing, because see, cost definition is any expenditure incurred or attributable, so that includes direct cost as well as indirect cost. Costing says ascertain cost. Effectively, we have to ascertain both direct cost as well as indirect cost. So direct cost is ascertained by methods and typically indirect is covered by techniques. Again, there is not much to discuss over here. One, of course, is absorption costing, where product cost is equal to variable plus fixed. Then we have got marginal costing. Marginal costing, product cost is only variable cost is considered as the cost of product. Only variable cost is considered as the cost of product, right? So absorption costing, marginal costing. Then third, we have direct costing, where only direct costs are considered as cost of product, right? Then we have differential costing. So differential costing is typically change in total cost due to change in one unit of production. That is differential costing. Then we have uniform costing. Uniform costing is where all the firms in industry follow similar treatment. They decided, okay, we're going to follow in this treatment. That is your uniform costing. Next, as given in your study material, we have got standard costing as well. Right? So these are the techniques of costing. The next important question that you are asked in this is objectives of cost accounting system. So when I have to discuss objectives of cost accounting system, there are 5 main objectives with which cost accounting system was developed. First and foremost, ascertainment of cost. That was the most important objective of cost accounting system. You have to ascertain the cost of product. Second, ascertainment of selling price. Please mind you, cost of product is only ascertained by costing. Finance cannot ascertain the cost of product. I give you a live example. Like if you are paying rent, what finance will do? Finance will do rent account debit to cash and bank. That's it. Now, how to charge this rent to each and every product? Finance has got no answer and finance has never thought about it, nor it needs to. I'm not blaming finance. In costing, we have got absorption costing, activity-based costing, wherein we charge this rent to these products. So only and only costing can give you the cost of product. Finance can give you total of all the products. Like if it is total, debit of manufacturing account, trading account, it can give you total. but it cannot give you product-wise cost. That is only and only costing can give. And if finance cannot give you cost, it cannot give you selling price. Yes, finance can write sales, record sales on the credit side of P&L, but at what price it should be sold, it is only costing, right? Then, third objective is going to be ascertainment of profit. Again, someone might say, sir, in cost sheet you teach us, those who have seen my cost sheet videos, that we do not have costing for the purpose of ascertainment of profit. Yes, I still am on that, and that is why we do not record financial income and expenses. But here we are talking about profit of a particular product. Which products are profitable, which are not. That is something costing can tell you. After having done ascertainment of profit, next objective of costing is cost control and cost reduction. I am not getting into it. In my theory sessions, I have spoken about this difference. We have taken 5 difference points between cost control and cost reduction. And last objective that you can look at is assist in management decision making. That's the third and that's the fifth and last objective that we have about cost accounting system. Then one important question that is also asked is called responsibility centers. Okay. Now there are 4 types of responsibility centers that we broadly need to discuss. First, is going to be cost center. The departments which are only incurring cost, they are not earning, like your maintenance department, like your canteen department, they incur cost, they do not earn. Revenue center, they are only earning for you, like sales department. Then you have got profit centers. See, cost where only cost is incurred, revenue is where only earning. Profit means revenue minus cost. There are departments which do both this, like branches, independent branches. They do sale also, they incur cost also. And fourth and last, we have got investment centers. Then, next important question that we have in chapter number 1 is cost unit. So cost unit is defined as a unit of product, service or time for which cost can be ascertained. What can be cost unit? It can be 1 unit also, it can be 1 batch, it can be 1 job, it can be 1 kilometer, it can be 1 ton kilometer, it can be 1 passenger kilometer, it can be 1 room day in case of hotel, in case of hospital it can be bed day, right? For which you ascertain the cost. That is your cost unit simply. And then one very big question that we have in chapter number 1 is classification of cost. Now this is something that is really easy, you know it. Like if I were to tell you that what is the classification of cost by element. So by element we have got 3 classifications. Material, labor, expenses. Right. By deductibility, we have got 2 types of cost over here. One is direct cost and one is indirect cost. Then classification of cost by function. So by function we have got 4 classifications. By functions we have got 4 classifications. First is going to be my direct cost. Then for overheads we have got factory overheads, admin overheads and selling and distribution overheads. That is by function. Then we have got classification of cost by behavior. So by behavior we have 3 classifications: variable, fixed and semi. Then by controllability. So from control point of view we have got two breakup. One is a controllable cost and another is going to be uncontrollable cost. So we have controllable cost and uncontrollable cost. Then by we have got 2 more types of cost. One is explicit cost. Explicit cost means which requires outflow of cash, and we have got implicit cost. Implicit costs are the costs which you incur but you don't have to pay in form of cash, like opportunity cost. Okay. Then explicit cost and out of pocket cost both are same. So there is one more written in your study material, that is out of pocket cost. Then we have got sunk cost, right, which are costs incurred in past. Then we have got discretionary cost. And there are committed costs. Now what is discretionary cost and committed? Committed costs are something you have to pay. Like if you made an agreement, rent is something that you have to pay. But discretionary costs are what? Discretionary costs are the cost you incur if you wish and not if you don't wish. Like advertising. If you think I want to spend on advertising, it's okay, go for it. If you think no, I don't want to, it's okay, don't do it. That is discretionary. Another example of discretionary cost can be research and development cost. If you think I want to research further, it's okay, do. If you don't, fine, don't do it, right? So there are numerous pages on this classification of cost. Majority of things you know because we have learned somewhere or the other way. So do remember this thing, and I think that of course you have to read each and every line of chapter number 1. That is more important. And apart from that, as far as theories are concerned, every chapter beginning, like I gave you a few examples as well, there are theories. Do recall theories and it will help you a lot to get good marks in costing. So my friends, with this we are concluding this rapid revision session. I have tried my level best to cover every possible aspect of costing in this shortest possible time. Yeah, you may feel like, oh my gosh, this video is 8 hours, but my friend, 15 chapters in 8 hours and we are covering every damn thing. It's just nothing. So if you just go through it sometime before examination, it will be brushing up so many things and it will be a big booster to your preparations as far as costing paper is concerned. Thank you so much for watching this video. Subscribe to our channel and keep watching us. Thank you so much. Bye-bye. Take care.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.